All right, guys. Jerome Powell today at 10 a.m. We'll see how that goes. Let me know if you think it's going to help or hurt the market. Um, Market dropped a little bit yesterday. It's gapping up a little bit today now. All right, so we're going to do a poll here. Does Jerome Powell help or hurt the market today at 10 a.m.? Help or hurt? Go to the poll. Tesla up to almost 280s, man. What a huge run for Tesla here. Look at it, 280s right now, 279.50s. SPY is actually green today, pulled back a little bit, but mostly flat yesterday. Didn't really do that much. We'll do a timer for 10 a.m. Right now it's 5 a. It's 6 a.m. right now, but we'll do a timer. See a significant push in U.S. and Europe by the indicators. Yeah, they're moving. All right, guys. So okay, this is sad music. I gotta change that. Gotcha. Thank you. It's 1 p.m. here. What's up, Dan, Yobito, Fool, Han, Orkin, VDS? What's up, team? I'm starting the stream a little bit earlier than I normally do, and that's okay. 70% of people think Jerome Powell is going to help the market. I'm going to get a timer up here. I'm curious to see what we get today. I'm also going to put some music up in the background, so hold on. There we go. Disney green today made a little bit of our money back. Tesla, man, huge run yesterday. Huge run in pre-market today. Hey, congrats. Hey, what's up, Adam? Bob. All right, so yeah, today at the semi-annual monetary policy report to Congress at 10 a.m. is when Jerome Powell is going to be speaking here. Tomorrow, he's going to be doing the same thing in the semi-annual monetary policy report to Congress before the U.S. Senate. Today is in front of the House. I'm pretty sure today's the House. Yeah, today's the House. Tomorrow's the Senate. So congressional testimony for Big Papa. Yeah, and we'll see what happens here today, man. Honestly, yesterday I've been using Chart Prime, where I showed you guys where I actually got it to alert me. So I actually got it to alert me on my phone. So now if an alert goes off, my phone will alert. I'll get it to alert in numerous different places, but at this point in time, when an alert goes off, you can kind of see the different alerts that fire here, and it works, dude. Honestly, I waited around yesterday during market hours, and I would just kind of sit there and check my phone every couple minutes, and was able to get into a bunch of really nice trades, to be honest, yesterday. Like throughout the day, you can see the SPY, NASDAQ, it's got the NQ firing, and again, you can kind of see when these alerts hit. I bought this one. I did end up making money on Top Step yesterday based off of these alerts. If you look at the trades I got into yesterday, you can see here we made about $1,200 yesterday. When I was said and done, about $1,200. You know, again, we took these trades. Again, I like looking for when a bullish engulfing candle or a bearish engulfing candle and a reversal signal shows up at once. Here's another example of it. Reversal down, bearish engulfing, nice downward trend for like an hour, reversal up, bullish engulfing, nice upward trend. And we were just waiting for these alerts, and we took the trades when they gave us, and it worked, man. It gave us really nice trades to get involved with. And so that is the service I'm using is called Chart Prime. Now, they're a sponsor of mine, but honestly, it genuinely works for me, at least. I can't guarantee it's going to work for you. Of course, nobody can. But yeah, it was fun. We're going to do it today. Again, we got our alert set. My son is still sick, or has been sick. He's going to get better today. I'm going to put that out in the universe. He's going to get better today. He's not going to be sick anymore. But yeah, yesterday he ran high fever still. This is day 5. Today would be day 5. Hopefully it's done today, man. But man, it's just been super stressful. Shopify says pay will be available to enterprise retailers not on Shopify, according to a blog. Did I miss some big Tesla news? Let me see. All right, you talking about the investment in India after he met with Modi? All right, Modi in the U.S. says Elon Musk says Tesla is going to come to India as soon as possible, end quote. You can now buy a Hyundai Ioniq 6 for less than a Tesla Model 3. Yeah, but I mean, dude, that's kind of how it goes, though. Hyundai is a cheaper model, you know, car. So it's only $5,000 cheaper too. And so in that regard, like if you got the option for Model 3, Hyundai, I'm gonna go with the Model 3 every time. I think Model 3 starts at $40,240. But if you want the 6-cylinder or 6SE, 6SE, not cylinder, sorry, with the higher range, it's going to cost about $3,000 more for the What's up, Daniel? Don't forget the tax credit for $7,500. Yeah, for sure. You know what I figured out? I'm going to take some trades on some other stuff. $7,500 tax credit. New ETF includes Tesla EVXX. What else does it include besides Tesla? It just doesn't have any liquidity is the problem. Like the liquidity is very light. Powell speech is at 10 a.m. So we got like we got like 3.5 hours. A little bit over 3.5 hours. We're going to be trading at the open today too. Here, I'll put a timer up if it makes you guys see it better. Yeah, so we're putting a timer at Tesla. Yeah, Tesla, I mean, huge run here, man. And I was just wrong for Tesla. I thought Tesla was sketchy at 100. But it looks like in hindsight, dude, I was just right. Tesla just ripped. So here's the timer. SPY is up to 437.60 today. Look at the Q. Tesla holding really nicely here too. Again, and what I'm probably going to do is like, again, I made some money on Chart Prime yesterday, dude. Again, what I did, I figured out how to get the alerts to actually work. Like I figured out to get alerts that actually alert me. And yeah, I figured out how to get alerts that actually worked here. So, and I know exactly how I got to do this. So now the system I have planned here is like this, okay? So like you see the reversal signals. The reversal signals sometimes come in. I got to give them like a window of opportunity to do it. Like I got to give them a window to work, right? Sometimes they're just going to straight up work really quickly like this or like this. But I have to give them like a window because sometimes they come back down here And you can kind of see sometimes they break this the candle showed up right there. So sometimes they break that and they end up going in the direction that I wanted originally. And so I think I have to give them like a window. Or there's two ways I could do it. I could either cut it as soon as it breaks, you know, within a certain distance past the candle. Or I think a better way to do it is to, if it breaks like significantly over that specific candle, I cut it. But then I watch it, because if it reverses and starts to go back under the reversal signal, then I could probably take the trade again. You know what I mean? That's the other option to do it. I don't know. But again, it worked really well. I mostly did it on the SPY or the E-mini yesterday. So like if you put up the SPY chart and you can kind of look at where the market oracle worked. Again, my big strategy here, and they don't show up a lot every day. So I need alerts, because if I don't have the alerts, I'm going to miss it. Because look, this only showed up twice yesterday, but every time it showed up, it worked really, really well. Again, bullish engulfing candle and reversal up signal. Nice bounce. That's the first one I took yesterday, where if you look at the actual trades I got involved with on Top Step, that's the first one I took yesterday. Again, I made like $500 or $600 from that one. And again, I was very red leading up to this. Like I was kind of red leading up to this. You can see I was down at one point like $500. And then this was the second one where it alerted me here. Again, same thing, reversal down signal and bearish engulfing candle drops. And you can kind of see it worked this time too, bounce. And then this one would have worked as well, bounce. The 5-minute chart is really where it shines, I think. I haven't really tested it in a bunch of other areas, but the 5-minute chart is really where it works the best. And so that's what I'm going to be doing today. I have the alert set. It's going to alert me anytime that triggers. And so I'll know when it happens. And I'm just going to kind of sit back and wait and try to use this to get funded, to be honest. Looking at our poll numbers here, we got over 100 votes. 57% of people think he's going to help the market. I don't know, bro. Sometimes, okay, especially with how hot the market is right now. I don't know. At least the LSU won yesterday. LSU versus Tennessee, we actually won, so that's good. Data on the state of the housing market by the Fed. Fed's target of 2% annually. Hey, nice, Jeffrey. Hey, thanks, bro. Yeah, dude, it's dope, dude. Honestly, again, the 5-minute reversals work really, really well on Chart Prime. And I'm not even trying to do like a plug here. Like I've actually been using this, and I'm probably going to set it for like a couple other stocks like Apple and Tesla. I'll probably set it up for that, because again, you can kind of see the 5-minute. Again, I think the 5-minute is really where it shines. Again, reversal down, drop, reversal up, bounce, reversal up, bounce, reversal up, bounce, reversal up, bounce, reversal down, drop. This one didn't work. This one worked beautifully. So like, yeah, like look at when the reversal signal and a bunch of engulfing candles show up at once. That's the real big edge one. That one will find you tops like this. Like, look at that. And then drops. I think that one's powerful. But like, even if you just kind of tally them up, if you want to back test it, it's really easy to back test. So again, 1, 2, 3, 4, 5, 6. That one didn't work. So 6 out of 7 worked at this point in time. 8. So 7 out of 8 worked. 9. 8 out of 9 worked. That one didn't work. So 8 out of 10 worked. 11 out of 9 worked. Whatever. Point is, this is giving you like really high accuracy rates if you wait for it. And again, I can't guarantee it will, but it has over the last few days for sure. Yeah, I'm from Louisiana. I'm always kind of hesitant. Like anytime I see somebody be like, "Hey, I'm from Louisiana," to be honest, I'm always kind of hesitant, bro. I'm always kind of like, because like I've got people. I don't know. I've got friends. I think the friends that would probably be more likely to do this live in like Florida now, but I've got some people that would just that I don't know. I've noticed the way that some of the trolls type, you know, and they're very similar to the way that some other people that I know of type, you know. And so honestly, I'm hesitant now. Being on YouTube's a weird thing. And I'm not acting like I'm just like the biggest, greatest, most famous person ever. Obviously, I'm not, right? This is a, you know, it's a good size YouTube channel, but like I'm not acting like I'm like super famous because obviously it's a very small niche, if that makes sense. But yeah, I don't know, man. Yeah, I'll probably set the alerts up for Tesla and a couple other things too here, to be honest. So I got it set currently for the E-mini, the NASDAQ, the US 100, which is the same thing as the NASDAQ, but just in case it doesn't work, I set it for that one too. And I'll probably end up setting it over as well for like Apple, I think is one. I'm looking for stuff that's volatile, like actual stocks that are volatile enough. I'd have to actually test it though on Apple. It looks like it works on Apple, but you never know for sure. It seems to work okay on Apple. I think, again, the real edge is when multiple show up together at once. I think when multiple show up together, like when a bearish engulfing or a bullish engulfing candle and the reversal signal all show up together within like again, within like a couple minute period, that's when it's like powerful, you know? All right, we got the possible reversal down for Apple. The good thing about TradingView too is that it lets you like set alerts. All right, so we got it set on Apple. I just got to set it on Tesla and then we're good to go. Test it on Tesla though. But yeah, how about those Tigers, man? LSU doing great. Yeah, Tesla seems to work okay on too. I find it works better on broad market ETFs, but I'll set it here. Possible reversal up. Possible reversal down. All right, so we got it set on a bunch of different ones now. We'll see how that goes. Oh, bro, you got to root for LSU if you're from around Baton Rouge, though. I don't have a discount for actual TradingView. I got a discount for Chart Prime. And yeah, if anybody wants to try out the indicator service that I've been talking about all day, here it is right here. Pretty cool though, dude. Like again, my favorite way to use it, and again, I'm going to preface it with like, I can't guarantee you're going to make money. I can't guarantee it's going to work. I can't guarantee it's going to do anything. My favorite way to use it is to wait for a reversal signal mixed with a bearish or bullish engulfing candle to show up within like a 15-minute period of time. If they show up within a 15-minute period of time relative to each other, that is where I think this setup has a very high accuracy in the SPY and the NASDAQ. That is where I think it's the highest, is the SPY and the NASDAQ. That tends to work. Again, I'm going to tread lightly with this because I can't guarantee this is true. But it looks like it works very high percentages of the time in that situation. Again, that's what I made money on yesterday. So that's where I'm going to be putting most of the weight on it. Like I'll still look at the other reversals and stuff, but is crypto moving right now? I know people also use it for Bitcoin. So I guess that would be a good option to like test this here too. Bitcoin US dollar. Try this here. Yeah, it seems to work okay there too. I have to test it a little bit more, but Big Papa Jerome Powell speaking today. A lot of stuff gapping up some today too. I wish I knew a trader in real life. Haven't met one yet. We are rare. I guess most stay home, stare at charts all day. Traders are less rare than you think, bro. A lot of people trade. They just don't talk about it. Very sad to hear about the Titanic submarine that's stuck underwater. Yeah, man. Sad about the Titanic submarine. Powell speaks at 10 a.m. Eastern Standard Time. But yeah, traders are more rare or less rare than you think, man. There's a lot of traders out there, dude. It just depends, bro. Like a lot of people call themselves traders and they really aren't. You know, like I'm from Baton Rouge as well, and I know a lot of people in Baton Rouge that are my age. It depends on how old you are, whether you know them or not. But a lot of them, a lot of people I know found out about my YouTube channel through me, and then they all of a sudden started acting like traders and posting their Robinhood links or their, and said they were day trading on Robinhood, and like they really weren't. Like most of them were just kind of nonsense. Like they were just trying to. Most people like that are just trying to sound cool. They're trying to sound smart, is what they're trying to do. In the end, very few people are actually traders, though. Like that genuinely like sit around and trade all day. That's a much smaller percentage. And I don't know, man. I looked at the poker controversy with Martin Cabral, and I don't think he cheated for a lot of different reasons regarding Martin Cabral. I don't think he cheated. The main one is because it would be so difficult for him to cheat and get away with it. Like they would produce if he marked the cards, they would be able to produce those cards and say, hey, look, these cards have markings on them. They know exactly what cards he would have done it on too, because you're able to see what cards he played and what cards his opponents played. You could find those cards, whether it was the ace of spades or whatever it is, and produce that card and say, hey, look, here's the markings on the card. The fact that nobody's able to do that, and the only other reason that we might not see that is if WSOP doesn't want that getting out. Like if WSOP doesn't want that out, then that's a different story because they don't want it to seem tainted or whatever. But yeah, I don't think he cheated. I think it would have been too difficult to cheat. I think he was most likely trolling people, making people think he was cheating so that they would be emotional and make bad decisions. I saw Doug Polk say it. I agree with him. Yeah, Bitcoin. I mean, hey. BTC all the way at 29,000 right now, so moving big here. Great for it, man. Good. It's about time. I know the typo I said it. Yeah, I guess in that regard you might be right in some ways, but all right, Big Papa Jerome Powell. 10 a.m., guys, 10 a.m. Looking at our poll votes here. Again, I got so many alerts there that it's going to be hard for me to keep track of them, but I guess that's what 4 monitors are for, right? I guess the main question is, do you guys think the market is going to hold today? Do you think it's going to bounce? Do you think it's going to fall? Do you think it's going to be choppy ahead of the Jerome Powell press conference meeting thing? AI girlfriends, man. What a ridiculous world we live in. Has anybody seen the Amaranth, or how do you say her? I don't even know how to say her name, dude. Amaranth, virtual AI girlfriend. Honestly, bro, if you're paying a VR girlfriend, or if you're paying an AI girlfriend to be your girlfriend, bro, you got other problems, dude. Who actually does that? Like, who actually is like, hey, I'm gonna pay this person to be my pretend girlfriend? It's AI, dude. Like, bro, anybody ever seen that movie, Her? We are going into that, you know, which is kind of crazy. Again, at one point, do you have to worry, is are we inspiring these things, or did they correctly predict these things? Is the real question. Like, are these movies inspiring this technology, or vice versa? Did this technology, or did these movies actually predict the technology was going to be there? I don't know, but it's getting weird out there in the world right now. It's cheaper. Oh, it's definitely cheaper. Honestly, it's survival of the fittest, in my opinion. You know, like, if I'm being real, like, if you're out here paying for, you know, dolls or pretend girlfriends or AI girlfriends instead of actually, you know, like, we're mostly driven by biology. Like, men and women are mostly driven by biology. You know, men want to find suitable mates to have babies, and women want to find protectors generally. And again, that's just biological. I'm not saying that we haven't, like, moved past that, but, like, that's where our instinctual, like, stuff comes from, is that mostly. Now it varies now, and the world has grown and evolved to a point where it's not always like that, but yeah, Darwinism to a certain extent, I guess, at this point in time, with that type of stuff, right? Right, exactly, Jay. Guys with no social skills who don't want to do what they need to do in a relationship. And I get it, bro. I'm kind of awkward and nervous. You know? Like, I never had problems with getting girlfriends, to be honest. But, like, you know, I can be awkward. Not really in front of girls. I was always kind of okay. I might have been a little shy, but again, I did all right. But I think people just got to, like, I think what happens is people, because I've seen it happen to a couple different people I know, but like I think what happens is people, like, they put it on a pedestal so much, they put like a girlfriend on a pedestal so much that they just get so nervous about it that they never take a risk, right? Like, you got to be okay with getting rejected. I think if you're gonna if you're gonna succeed, you got to be okay with getting rejected. I think that's really what happens, is that most people are just scared of getting rejected, and so they just never try. Everybody's a product of one's environment. It feels like we are living in a weird 80s cyberpunk movie. Yeah. Yeah, maybe TK. That would sell like crazy, though. Yeah. Yeah, I don't think it's unrealistic expectations. I think they might mask it as that, but I think what it really boils down to is a fear of rejection. You know, like, I think they might say, "Oh, well, none of these girls are right." It's like, are they really, or are you just kind of scared to, like, try? Are you scared of getting rejected, so you just never try? I think that's more likely the outcome, and I think they'll justify it with, "Oh, well, the girls aren't right enough," or whatever. But like, deep down, they're just worried about getting rejected. I think is really what it is. And I think a lot of people hide behind that and then just never end up making a commitment to do anything, you know? Yeah, the Q, guys, dipping down under the previous closing price, under the volume weighted average price, under the 200 EMA. Honestly, bro, I can't even knock OF girls, though. I can't even knock that. Like, bro, put it in trading terms, right? Look how much easier, like, the trading girls grow, bro. Like, they will grow 5 times faster than any guy on here if it's a pretty girl that trades. And I can't even get mad at it, dude. Like, I really can't even get mad at it. Again, the OF thing as well. Like, listen, if men had it like that, they would absolutely be jumping on that and doing that too. And so I can't even judge. I can't really judge. Again, the Q down at 367s. Tesla pulling back to the volume weighted average price. Again, I'm kind of waiting for these alerts. We got these alerts set. We're going to see how that goes. Just kind of patiently waiting. Again, Jerome Powell, Big Papa, today at 10 a.m. We got the timer up. Spotify's decided not to renew Meghan Markle's podcast deal. The podcast produced just 12 episodes, 12 hours of work for a $200 million or for a $20 million contract. So Spotify is mad at them. He said, quote, "I wish I had been involved in the..." Dang, dude. Drama. Yeah, Q getting rejected here. What is the main stock falling with the Q here? Here's the Q. Apple at $185, $185. Hey, what's up, Lulu? Trading. Tesla could run up 10% in a day, and I cringe if it pulls back 1%. I call this. Hey, what's up, Chris? NKLA? Yeah, here's Apple. Apple's not really moving in pre-market. Tesla is really the one that's moving a lot currently. Again, what's your favorite stock for a buy today, guys? List your favorite stock for a buy today in chat. Let me know what it is. A lot of people saying the market's now in a bull run. I don't know. The missing Titanic tourist submarine is being controlled by a $30 Logitech gaming controller. Wow. All right, so the Citadel, Fidelity, and Schwab launches. They all launch a new crypto exchange called EDX Markets. All right, guys. Everybody's talking about AMC today. What's going on with AMC right now? AMC's at 460s. Just not really looking that great. What about GameStop? I know that one's had Cohen hype last couple weeks. Bro, here's a seagull eating a freaking squirrel. Where's that squirrel going to go? Do not cut off. Yeah, I got to see this. What's that bird going to do after it eats this squirrel? Oh my gosh. That thing just devoured that squirrel, dude. It's a little bitty bird. That squirrel's bigger than it. Where's the squirrel going? I'm sorry, guys. A seagull eating a squirrel. Elon followed Vitalik, the ETH co-founder, on Twitter, sparking speculation about potential collaborations. Bro, seagulls are like little raptors, man. You're savages. You just ate a squirrel. You saw that? Yeah, bro. That was crazy. I've eaten squirrel before. I'm from Louisiana, bro. I used to go to the wildlife and fishing shows when I was a kid in Louisiana. So I've definitely eaten squirrel before. I've eaten squirrel, alligator, quail a bunch, you know, like I've eaten a lot of different foods. You know, the Waterboy movie was mostly stereotypes, except for what we eat. We don't eat it. We don't really eat that stuff like regularly, but we do eat alligator sometimes if you're from Louisiana. All right, so 8 companies make up the S&P's market cap. Google, Amazon, Apple, Meta, Microsoft, Tesla, Netflix, and NVIDIA here. What's NVIDIA doing this morning? NVIDIA ramping up yesterday, too. That's nice. Let's see if it holds. Bro, Twitter ads are getting rough, dude. Or Twitter bots are getting rough. Somebody said on Twitter, I'm 100% convinced that no one actually knows regex, regex, whatever you want to call it, bro. If any of you guys have ever messed around with that, it is it's basically like a mathematical language. It's like a mathematical abbreviation language, and it's just I've learned a little bit of it for programming purposes, but man, it is not fun to learn. Frog legs are actually really good too. Dexcom and McKesson. Yeah, nature is scary for sure. Honestly, they really are. Frog legs are actually really good. Bro, I'm up early every day, bro. Every day I start the stream at like 5:30, 5:15 in the morning, 6:15, 6:30 market time. All right, guys. So yeah, NVIDIA dipping down a little bit. Tesla at the volume weighted average price, waiting for something to happen there. All right, guys. Hey, what's up, Pawn? What's turtle taste like? It's all right. I've had turtle before. It's been a while. I don't remember. I've had turtle soup is what I've had. I think it was turtle soup. I can't remember what I had. It tastes like chicken. I don't know. Honestly, I don't remember. I feel like I've had it, but it might not have. I don't know. Ooh. Ooh. Where's it at? Where's my signal, bro? What? Bro, you're supposed to show me a signal. Why are you going off right now, bro? Where's the alert? I'm gonna try to buy this dip. Sure, I'll go ahead and send that. I like the pullback to the 200 EMA, so we're just gonna add like 40 shares. I don't actually see a signal here though, so I wouldn't copy me here. I don't actually see any signal. Like it gave me that big alert. Is there any way I can check? Oh, there. No, that's an Apple. Yeah, I don't know why it gave me that alert because I really don't see a signal here. It said it was on the SPY, but all right, we're in 50 shares of the SPY. I like the pullback area though. There's Nvidia, there's Tesla bouncing up a little bit. Put Tesla up here. I'm having so many freaking charts on TradingView. Let me look at my phone to see when the signal time frame was supposed to be. Because the good thing about this is that I can set it on my phone. All right, there's the SPY. Bro. What did that alert just happen from, dude? Is that like an old alert? I don't know what that alert was, bro. I don't see anything. Maybe it's like a different time frame alert, I guess, but I don't see anything. It's all right. Yeah, it could be opening alert. I don't know. But yeah, Pawn, yesterday, dude, I forgot to tell you, bro. Yesterday, I was using these chart prime reversal alerts, and dude, I ended up doing really, really well. So again, here is $1,200 in profit yesterday, give or take. Let me see how much net that was. I'm curious to see how much net this was. But again, what I basically did was I set the alerts on my phone. I set them to show up on my phone, and I specifically set them to show up in my TradingView app on my phone, right? So I would get the alert on my phone, and that worked really well. We ended up making, on the day yesterday, net, we made about $980, $982 or so from that. So that was nice to see. We'll get ready to cut this pretty quickly here. I do not want to get stuck in like a breakdown, because I really don't see any alert that you know, they gave me the signal, but I don't actually see any alerts. And so maybe it was an alert, but if it was, I don't know if it was a bull or bear alert too. So it could be either one, I guess. Go to your alert settings and see where's the alert settings. Yeah, where do you go to the alert settings? Again, there aren't, I see the alert settings, but it doesn't tell me where my historical alerts were. You know, there might be a way, I don't know. Go like chart setting events. No. So this one is the 150K one. I wish it was on the 50K one. What's it like having 50K to throw around in the market? It's very nice, to be honest. It really is very nice. It's something where once you get used to it, it's hard not to do it. You know, like being able to buy, like, but you gotta have discipline with it too, though, bro. Like it's very easy to say, like, you can make money pretty quickly. You can also lose money very fast as well, right? So it's something that you got to be really disciplined with, because if not, you can just lose a lot of money. So it is something that you have to be very disciplined. You can't just throw money around all the time. You got to take it slow. Yeah, we'll see what Powell talks about today. It'll be fun. We still got about 3 hours, a little bit less than 3 hours before Big Papa speaks. Bro, how many conspiracy theories is the AMC community going to put out there regarding AMC, bro? Like, how many freaking conspiracy theories have we seen, dude? Every day, I feel like I see another AMC conspiracy theory, and it's freaking ridiculous, bro. Who falls for this stuff, dude? Who actually believes this? Like, at what point do you say, hey, man, this is the 30th conspiracy theory telling me that some super secret thing is going to happen and AMC is going to moon? At what point do you say, hey, this is probably BS, like we've heard it all before? You know, who continues to buy this? Yeah. Did England CPI come out today? Let me look, bro. I don't even have Bloomberg up today. Let's see what we got today. Today is the 21st. So today, we had England CPI come out at 8.7%. Year over year higher than the 8.4% expectation. Base month over month CPI came in at 0.7 versus 0.5% higher than expected. Looks like they also had PPI, which was minus 1.5%. So producer inflation went down a little bit for England. We also have what country is this? Okay, so we also had South African data come out. It's a trading view indicator service, Jay, but you can use it in stocks, crypto, forex, futures. Again, my big edge for them shows up when in the SPY and the NASDAQ. when the regular market oracle is what I'm using. The full indicator is like $35 a month, and this is just a tiny percentage of it. So there's so much more that comes with it than just the indicator I'm using. But my favorite one currently is the reversal up signal or the reversal down signal on a 5-minute chart specifically. Like the 5-minute chart's the big edge one, in my opinion, where we get an engulfing candle of some sort and a reversal signal that show up within like a 15-minute time frame, within a 3-candle period on the 5-minute chart. If that can happen, it's usually a pretty good sign, and that's what I've been using here. Nvidia's starting to pop up a little bit as well, but again, you can use them on any time frame, all that stuff. I just like using yeah, you can see the link in the description is there. All right, we're still in Disney. We did buy the Disney dip. Our average is like 90 something, like 90 point something. So we're still in Disney, but we're just kind of waiting. We're down less than $100 there, and I think we're just gonna have to let that sit, and just kind of patiently wait, if we can. Again, what's the best trade you guys see? If we break down under this VWAP 200 EMA. Volume profile? Well, explain yourself a little bit. I don't think there's any one indicator. Like, again, trading is all subjective, right? So everybody's different. Everybody likes different things. Everybody likes different strategies. One of the things I usually see is like the more somebody says that their way is the only way, generally the less experience I think they have in markets, right? Because like sometimes you'll see new traders and they'll be like, this way is the only way. Generally, that means they don't have that much experience, because there's such a broad array of strategies and patterns and signals and symbols and all that stuff that it's not one way. It's not just one way. There's multiple different ways to get involved with stuff. I like using candlestick patterns more so than anything else. Candlestick patterns can be powerful, and a lot of people underestimate them. Like they don't understand how useful they are. So I like candlestick patterns, but it varies for sure. Yeah, for sure. Indicators are ex post, only price action matters. I agree and disagree, right? So I think indicators can be powerful even if they show up after the candlestick closes, right? Because that's what you're referencing, is that they show up after the candlestick closes and they're lagging. And in that regard, that's true, right? But I think, again, I can't fake this. Again, I can't fake what I'm showing you. So again, here is one of the ones I'm using on the spot. Again, it's called Chart Prime. Again, if you just look at every time this one specific pattern happens, right, where you get a reversal up signal and a bullish engulfing candle here. This is a 5-minute chart. So this is a bounce over like a 5-hour period of bounces. Here's the same thing, reversal down, bearish engulfing candle, hours of drops, right? And so that's 2. And again, you can keep searching here. Reversal up signal, bounce. Here's the same thing, possible reversal up and a bullish engulfing candle, bounce. Same thing here, where you get 3 different indicators showing up together at once. Again, bearish engulfing, drops. And so again, like we could say they don't work, but I think when you look at them, very high probability. Look, here's another one, same exact thing. A test that you can use on Chart Prime is find one where this happens and it doesn't work. I think you're going to be, I think it's going to be a hard time finding it. Look at this, same thing. Again, I can't guarantee anything's going to work for you, but it's pretty powerful. But at the same time, just to be a little bit agreeable here, I do agree chart price action is the most important thing. It's the first thing that you should be learning in trading for sure. Indicators are only a past of price action. Sure. I mean, I understand that as well. But everything is a passive price action. Like that's what technical analysis is historical analyzation of historical price action. Like that's what it is. That's what tech analysis is, of course. And so of course it is, you know. How many cups of coffee do you drink in a day? One. Typically only one. Not into penny stocks? No. Most penny stocks are sketchy and fail and just not realistically good. There's just not really any. Again, you can day trade penny stocks, and if you're good at that, great. More power to you. I think it's incredibly difficult to succeed in those markets. I think most of them are propped up by people pushing courses on others, and they're just kind of selling people a dream. You know, and people that don't have large accounts, they want to believe it because they don't have the money for a large account. So they desperately want it to be real. And so that makes them ignore red flags and signs and ultimately gets them kind of into these really sketchy markets. Hey, bro, might be a dumb question, but in your opinion, what's a good stock to add to your portfolio? I have no idea, man. All I can go with is what I specifically like, which is Apple, Amazon, Disney, Google, Walmart, Home Depot, banks, JP Morgan. And again, I can't guarantee those are going to work for you, of course. These are just my own subjective stocks that I like in long term. But yeah, those are my favorite ones. Penny stocks of tight liquidity with downway development. Yeah, I understand that, Anton, but the problem, brother, is that most of the time people are sold on those. Like the worst investment you could ever make in stocks is investing in a penny stock, right? Like that is the worst investment you can ever make. Are there outliers to this idea? Sure. You know, people always say, oh, Tesla was a penny stock. Maybe. But most successful companies do not start off as penny stocks. You know why? It's because that by the time they IPO, they are already successful enough to IPO and immediately get, you know, large cap, mid cap status as soon as they IPO, right? Facebook is an example. Amazon. There's just a lot of different versions of this, right? Most penny stocks are going to fail. And so what happens a lot of the time is like, it's kind of like the Wolf of Wall Street, where you got Aerotine International, cutting edge firm at the Midwest awaiting imminent patent approval, civilian and military uses. It's really just the shack, right? But they have to sell investors or retail traders a dream to get them to buy these crappy companies. You know, the quote they said is selling garbage to garbage men. is what they said in The Wolf of Wall Street. That's what happens. It's like you look at the due diligence for these penny stocks and they just pump these things up. They make it seem like the next Amazon. Retail traders are really the people that are investing and losing money in these. And no matter how much money they lose, they just kind of hold on to the dream. And it's the rough cycle of penny stocks, right? That's what happens to a large majority of investors. It's unfortunate. Eventually traders wise up and they start buying blue chip healthy companies. But sometimes it takes a while and sometimes they never do. Yeah, there's no other guy on the mic. Again, I got a lot of people that want to come on stream, bro. I'm not letting anybody come on stream anymore. It's just not worth it. All right, guys. So again, SPY broke under the previous closing price. Maybe it was a bear signal. I don't know. All right, guys. SPY at 437s, NVIDIA at 436s. Again, Disney down a little bit. Again, NVIDIA break it down. Tesla's still holding really well. Tesla is one of the reasons the market's doing so well today. All right, guys. So again, we are kind of sitting back waiting here. Yeah, there's no other guy on the mic. But yeah, what I was gonna say is like, bro, I'm never gonna have another guest on this show, dude. Not at any time soon, dude. Like, there's too many people that try to manipulate me. And again, I don't know who it is or what it is, but like, again, I'm just not gonna have guests on. Like, too many people have agendas when it comes to me, and I don't like being manipulated in that way. And again, like, I got people asking me to come on stream and like wanting to come on stream. I've got multiple different people right now that are texting me, calling me, trying to get me to let them come on stream. And again, I'm just not about to let anybody come on stream. There's too much nonsense. Like again, to put it into perspective, 3 weeks ago, I basically got harassed by bots. I brought a guest on stream. And then right after I brought a guest on stream, I got harassed by bots. But it wasn't even bots. It was probably just fake accounts, people creating fake accounts, praising the guest, talking about, hey, this guest is so good. He's so smart. He's so wise. You should let him host a stream, they said. You should let him run a show. And it's just kind of like, bro, I don't know who else would have that agenda besides, and so it made me realize very quickly that, like, some people are desperate to come on stream. Not all of them. It's again, but in the end, all that's going to make me do is say, hey, I don't want any guests to come on the show. It's just not worth it, bro. Also, most people don't tune in for the guests, right? Like most people, again, I learned very quickly that most people are watching this show for me. I'm not even trying to be conceited or anything like that. I've had guests on the show that held their own shows. Like I've allowed people to hold their own shows on my channel, and we usually lose like 75% or more of the viewership. And so, you know, guests are cool, but they're not worth the risk and the hassle and the drama that comes with them. And so from now on, again, just to make it really easy and simple, nobody else is coming on the show. Hey, what's up, Roderick, my guy? What's up, dude? All good, Roderick. Thanks, brother. I appreciate you, man. How did they manipulate you, bro? And they came on the show, and all of a sudden, and again, we had one specific guest come on the show, right? And this was like a friend of my family. Like this was like my son knows his son and like all this stuff, right? So he comes on the show. And again, shortly after he starts coming on the show, he came on 2 streams, right? Shortly afterwards, I get basically attacked, like bots, like harassed, basically is the word I'm going to use for it, for a week plus from these guys. And they would say, I'm going to say his name was Steve. Right, but I'm not. That wasn't his name, but I'm just going to use Steve. They would say Steve is the greatest. Steve is the best. John, you're not. You're terrible. John, you're blah. John, you're not good. John, you're arrogant. They'd say all this stuff, praising one specific guest and trashing me simultaneously. They would say things like, "Hey, why don't you let this guest run his own show? Why don't you let him?" You know, they would call him like all this stuff, and it's just kind of like, look, man. I think people come on stream and they love the feeling of it. It's kind of exhilarating. Like it's nice. People are nice. People are kind. They say kind things. It's great, right? And I think that makes them get addicted to coming on stream. And maybe they hope that I'm gonna like share my channel with them or like help or like give them a split or something. I don't freaking know, man, what their idea was. Either way, it's just a stupid idea. And then, but I'm pretty sure that's what happened, unfortunately. And again, I just don't like being manipulated. Once I see that stuff, number one, I don't think people realize how obvious it is. You know, like I don't think people realize like just how obvious it is for stuff like that. And so again, every time I brought a guest on, it's just been more hassle and drama. Yeah. Scuba Steve, the GOAT, the greatest. Yeah, I mean, a call wouldn't work. It would just be too much drama. Like people would, Scuba Steve, the GOAT. All right, guys. So again, market's dipping down a little bit. I'm still waiting for those alerts to show up here. So I'm still waiting for the alerts to show up. We got time, but again, we're going to see if the alerts show up. Just kind of patiently waiting here. Big Papa Jerome Powell today, guys. Big Papa Jerome Powell. 10 a.m. is when Powell speaks. 10 a.m. Again, we got some alerts set. I'm waiting to see if we do have some alerts that show. Yeah, it's too risky. What's up, Steve? Bitcoin resistance is at 30.5K. Yeah, Bitcoin, man, all the way back up to 29K. Looks great. Definitely top 3 for sure, Steve. Definitely top 3. the GOAT. Again, let's see what happens with Bitcoin. Bitcoin at 29K. Let's see 30K. I would imagine 30K would be like a psychological support level. NVIDIA break it down a little bit. I'm looking at Moomoo to see what other kind of range we have here. And the other stock. C3 is down a little bit today. It's not a huge drop, but it is down some. So we are watching that. I'm looking at Moomoo to see some other stuff. Here's a heat map for today, guys. So if you want to see like a heat map of what's going on today, here is the Moomoo heat map for the day. And again, you can kind of see NVIDIA is helping the market right now. Is NVIDIA up that much? No, NVIDIA, this might be from yesterday. I don't know when this is. Let's see, best performing. Meta. So Meta is up 1.9%. This might be from yesterday. Let me see. So yeah, this is from yesterday. Okay, so this is yesterday's heat map. So NVIDIA did really well. NVIDIA up almost 3%. Meta up over 1%. Apple was break even basically yesterday. Amazon was up a little bit, not a ton, but a little bit. Salesforce, which is CRM, had a nice green day. You can see Salesforce. Where did that go? Yeah, Salesforce had a nice green day where they rose too. And so that's the heat map from yesterday. Again, what was mostly green AI stocks, except for Microsoft, which was down 1.5%. But kind of a choppy day. And again, you can kind of see NVIDIA start to break here, just start to flush down. All right, guys. So again, NVIDIA leading the market down a little bit today. Market's pretty flat. You can see the previous closing prices right here. So we're pretty much flat on the SPY today. Pretty neutral here. Gold, what's gold doing? I think gold is pretty flat on the day. I'm not 100% sure. Okay, yeah, gold is pretty much flat on the day. What are the metrics today for what? So will Rivian run up now? All right, guys. Rivian, it did gap up, and it ran up some yesterday, but it wasn't like a huge run up here. We still got time. We still got about 2 hours left before Big Papa, the man, the GOAT, Big P, JP, the greatest. Give me your best Jerome Powell nickname in chat right now. Yeah, so the Tesla Indian news is great for them. So Tesla spoke with a leader in India to bring Tesla, factories over there. So, and that's great. Let's see if they can. All right. Also, y'all do me a favor. Remind me before Big Papa speaks so I can switch out my headphones because I'm going to need to. All right, so yeah, y'all know Citadel, Fidelity, and Schwab are starting their own crypto exchange. Bro, I'm not saying these guys are copying me, but a lot of these dudes are probably watching my stream. Now we all, as soon as I tell people I'm buying Disney down here at these lows, I see somebody else post about it. Maybe we just had the same idea. It's certainly possible, but does anybody really buy the penny stock courses? Seriously, does anybody really buy these penny stock courses? I expect a hawkish tone. Jerome Powell. Big Daddy Dump. I like it. Give me your best Jerome Powell nickname here. I like Big Papa. Yeah, I like Big Papa, but all right, guys. So again, SPY is under the previous closing price, slightly red, but mostly flat here. Again, we got a bunch of alerts set up, and we're gonna try these alerts today. Again, what I figured out how to do was set trading view alerts that actually like gave me a notification. So I figured out how to set it up where alerts actually show up in my smartphone. Didn't you used to trade penny stocks a couple years ago? I did, but again, that led me to believe that a lot of the penny stock market was just shady, bro. I mean, you might make some money in penny stocks. Of course, there might be ways to make money in them. But I think one of the big problems in penny stocks that you see often is, I think one of the things that you see is that like penny stocks, you have to dig and find a new one every single day. Most of the time, like even if you have a strategy that works, the risks of like dilution happening, like the risks of them slapping an offering on you randomly, or the stock getting halted and not resuming and then you losing out, or like huge drawdowns, is much higher in penny stocks. So it's like, even if you have a profitable strategy, it's going to be very hard to find consistency there. And I think most of the penny stock market is propped up by penny stock gurus slanging courses for thousands of dollars on publicly available content on strategies that you can easily find on Google or YouTube for free right now. I think that's what mostly is propping up the penny stock market. It's a mix of that mixed with like pump and dumps, right? Like people desperately trying to pump up their holdings, right? Front loading into sketchy low float penny stocks, kind of like Atlas trading, to be honest, where they're front loading into these sketchy penny stocks, and then they're putting out all this marketing talking about these stocks are the greatest. They're pumping these stocks up, and then they're just unloading their shares on all the unsuspecting traders. That's what's happening. So those two markets are propping penny stocks up. It's making retail traders think that there's more edge than there really is in those markets, in my opinion. It's also talking a lot of retail traders into actually investing in penny stocks, which is even worse idea than trading them. How about that LSU game, though, guys? What is Big Papa discussing today? He's speaking with the House on a semi-annual monetary policy report. So he's talking about monetary policy in the market. Yeah, they're pretty much crap. Palpatine. I like it. And again, a lot of people, like a lot of retail traders, are the ones that get stuck in penny stocks because their accounts are small, right? So they want to believe it's real, so that, because if penny stock markets are scams, then what does that mean for retail traders? It means that they need 25K or more to day trade, right? And they don't have that, so they desperately want to believe that you can do that in penny stocks. But again, mostly it's just retail traders getting hurt. When I first started trading, I had 30 wins from penny stocks wiped out by 3 losses. Then I came here. Hey, my guy. TOS is a good platform. IBR is a good one too. Interactive brokers is okay if you're into paying for commissions on stock platforms. Good for shorts. Like IB is good for shorts. All right, so again, very stagnant market. I think the whole market's waiting for Big Papa, Jerome Powell. All right, guys, Big Papa. All right, so we're going to do a poll on Twitter as well. If you want to vote on this poll, I appreciate it. We're going to make the poll 5 hours long. Yeah, that should be about right. Again, guys, do me a favor. Bump that like button up if you haven't already. Hit the notification bell. I appreciate the love and support, as always, guys. And again, maybe I'm wrong regarding penny stocks. It's possible. I don't think I am, but it's certainly possible that I am. Sorry for the Mortal Kombat music. All right, guys. Yeah, so we got the poll live. And if you want to vote on the poll. Yeah, I heard about the submarine. It's crazy. Mortal Kombat. That's basically what I think about. I think everybody that grew up in the 90s understands what I just did. This one too. It's a little bit too crazy. I'm getting these alerts. What are these alerts from? Bro, Carol sends me so much stuff. All right, so KB Patterson and Winnebago earnings are today as well. The president is set to host a guest. Noises have been detected in the hunt for the missing Titan submersible. A storied Bel Air estate could become America's priciest home. So Biden is set to host India's Modi. He met with Tesla CEO in New York and is expected to lead a yoga session at the UN. Interesting. So BTCX is now closing down. All right, guys. So again, NVIDIA bounced it up. SPY is mostly completely flat right now. Mostly completely flat. Yeah, it's all right. My timing was a little bit off. It's all good. Again, let's see what the market does today, guys. Again, we did our Twitter poll here. 100% of people think bullish reaction. Hey, my guy Jason, thank you. Or no, actually, so we got some votes. 40% think bullish reaction. 60% think bear reaction here. And I said it once again this morning, I'll say it again. At what point do AMC holders stop believing every freaking conspiracy theory that comes out regarding their stock? A new one comes out every day, mostly from people that are just trying to grow a following on social media. And so what do? Because they're trying to grow, they say the most ridiculous stuff. They say all these crazy conspiracy theories about AMC, and they're never turned out to be true. And they're just trying to grow a following. They're trying to get you, confirmation bias, setting it up is basically all they're doing. I think they have less than that, Chris, but I'm not 100% sure, dude. I can look up some more stuff. Dude, there's some funny ones, bro, but I feel bad. There's some hilarious videos, Titanic movie references and memes about it, but I seriously, genuinely feel for them. I hope they're found. Everybody sends some good prayers, thoughts, vibes their way. Again, Tesla's still holding at the volume weighted average price. So France did send in a rescue team. I mean, what's the irony of like a possible ship disaster happening as they're trying to look at a historical ship disaster? I keep hearing different things. Some say they have 4 days worth of oxygen. Did it cost 250,000? Did it really cost them 250K to get in that sub? So they were on a submarine to go view the Titanic. All right, guys. So again, the SPY is basically completely flat right now. You can see it's right at the previous closing price. We still got about 2 hours before Big Papa speaks. All right, so yeah, I genuinely hope they're found, though. Yeah. Unfortunate, but all right, team. All right, guys. Again, we got some pullbacks here happening. We get some pullbacks that are happening here. All right, team. Got almost 400 people. AI will solve the problem, maybe. Maybe. All right, guys. So we get the SPY pretty much flat. NVIDIA break it down a little bit today. We're gonna have to look at the heat map, but yeah, NVIDIA break it down some. Let me see if it'll let me log in. Bro. All right, guys, we're at 437. It's basically flat on the SPY. All right, so it wants to hold. Again, Jerome Powell, the market might be a little sideways here, guys. So it really might be a little bit sideways. Figure out how to. Again, so I'm looking at Tesla here. Tesla is starting to break under the volume weighted average price. Tesla is starting to break under the previous close level here. Hey, what's up, Sam? Up 25K today. Nice run up. Hey, good luck. No, I don't have any alerts yet. Nothing really came out over the last couple minutes here. And again, we got like we got like a bunch of alerts set waiting for them to show on the charts. So it'll alert me when it happens. But for currently, yeah, let me make sure we got the NASDAQ alert up here. NASDAQ on TradingView was acting a little iffy yesterday. So yeah, we haven't had any actual alerts. The NASDAQ alerts work really well too, just like the other ones. All right, guys. So again, we are breaking down to 437s on the SPY. All right, sorry, I'm trying to send money to there we go. All right, guys, again, market's starting to flush down under 437 right now, under 437. NVIDIA at 435.50s. Wait. All right, guys, bear with me. Almost finished here. Wiring money is a little bit time consuming. All right, now this is better. There we go. All right, guys, and again, let's see what happens with the market here. We'll see if Big Papa influences the market heavily. That's what the big thing is. Is what does Powell say? I mean, is he going to update us with different sentiment relative to the last Fed meeting? You know, we did stream the last one that was exactly like this. We did stream the last one. And so again, we'll see what happens. We did stream the last one, and again, last time I can't remember what happened. Let me go check. It was on March 7th was the last one. So March 7th is what it was. March 7th. And so I'm going to go back and look at the time in a second. Finally. So we did bounce up a little bit. Let me copy this confirmation code. Finally, I'm done. There we go. Again, we're bouncing up. NVIDIA break it down a little bit. Tesla's starting to get closer to that previous closing price, but we're still pretty flat on the day here, guys. So we're still pretty much neutral. He's going to pump crypto. I don't know, man. Somebody tell me if Tesla will fall. Nobody knows whether it will or not. Why is Tesla falling? I don't know, man. I'm done for the day. Hey, good luck. Bitcoin 30K this week. Yeah, it's pretty close. Bitcoin at 29K right now. We'll see how this meeting impacts everything is realistically what's going to happen. John, what factors trigger your alert? So I'm using Chart Prime. I'm using Chart Prime, and I'm using, again, what I'm specifically using for it. Again, I've showed people this a couple times. I've got multiple alerts set up on multiple different positions here. But what I'm using for these alerts is this. I am looking for a possible reversal down signal or reversal up signal mixed with a bearish or bullish engulfing candle. So you can kind of see an example of this. Here's the bullish engulfing candle and the reversal up signal happening within a 3-bar period of time. Nice bounce afterwards. Here's the same thing on the downside. Bearish engulfing and reversal down. Nice drops over like the next hour. So that's what I'm using for my trades. Again, it works really, really well. Yesterday, we made about $1,000 net from taking these type of positions. And again, I can't guarantee it's going to keep working. Of course, nobody can, but that's what I'm using right now. SPY starting to break down. We're at 437s right now, guys. 437s. Again, we're starting to break down. SPY at 436s here. Tesla at 275s. Yeah, I think so as well, man. I think, like, again, I'm not going to say I was a hater of Tesla, but I was a skeptic when Tesla was at $100. I thought the way Elon was acting on social media would be damaging to the company overall and bad for Tesla moving forward. I was wrong because, again, Tesla has flown up. And again, I'm not one that strays away from admitting I'm wrong. And I was definitely wrong. Again, I thought Tesla was sketchy at $100. Tesla now proven me wrong at 275, has continued to move up. And again, I do tend to agree when the Cybertruck is announced, when the Cybertruck comes out, it's going to break freaking records, bro. It's going to break records. And again, here's my argument for it. Regardless of whether people say they're ugly or whatever they want to say about the Cybertruck, here's my argument for why the Cybertruck announcement is going to break records. Okay. Teslas used to be a status symbol. And I've given this argument before. Teslas are to a certain extent a status symbol. You know, 2 years ago, if you saw a Tesla driving down the street, you'd, a Tesla. Look at that. Wow. Amazing. Right? At this modern time, that's less of a thing. Like they're so, I'm not going to say saturated, but you see so many Teslas now, it's not like a crazy thing. It's not like a status symbol like it was back in the day because everybody kind of has a Tesla at this point in time, right? And not everybody, but a lot of people have a Tesla. I think when the Cybertruck comes out, it looks different enough. It's a different design. So it looks different. It kind of looks like a Mars rover. To a certain extent, it's bulletproof. It can float on water. It's fast, and it has great towing capabilities. I think all of those things combined are going to make the Cybertruck break records when it finally comes out. I also think Elon has waited a long time for the Cybertruck. I think he's been saying they were going to come out for a while, building up hype. And so when they finally do drop, I do think they're going to break sales records. But again, maybe I'm wrong. Who knows? But I think that's probably the case. Why don't you use the updated version? Because I like the 5-minute one. I like the OG. I mean, it's not the updated. One's the Oracle Pro, which is for shorter term day trading, and one is the regular. I like using the regular one. Everybody has their own preferences. I just tend to prefer the regular one. You know, the regular one's my favorite one. But again, it's all very. I can set the alert for both of them for like a strong sell signal too. Let me see if I can. So I'll set the alert for both of them now here too. Let me create another alert. Only for strong buy or sell signals is what I'm going to create it for. Market Oracle Pro. But see, I don't actually see it. Okay, I got you. Okay, so you actually can change it. Okay, got you. But see, the problem is that like you can't. So crossing is one, crossing up. I'm gonna go moving down on a strong. See, the problem with this, I'll have to just watch it for that one. Yeah, that bulletproof incident is going to make it kind of tough. But still, I mean, I still think it's going to break records probably, you know. But it's arguable for sure. NASDAQ to 14,000. Again, I'm not telling anybody to buy anything, though. I have no idea what Tesla or anything's going to do. No idea what Tesla or anything's going to do here. So again, I'm certainly not telling you to buy it. I don't know what you should do there, but I think there's an argument for it. Again, do me a favor, hit that like button, guys. Hit the like button, hit the subscribe button. We appreciate it very much. Again, we got about 560 votes. 55% think that Big Papa is going to hurt the market. 45% think he's going to help the market here. All right, we got some votes here. Again, on Twitter, 48% think we're going to get a bullish reaction. 52% think we're going to get a bearish reaction here. So, we'll see. Again, we still got about an hour and 45 minutes until everything comes out. So I'm looking at the strong signals. The strong signals actually seem pretty cool. Strong. The only problem is finding I got to figure out a way to get the alert on this, on the SPY. Oracle Pro. See, I'm gonna have to change this to where it gives the strong signal. I'm trying to create it where it gives me both Market Oracle Pro, moving down, strong, one. All right, so we got both of these. See if they give me the actual alerts here, though. All right, market's still flushing down here, breaking down a little bit. What's up, Jamie? Hey, what's up, man? Should we cut Disney under 90? I mean, I don't want you guys to copy me at all, but I'm holding Disney long. Like Disney under 90 is very close to my average. My average right now is 90.70. And so we're nowhere near. Again, I'm not cutting Disney. I'm probably holding Disney indefinitely now. Like, I'm not going to get scared out of it. Like, most of the time, Disney's going to end up coming back. And it's gapping up today, too. So it's not close. Like, if Disney starts to break under like 85s, maybe I'll consider cutting it then. But again, I don't want you guys to copy me. I have no idea what it's going to do. Yeah, so no idea what it's going to do here. And again, not an investment professional. Not liable if you lose. Always make your own assessment. Trade responsibly. Again, guys, we got Big Papa at 10:30 or at 10 o'clock today, 10 a.m. Big Papa, Jerome Powell, the man, the GOAT. All right, guys, NVIDIA at 435s right now at 435s. Tesla's still trying to hold. We got it on a 5-minute chart. The SPY is still dumping down here, though. So the SPY is still dropping dramatically. We're still in KO, and KO is still doing all right. We're still in gold. The question is, do I hold? Gold is kind of like a longer-term hedge, though, is what I'm sitting in gold from. Again, SPY break it down. Is there an argument for a dip buy heading into this? I guess is the question. John, Disney is an excellent long-term hold. Yeah, I mean, I think it is as well. But, you know, again, it's subjective. Like, I will say this, that Disney is one of those stocks that whenever I buy it, I usually get a bunch of haters coming out the woodwork, mostly for political reasons. Like, some people just hate Disney. But every time I buy it, I get people hating on the trade. And then usually as Disney pumps up, it's just kind of crickets and silence. And so I'm not going to get scared out of Disney at $90. I think if I'm willing to hold this for a year plus, Disney's almost certainly going to be over this. Now, I might be wrong, and there's obviously a chance that it's not. But, you know, again, kind of the same thing. Like, I bought Target a couple days ago. And I ended up selling it very quickly for like a really nice profit. Like, I ended up buying Target. I can't remember where I bought it at. Let me see. So I bought Target. Let me put up my actual trades to see this. So I bought Target at 139.40s. Or no. I bought Target, I'm sorry, at 127.40s. I bought it at 127.40s. Very quickly, this thing popped all the way up to 140. And then I sold. You know, or actually, no. So I bought this at 127.40s and sold it at 132, basically. And again, I bought it right around the low when everybody else was telling me how weak and sketchy it is. That's when I choose to buy it up. And again, the fearful when others are greedy, greedy when others are fearful motto genuinely works most if you're looking at blue chip healthy companies. So it's like everybody counts these companies out, but sometimes there's just good value. My Q calls are wrecked again. What a surprise. Well, yeah, I mean, a lot of people, again, just remember, like, options are sketchy, guys. They really are. Like, options can be sketchy. You just got to be smart and like understand and take calculated risks. Yeah, Intel's been pushing up with AI. Yeah, so like AI, the stock AI has been on a huge run, but last couple days we're getting pullbacks here. Red a little bit on the day. NVIDIA, again, also pretty red on the day. SPY starting to break down some more at 436.50s. Is there an argument for a dip buy, I guess, here, guys? It's impressive how long you can stay focused on the market. I maybe do market open, but you must really be up to date. I mean, when you sit here talk and when you watch the market for at least 4 hours every day, you know, generally you're going to start to know about it and learn about it. it doesn't stop people from arguing with me, but like when you watch the market so much, eventually you start to kind of learn it. It becomes easier. Ow! I'm sorry, guys. There's the alerts triggering though. Make it freaking stop. What alerts? Okay, Apple and Tesla are alerts. Let's see what they are. So these are Apple and Tesla alerts. Let's see. Ouch. All right, so let's see how well these alerts work. Okay, we're gonna try that. Come on, Tesla. Big Papa Tesla Daddy. Help me work. All right, we're in 25 shares of Tesla here. Don't punish me, Tesla. Don't you do it. Apple as well. Apple's another one. Could y'all hear that? Was that loud? Yeah, okay, Chris, out my ear. Yeah, I feel you, bro. Again, I'm not telling you to buy. I have no idea if this is going to work. I'm not an investment professional, not liable. If you lose, have no idea. But I like the momentum into the trade, though. Let's look at Apple. See what Apple's trade looks like. Okay, I actually like Apple's a little bit more, actually, here. All right, so we're going to give it time to work. Okay, yeah, so sorry. I turned the alerts off. There you go. That's better now. And these are 5-minute patterns, and so it might take a little while for these to come to fruition, but these are 5-minute patterns. Again, I will say this. I think they're working. These patterns and strategies work the best on these patterns and strategies work the best on the SPY specifically more than anything else from my experience. Where did all my patterns go? No, not there. Bro, I got so many freaking monitors. Where did it go, dude? All right, so this is not going to cut out the stream. All right, there we go. I'm going to have to pull it back up. I'm just going to open this back up so I don't keep losing this on my main one. That's a smarter view. SPY. NASDAQ. Apple. Tesla. Looks like the NASDAQ is still kind of being iffy. I'm going to have to go with the, not the E-mini, but just the regular NASDAQ, the US 100. I do kind of like the Tesla one. It is right around the dynamic reactor. Let me exit out of this. Yeah. All right, nice little pop up on Tesla so far. I didn't really take big enough size, but that's okay. See how long it takes. Tesla's trying to bounce off of that previous closing price too, so we're in it. Nvidia's up there. We can look at the SPY. SPY getting a flush breakdown here, but I feel like Powell's going to shake the markets today. He don't like all the green that's going on. I don't know. I think he probably does like the green that's going on. I think you got to understand, if he could have ripped the Band-Aid off and combated inflation, but caused a little bit more market turmoil a long time ago. I don't think Powell necessarily wants bear action under his watch, although I do think he wants to combat inflation. But to a certain point, I think we have seen a lot of inflation reduction over the last 6 to 8 months. But again, it's arguable, of course, for sure. All right, Tesla, let's see a hold here. I heard rate hikes are bullish. What do you think? Rate hikes raise rates to combat inflation. Generally, they cause short-term pain in markets, again, the higher the rate hike, the more short-term pain they cause in markets. The more they push the market down, the more the dollar index goes up. But it varies, you know what I mean? I don't know, man. Yeah, honestly, somebody said look at the pro, and I think the pro is right. I think if you look at the strong signals on the pro, I think they can be powerful. John, did you notice today everything, global markets at their peak, crypto unusual high? Well, crypto's up because of some of the big boys, Citadel, BLK, and Schwab starting their own crypto exchange. That's causing bullish sentiment on crypto markets. All right, so I finally put some money into Moo. So question, if I want to day trade 0 days till expiry options, do I need a cash account to have the money settle, or does it allow me to use a margin account to buy and sell more than 3 times a week in 0 day till expiry options? Again, I'm not really sure here, but markets are inflation. My money doesn't buy a lot of stocks anymore or food. Well, yeah, but inflation has gone down dramatically over the last year. It's one of the reasons the Fed was more likely to skip or pause this cycle, is because inflation has gone down a little bit. You could see it mostly reflected in gas prices. So like if you look at gas, a year ago, gas was like $6, 5 something a gallon. At this point in time, it's like 3. Where I'm at, it's less than 2, or it's less than 3. It's like $2.80 a gallon. Again, Nvidia trying to bounce here. SPY still breaking down. We did buy the little Tesla dip. We'll see if it actually holds. How do I switch to a cash account though? All right, so we are green in Tesla here. We're going to give it some time to run. Again, these are 5-minute patterns. Yeah, I mean, generally dropping from roughly 9% down to 4%, I would say, is a pretty dramatic reduction, Shane. It might still be conventionally high, but that's not what I said. I said it dropped dramatically, which I think in terms of percentages, that's obviously true. I get it. People might want to make the market seem worse than it is for political bias and like other reasons. Maybe they think the market's going to crash or whatever it is. But like the reality of it is inflation has dropped dramatically over the last 6 months to a year. And again, let's look at, so the last Fed meeting happened on March 7th, right? March 7th was when the last Fed meeting was. Let's go back and look. A 90-day chart. It might be a little bit over that. Let's switch this. Yeah, but I'm obviously referencing global markets in the US, dude. So I mean, yeah, you could isolate one specific market overseas and say that that market is bad, but that's obviously not what we're talking about, man. We're talking about the US, dude. We're covering the US stock market, brother. And Jerome Powell, it's Jerome Powell. He's not relevant to the rest of the world, bro. I mean, he is, but not like we're talking about. We're obviously referencing the US. Let me look back and see what the last Fed meeting showed here. Let me edit this. Five-minute is what I want to edit. I want to give it 180 days on a 5-minute if it lets me. Yeah, it did. Good. There we go. 5 minutes. All right, let's go back and look at March 7th. March 7th is when the last House testimony was. All right, so here's March 7th. So again, you can see last time Powell spoke, the market did drop here. He spoke right here. So here's when Powell started speaking in this time frame right here. So this is when Powell started speaking. And you can see the last time we had dramatic drops basically for the rest of the day up until mid-afternoon. So basically very bearish response to the last again, Shane, it sounds like you just don't want to be wrong, bro. It sounds like you don't want to be wrong. Obviously, we're referencing CPI in the US, of course. You know, when I say most of you guys know I'm in Texas, so obviously I'm referencing the US. And then when I pull up the actual metrics of, hey, inflation dropped from almost 9% down to 4%, which is a very large percentage drop, then you all of a sudden zoom out and say, oh, I'm talking about the world. Again, what it really sounds like, brother, is that you just don't want to be wrong. And, you know, I think admitting you're wrong is healthy sometimes, guys. Again, I was wrong on Tesla. You know, I was wrong on Tesla. I thought Tesla looked sketchy at $100, but I don't think it's really arguable to say that inflation hasn't dropped. Inflation hasn't dropped dramatically over the last year in the US. Of course it has. It's dropped from almost 9% down to what, like 4%? And so, of course, it's a dramatic drop. And again, we can see it in gas prices. $6 a gallon over that a year ago. Now it's like $2.80 where I am. So, all right, so SPY got a quick little bounce here. Let's see if it's news related. I'm not going to hold this position too long. I do want to give this time to work, but I do have to think I got to be slow. In Houston, Lucid, look up Houston gas prices. Powell's not talking right now. Powell doesn't speak until 10 a.m. Okay, yeah, we got it ready. Waiting starts at 10 a.m. 86 minutes. So yeah, we got it waiting, ready and waiting here. Yeah, let's take out see what's being released currently. I don't think anything came out at 8:30. I might be wrong though. Let me make sure. Okay, we had Canadian retail sales drop. That could be what's moving the markets. We also had mortgage rates drop today. Mortgage rates came in at 6.73%, which is a little bit down relative to where they were. A little bit down relative to where they were. Powell speaking in like 90 minutes or so. But yeah, we had Canadian retail sales come out much higher than expected. Maybe that's moving the markets. I don't see anything else really influencing the markets super heavily here. We're scrolling. But yeah, this looks like okay. So yeah, Fed Powell says process of getting inflation back down to 2% has a long way to go. Reiterates nearly all FOMC participants expect will be appropriate to raise interest rates somewhat further by the end of the year. He said that the process of getting inflation back down to 2% is a long way to go. That's what he said. So again, that is the reason the market is dropping right now. I'm going to cut this Tesla trade because again, I think this kind of cancels the trade out. Like fundamentals trump technicals, of course, right? So like fundamentals are going to influence technicals and cancel out any big technical pattern that's there. And so I think with this fundamental data dropping, I have to cut that trade and just let it and just kind of wait. Powell's not speaking. And he did put out this right here. That is what's moving the markets right now. Yeah, so it's his policy statement released 4 minutes ago. Again, markets flushing. Basically, Powell signifying that there might be more rate hikes coming soon. Yeah, so basically they're expecting rate hikes. I'm such a sucker. This game is rigged. I can't believe I fell for the stock scam. D, it really depends on what you're considering a scam, bro. Again, what happens, brother? I'll tell you what happens. What leads people to have your mindset right now? What happens is like people buy like. There's a bunch of sketchy marketing acting like you can get rich. They act like you can take $5,000 and turn it into $1 million in like 2 months if you just buy their trading course. They act like penny stocks are good investments and that they can predict. Nobody knows what a freaking penny stock is going to do. Nobody does. But they act like you can buy and invest in penny stocks like they're Amazon, and they act like they're going to 1000x. Right. And they talk a bunch of retail naive traders into doing these things, paying for overpriced courses, trying to get rich quick in the stock market. And the market just doesn't work that way. And so most people end up just getting destroyed in terms of their account. They end up just losing so much money. What's not a scam, if you want to make money, research healthy blue chip companies or the S&P 500. You buy and you sit for years, almost guaranteed to make money that way. And that's statistically proven over a century. You research healthy blue chip companies, you diversify into many of them, or you just buy a broad market ETF or index fund, and you just kind of buy and you sit, right? Doing so, if you hold it for a minimum of 5 years, you are almost guaranteed to make money. Almost guaranteed to make money. The problem is that most new traders get sold a dream, a get rich quick scenario where they're just going to get rich and they're going to invest $1,000 and they're going to buy this trading course and they're just going to learn the secrets of the market. You know, and most of the time they just end up losing thousands of dollars and then saying this is rigged and quit. That's what generally happens most of the time. But again, what I do here is I just tell people the truth. D. And so if you want a place that's going to be honest with you, bro, subscribe, dude. Again, I tell people the truth. I've been telling people this for years and years. This is how it goes. Again, most traders are going to lose. Most day traders are certainly going to lose. The problem most traders face is that they trade way too large. Still, my best trades are swing trades, where I look for healthy blue chip companies like Apple, Amazon, Disney, Google, Walmart, and I wait and I look for long pullbacks on long-term charts, like on daily charts, on 3, 4, 5 month charts, on 15-minute charts. I look for long extended pullbacks. I buy the dip and I sit until they come back. That is very powerful. I'm green on the year in TOS, and I wouldn't be able to lie about that without getting in trouble. So I'm certainly not lying about that. But there's a lot of ways to make money in the markets, brother. You just got to get past the guru culture of the market, where basically new naive traders get talked into spending thousands of dollars on nonsense and just having completely unrealistic expectations. Yeah, all good, Jay. No worries, man. NVIDIA would make you rich? NVIDIA is probably a little extended at this point in time. Maybe it keeps running, but... yeah, again, I'll say it once, I'll say it again. The biggest long-term edge is... yeah, I trade with $50,000 D, not $5, bro. I trade with about $50K. Still, the biggest long-term edge you'll ever have in markets is blue chip investing. Buy blue chips, diversify, you sit. Again, you're almost guaranteed to make money. Again, it's something that a lot of people that don't have that much money don't understand the value of that, right? With compounding and blue chip value investing, you could make a lot of money in a 5-year period of time, 10-year period of time, a lot of money. You could become a millionaire within 10 years by doing so, but nobody wants to wait. Everybody wants quick profits. They want to get rich quick, and that causes them to take really risky, bad trades that just end up causing them to lose a bunch of money. Is it considered buying the top if you're putting money in 401k? It depends on what you're doing. Yeah, I mean, people make money, bro. Again, the big problem is simple. The problem most people face is, again, they try to get rich quick. They buy Tim Sykes or, stuff like that, penny stock guru course, or like options, bro. And like, they just try to get rich with very small sums of money, and like they lose it. And then they say, oh, it's rigged. It's like, nah, bro. Like, listen, if you can make 30% in a year, that is elite trading, right? But for whatever reason, a bunch of kids start marketing trading, and like now they're trying to make it sound like you can turn 20K into $1 million in 3 months easily if you just buy their course, guys. And again, it's just not like that. Like, again, if you can make 30%, you're elite. But nobody wants that, bro. Nobody wants it, dude. Everybody wants to instead just get rich quick and ride off into the sunset. And unfortunately, it's just not how it goes. All right, guys. Powell. We got Big Papa. Goat, the man. Let's see what happens here. Again, market started to bounce right at that previous closing price. Again, we'll see if it actually holds. Starting to bounce a little bit. Again, the SPY at 436.20s. I mean, you ask a kid out of high school, be rich at 30 or 60, you know what they were choosing. Yeah, but if the odds of getting rich at 30 are less than 1%, then it's a bad decision. Well, there's obviously manipulation. Again, that doesn't mean that it's not possible to make good money in the market. Um, Again, most of the time, the people that are crying about the market being rigged or are trading way too large of size. They are buying up sketchy, terrible companies and penny stocks or mid caps. They're buying up stuff like Mullen, and they're wondering why they're losing money, or they're buying up stuff that are just total crap stocks. They're buying Peloton or BYND, and they're wondering why they're losing money. And again, I understand people wanting to get rich in markets, but like you gotta think about it objectively and just try to be reasonable, because most of the time the reason people are really losing money is because of they're buying up crap trying to get rich. Yeah, if the get rich quick scam worked, the big boys, like if penny stocks actually worked, you'd see the big boys like JP Morgan and all these guys buying up these penny stocks. The reason you don't see them penny stocks in their portfolio, unless they're insiders in the company, are because it doesn't work. Again, you want to know what works? Follow what big money does. What big money does is buy, sit, diversify, compound, and they let their money work in that way. That's what they do. John did Roblox. Yeah, we're gonna stream the full Powell speech, the whole thing. Because the time frame is different, Derek. Why does the moving average line move depending on what chart interval you're looking at? Because the time frame is different, so it's using different coordinates. And again, another big problem, guys, is that like a lot of bears try to, like, again, ever since the Big Short came out, everybody wants to be Michael Burry. A bunch of Michael Burry clones come out trying to predict the next stock market crash. But again, they're misunderstanding the true state of the market, which is that like long-term blue chips in the S&P 500 and other broad market ETFs are going to go up long-term. The S&P and NASDAQ and the Dow, they're all down over the last few years. You know, like, yes, we're green over the last year period, but over a 2-year period, they're still down. And so in that regard, like the biggest edge you're ever going to have is that those things are going to move up long term. Yet everybody watches The Big Short and they want to be Michael Burry, and they start over betting on crashes, and they act like the market has to do something. The only thing the market is going to do statistically is the market and blue chips are going to go up long term. Again, they're going to give you 6 to 12% a year, and that includes crash statistics. And so what that means is that when the market is not crashing, it's going to go up much more than 6% in a year. On a good year, the market's going to go up much more than 6%, because again, the tendency of the market is to give you 6 to 12% on average, but that is the average there includes the crashes that happen. So again, on a good year, the market's going to go up 20% or more sometimes. And that's the most profound edge the market gives you. Yet everybody wants to bet long-term against blue chips on the upside. It's the dumbest bet you could ever make. Like, you're betting against the biggest, most profound statistical edge the market gives you. And again, a lot of people just lose money betting on the bear side, trying to bet down on the downside long term. And I just don't understand it. Again, it doesn't make sense. If you look at statistics, it doesn't make sense. Yeah, money makes money for sure, Jamie. That's another truth. Your thoughts on PayPal? I think PayPal might have some extension on the downside, but I also think there's an argument against PayPal long term because of potential obsolescence. I think crypto might replace the need for PayPal. I think especially with like the Fednow coming out pretty soon. I think that's a risk for PayPal. So I really have no idea what PayPal is going to do. I think there could be an extension argument, but I also understand that. Yeah, I'm going to go ahead and buy Tesla again here. It might be risky, but it's okay. We did bounce right off that previous closing price. But yeah, that's the only again, I made money on PayPal when it dipped down. I think it dipped under 50s, but I ended up selling because I don't really trust PayPal long term. So the last time I bought PayPal, I ended up buying PayPal and averaging in starting. Here, bear with me, guys. Okay, so yeah, I ended up buying PayPal at about $59.50. So I averaged into PayPal from 70s down to 60s. I made my last ad at about $60, and then I ended up selling it at around 65 for profit. But I cut it. It's now at almost 70. But again, I'm not in it anymore. I don't trust it long term because of stuff. Why are we dropping? Most likely because the market's up so much already, over the last, again, the market's not crashing right now at all. If you look at a 20-day chart and you zoom out, brother, the market is incredibly green over the last 20 days. You look at a longer term chart, it's even more green over the last couple months here. And so the market's not going to go up forever. The long-term state of the market is this. It's a stair step. And with that, pullbacks happen. It's not just going to go like this. If it did, it'd be too easy to make money. It's a stair step. It's up, down, up, down, up, down, up, down. But that's why you get trends that look like that. And again, a lot of the time they work, but any period of time we could have a bear market or a bull market. But again, the biggest statistical edge, you put in a weekly chart, this is the biggest statistical edge you ever have, is that generally long-term markets are going to go up. Now, you're going to get crashes. And again, like I said, over the last few years, since the beginning of 2022, late 21, early 2022, we're red. The market has been dropping. We're only recently starting to come back here. So the market had been dropping all the way to October of last year, where we started to go on a little bit more of a bull run. And we've been on that bull run since then. And we've basically just been going straight up since then. So a pullback could happen from extension. But again, generally, the long-term state of the market is going to be up. I went to Cane's last night, bro. Cane's makes me sick, dude. I don't know what it is. But Cane's makes me sick. Every time I eat Cane's, I get sick. Donuts and Cane's. There's something about how they cook their food that makes me sick. I don't know what it is. Yeah, for sure, Tobias. SoFi is a small, it's not the biggest company, and so I'm skeptical of it. I think AI might help it, of course, with all the stuff going on in tech and AI. But again, the long-term chart's really rough. It's dropped from basically $30 in 2021 to $8 now. So it's just a bad long-term trend. It's one of the reasons I don't really invest in mid-cap companies. I think mid-caps are the riskiest companies you can get involved with, because a lot of people invest in mid-caps like they're blue chips, but they're not. And so a mid-cap can lose 70% in a year and then become obsolete or lose all of its hype and then just get destroyed and get delisted and fail, and everybody can lose everything they invested in them. Now, they're higher risk, high reward. So sometimes when mid-caps do succeed, you're going to make a lot from them. But because of that, in that regard, you need to take trades on them, understanding you might lose everything you're investing into these companies. And with that, scale down your size when you do put money in them, because again, there's a big chance they'll drop big percentages short-term or long-term. And again, it's one of the reasons I mostly just stick to blue chips. I'm not trying to pick the next big hot thing and get rich. I'm trying to ride the curtails of stocks that are already proven over long periods of time, like Apple, Disney, Amazon, Google, Tesla to a certain extent, Nvidia, stuff like that. That's what I'm trying to make my money on over BYND or Peloton or SoFi or something that's just not going to be, it's not a guarantee to be successful long term. Not as much of a guarantee. Nothing's guaranteed, but probabilities are very high in Apple's favor long-term, and Disney's favor, and Google's favor, and Amazon's favor. And so those are the companies that I choose to put my money in over speculative mid caps and penny stocks. Plug is too low, small cap for me. Yeah, Powell's talks in about an hour. You need to be more clever to be a successful bear than a blue-eyed bull. But yeah, isn't that just a different way to say it's harder to be bearish? And so if it's harder, why wouldn't you go with the easy route? Why take something that's noticeably more difficult than the upside? No, I'm talking about Cane's chicken. Yeah, for sure. That's just kind of how it goes, man. People get sold on a story and just lose money. All right, guys, we got Big Papa speaking in a couple minutes. Again, do me a favor, hit the like button, hit the subscribe button. Run these numbers up, guys. Big Papa Powell. Market opens in about 35 minutes. All right, Tesla rising back up a little bit here. We'll give it time. Someone has to be bearish at some point. You couldn't buy if someone isn't selling. True. But I think there's a difference between selling because you're worried and shorting because you're bearish. You know, selling is gonna happen. If you buy, you got to sell eventually. You know, now when you choose to sell doesn't mean you're bearish. It just means you're skeptical. Shorting, I would say, is more of a bearish activity, but my name is John. What's up, Trader Mike? Is the market gonna tank in Roblox too? I don't know. Yeah, I mean, it depends. Like, if you got $500,000, just put that money in dividends. You could live for the rest of your life off of dividend investing for the most part with around $1 million. And so you can just kind of put that money in, sit. It'll probably appreciate over time, and you'll get dividend payments. That'll be at least 30,000, usually, not always, but thoughts on cryptocurrency? I don't know what to think about crypto right now. I know we got a lot of, I know Schwab, BLK, and the Citadel announced they're opening up their own crypto exchange. We got the Fednow coming out pretty soon too. So there's just a lot of potential stuff going on in crypto that might influence everything. But again, we will see. All right, guys, we still got about an hour before Big Papa speaks. It depends on if you own your stuff, Lucid. If you own a home and your home is reasonable, you could probably live off of 30K. You go work it, you know, a part-time job and make that back if you really want to. Because smart people like to prove they are smarter. Yeah, but no offense, Mads, that's a ridiculous statement. So you're telling me that smart people intentionally take the less edge approach in trading just to prove people how smart they are, brother? Think about what you just said, sir. You know, if that's really what you think, I don't know how smart you are. No offense. I'm not saying you're not smart, but like if that's really why you're on the short side, is because you want to prove how smart you are by taking the lesser edge trading approach. Yeah, I think smart people are going to go with the biggest edge they find versus trying to take the lesser edge approach to show people how smart they are. You know, I don't know, man. That doesn't add up to me, sir. Yeah, bulls are future sellers for sure. Smart people like that. I've heard different numbers. I've heard it was 20K. I've heard it was 250K. I've heard it was much more than that. I don't know how much that submarine ship costs. I do know it was a bad investment, though. What are your thoughts on the indexes? I think most broad market ETFs and indexes are up dramatically short term. You know, or midterm to short term, and so I think a lot of them are probably a little extended on the upside and primed to pull back some. But again, I really have no idea. Tesla started to bounce back up again. We did rebuy Tesla there. Oh, I definitely find it. I'm a much better swing trader than I am a day trader, like without question. My swing trades are much better than my day trades. Again, my swing trading strategy works too. I mean, I'm green on the year doing it, and it tends to work really nicely. Again, what it entails is I look for blue chip healthy companies. I look for big bearish action, either like whether it's multiple, you know, red days, red weeks, red months in a row, depends on the time frame. I look for blue chip healthy companies to drop dramatically over a period of time, and then I buy up the dips, and then just kind of sit and park my money in them for, you know, anywhere between weeks to months to years, depending on the stock. But it's only blue chips. It's not mid caps or penny stocks, because those actually have a no edge long term in those companies for the most part. And so it's only blue chip healthy companies, and I just kind of sit and park my money. Yeah, Mads never responded. I mean, I get it too. I wouldn't respond to that either. You know? But it's all good here. I'm just kind of messing around. I mean, I think what I said was obviously true, which is that like smart people take the biggest edge they can. They don't trade the lower edge setups just to prove how smart they are. And I think when you really think about that, it's, you know, it's very clear that doesn't make sense. But hey, Tesla going back up now. Yeah. So again, I'm sitting in Tesla right now currently. We got less than 30 minutes before the market opens. Will Powell's speech have a positive or negative impact on gold? I don't know. All I can do is look at the history of Powell's speeches. The last time he spoke, it dropped the market. Yeah, so the last time he spoke, he dropped the market, but whether he's going to keep dropping the market, I don't know today. Again, this is much different than last time. I think we've seen noticeable improvements. The question now is whether they raise rates aggressively moving forward for multiple different cycles. I think we'll at least do one rate hike this year, probably the next Fed meeting. But the question after that is, do we raise rates more after that, or do we continue to pause or skip the rate hikes? And I don't know. What do you guys think? Will he help or hurt the market? Vote on the poll. We did do a poll here live like we always do. So we did do a poll. Right now we got about 900 votes. 56% think he's going to hurt the market. 44% think he's going to help the market. And again, I really don't know here. I'm just kind of trying to be patient. Powell put out that statement at 8:30. So it's his policy statement. He put it out at 8:30. Again, the SPY's still dipping down though, so the market is dropping now some. Again, about 25 minutes until the market opens. We're gonna get ready to trade some futures too into the opening bell here. I'm gonna put Tesla up here at the top. There's Tesla. Here is the SPY. We're gonna get some futures trading up. Again, we did make some money in futures yesterday. So we did make some money in futures yesterday. We made about, I think we made like $1,000 or so trading futures. So we will get ready here. Tesla's starting a new consecutive update streak. It should be longer than or equal to the last one. So Tesla's close to break even now, though, is the only thing. So Tesla's pretty flat on the day, actually, currently. I mean, it's green relative to the last, 10, 15 minutes, but it's still pretty close to the previous closing price. And the SPY is dipping down, so the market is dropping now, too. You can see the SPY testing lows. Thoughts on AT&T? I think there's risk. And I think there's risks in the phone carrier specifically, as well as Comcast and other, and like Verizon and AT&T. Where I think there are risks is, I think over the last 30 years, cable companies have had a monopoly over TV. Like if you want any good TV service, you have to go with Comcast or AT&T or DirecTV or Verizon, right? To have any type of reasonable TV experience, immersive TV experience, I'll say, you had to have those companies. Now, over the last 5 years, you've seen the rise of streaming services that allow you to stream basically the same thing that Comcast used to give you, the same thing that AT&T used to give you, for noticeably less with no contract, right? So you can spend $70 a month and get everything Comcast has to offer you with no contract. Where if you try to pay for the same thing with Comcast or AT&T or DirecTV or Verizon, you're going to be spending hundreds of dollars a month usually. And so in that regard, I think the trends now is like I can have Netflix, Amazon Prime, and Hulu TV and have more TV than I would get with just Comcast. It's going to be no contract based and it's going to be cheaper. And I think that is a profound thing that's going to negatively impact the phone carriers, the cable companies like Comcast, AT&T, and DirecTV. I think their margins, they're still going to have options because they're going with like no contract routes as well. But where it's going to affect them is their margins, right? I think their margins are going to be obviously affected by that. And I think that's bad for them, over the next few years, at least while we see the corrections in that. But I still think they'll be around, but I just think they'll be a little bit less profitable. Powell speaks at 10 a.m. Yeah, we'll be playing the full thing live. I'll put this up on screen. Guys, again, hit that like button. Again, Powell will be streamed live here at 10 a.m. We will stream the full testimony in its entirety. Subscribe if you haven't yet, guys. We appreciate it. Will this help or hurt the markets, guys? I guess it's the big question. Again, we did a couple polls here. Markets are looking weak currently. Help or hurt the market? Okay, we got about 1,000 votes. 44% think help. 56% think it's going to hurt the markets. I don't know. I really don't know what we're going to get here. We did a Twitter poll as well. 44%, 56% bull bear. And I'm pretty sure YouTube's pretty similar. Man, wow. So what's interesting is that the sentiment is all pretty similar here. So on YouTube, again, we got about 1,000 votes. 43% think it's going to help the market. 57% think it's going to hurt the market. On Twitter, 44% think it's going to we're going to get a bull reaction. 56% think a bear reaction. So very similar numbers here. Very similar numbers. It looks like most people think we're going to get a negative reaction. And again, that's kind of what we got last time for the Powell thing. Like that's exactly what we got last time. Is we got a bearish response to Powell, unfortunately. So again, we'll see what happens. We're going to day trade at the opening bell, and then 30 minutes after the open is when the Powell testimony starts. 30 minutes after the open. We got about 45 minutes left. So stay safe, guys. Let's do some good today. Let's make some money. Yesterday we did pretty well. All right, so we did get a little bounce. We're pretty, we bought a little bit of Apple too. We're kind of flat in that trade. Do y'all think they'll find the submarine intact with everybody still alive? I guess is the question that we have to ask today. With the big submarine news, do y'all think they'll find it? Again, SPY dipping down a little bit here. So SPY still dropping. We've been in this little sideways consolidation action here for a minute, though. Yeah, but I think that didn't France release a vessel to try to help them find it? Yeah, the ocean is huge, man. A lot of people don't realize how big it is. So again, we've mostly been sideways for the last few minutes here. For the last, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 minutes, the market's mostly been sideways, slightly downward trend here. We got 15 minutes until the opening bell. 15 minutes, guys. Yes, but best case, if they find it, hope to be able to nudge it, I guess, and then it be able to navigate itself to the top. Yeah, for sure. It's going to be a tough road moving forward. Hooked on phonics. The GOAT. Reading Rainbow, the other goat. Did Neil deGrasse Tyson have a show historically? Like an old TV show? I felt like he did. I always thought he was the Reading Rainbow guy, but I guess he's not. Maybe I was just wrong. Everybody knows Reading Rainbow. The Magic School Bus, bro. My kids were watching the Magic School Bus the other day. And I was like, hey, I used to watch this show when I was a kid. And they were like, no, you didn't. And I was like, bro, they were like, this show's just new. And I was like, dude, y'all don't even know culture. Y'all better study up on Magic School Bus. She had Cosmos, got you. I might buy back into Disney. Yeah, we bought into a little bit of Disney here. It's dipping enough for me to see long-term value here, but it's long-term. Again, what happens a lot of the time is like people, again, I tell people not to copy me because I genuinely don't want people to copy me. Like, do not copy me in these trades, guys. Do not copy me. I have no idea what I'm talking about. I might be wildly wrong about everything I say. All right. But I say this, and yet people still copy me in these trades. Like, they'll hear me say, oh, I'm buying Disney, and then they'll try to piggyback off of it or whatever. But these trades are long-term trades, unless it goes up to like 95 short-term. If it goes up to 95 short-term, I'll still probably take profit. But outside of that, I'm probably just going to sit on this long-term. So even if it drops 50 cents, $1 a share, it's not enough to get me to sell. I'm probably just going to stay in it. T-Mobile streaming out the door. Yeah, but again, those companies are going to lose margins. Cosmos, I've never seen Cosmos. I'm looking it up now, though, but I've never seen it. I do recognize his voice from that. All right, market's testing lows again, guys. Still testing lows here. 12 minutes before the market opens, guys. 12 minutes. Yeah, I mean, the market is slightly down today, but again, people got to understand the market has been surging up for weeks and weeks now. I mean, a red day is not a surprise eventually. So like eventually the markets are going to pull back some. Well, JP, it's the semi-annual monetary policy report to Congress, FOO. And so today's the House, tomorrow's the Senate. They're just going to talk about the economy, what the plans are. He's going to be interviewed. And so that's what today is. It's the semi-annual monetary policy report to Congress. So yeah, they're just going to talk about what's going on. It'll probably influence the markets at least some, though, and something to pay attention to. I might cut Tesla here. I'm trying to be patient with it, but let me look at what my actual chart shows. I guess I'll let it hold at the previous closing price if it wants to. SPY's starting to move back up, though. Again, you can kind of see the SPY dip down here. You can see Tesla down here as well. Still got some time, though, here, team. Yeah, but I'm not buying Tesla for a swing trade even. This is just a day trade, and I'll cut it if it breaks under the previous closing price. I get it. People might have like a long-term bearish view, but this is not a long-term trade for Tesla. Disney trades longer term. I'll hold Disney longer term, but that's not really big tech. Tesla trade, I'll cut it pretty quickly. If feds are aggressive on rates, banks, crypto fly. If banks generally like the more aggressive the rate hike short term, the more stock market pain that there's there. If banks are weak, though, a lot of the time crypto benefits from it. So it just depends. Like, it really depends on a lot of different things. Like, a lot of different things are going to influence what crypto does. It's definitely more nuanced than just broad stock market reaction. Now, when the banks were struggling, crypto was doing well because people were less confident in banking, and that made them more confident in crypto. And that's a correlation that tends to be there. But whether it's predictable or not in terms of like if rate hikes are going to affect banks and then those banks are going to affect crypto, I think the biggest chance of volatility short term, guys, I think the biggest thing to watch for in terms of volatility short term over the next 2 months is what I mean by this. I think the most important thing to watch for is like over the last month, AI has been crazy. So AI has been influencing obviously the stock market in a dramatic way over the last month or over the last like 4 months, realistically. AI has influenced the market a lot. Now, with that, there's a lot of companies that people are considering to be extended. I'm going to go ahead and cut Tesla here and just kind of wait. We'll sit back and wait now. But there's a lot of companies that people are considering extended at this point in time. Like, there's a lot of companies that people say are extended now. Some of these include NVIDIA, AMD, MU, AI. There's a lot of high PE ratio companies currently. Now, what the PE ratio is, and this is what they're always using as their argument on the bear side, is they're saying the PE ratio is high, the PE ratio is high, and it absolutely is right now. But where we're going to see if this actually sticks is the PE ratio's price over earnings, right? It's the price over earnings ratio. When earnings season starts next month in July, in mid-July, we get earnings. We get earnings for Tesla, Microsoft. A lot of big names drop earnings next month. We're going to see whether AI is actually like improving these companies' bottom line enough to justify the big run-ups. That is where, like, if companies still come in low for earnings, that is where we could see a massive correction. Because again, what the public, I think, the psychology of this and what the public is going to, the way the public is going to interpret this is they're going to say, okay, well, AMD is up a lot. The PE ratio is 500 plus. Are earnings going to show improvement in profits from AI to justify these high PE ratios? And if they don't, that is where we could see some big corrections in tech, in my opinion. But it's going to be next month during earnings season. That's when we're really going to see if AI is compensating enough in terms of profit to justify the high valuations that these companies now have. That is going to be the big thing. Now, I still think we got to give it at least a couple quarters before we're really going to see big effects in terms of profit. But I think that's the biggest thing to watch for, is whether next earnings cycle, which is, again, next month in July, is going to influence these AI stocks to correct some. But again, let me know what you guys think. Let me know if you guys think this is good or not. Or let me know if you think that's going to happen or not. What do you guys think? Again, Tesla down at 274. So Tesla bounced up a little bit, but we ended up cutting it. And again, we'll wait until the opening bell. The opening bell's in 6 minutes. Again, there's an argument for a sideways price action today based off of extension and everything because of there's an argument in terms of extension here. All right, so I am scalping. I just scalped about $50 from the NASDAQ. About 45 bucks. We got the upward signal here from Chart Prime, and it worked really nicely. We got a nice little pop. Tesla too, but again, I think I'm just going to give up on Tesla. Again, I'm mostly taking these trades. Let me add the alerts here. I don't think these alerts are necessarily working. Possible reversal up. We got it on everything. Create for the NASDAQ. Possible reversal down. Again, I like the regular reversal signals. All right, guys. Market started to bounce back ahead of the opening bell. We got about 4 minutes left. 4 minutes. Yeah, but 10% a week is an incredibly unrealistic profit target, Mads. If anybody could make 10% in a week, they'd be the richest person in the world within 5 years, bro. Like, it's not feasible. 10% a week? If anybody can make 40+% in a month, more than that, it'd be about 43% in a month. But if anybody can make 40% plus in a month, they'd be the richest person in the world in 5 years. Again, markets are kind of flat. Again, we might get sideways volatility leading into Big Papa Jerome Powell speaking. And again, we are going to be day trading on a funded account program today on Top Step. Top Step is a funded account program for futures. They give you a demo. They test your skill. If you can hit the targets on the demo while following their rules, they fund you between 50K up to 150K with a 90% split. And so it really is the best of both worlds. They give you a demo and they test your skill. And the futures market has no PDT rule. And so these funded account programs are allowed on there, and there's no PDT rule. And so they give you a demo, they test your skill. If you lose, which most people are going to lose because most day traders lose money, but if you lose, it's limited risk. You're only down 130 something if you use my link. If you pass it, you still keep 90% of your profit moving forward. And so it's a great way to get your feet wet without taking on a lot of risk and still have a lot of the benefits, specifically 90% profit split. And you get to keep up to 10K of your first withdrawal money if you get funded as well. And so there's a lot of reasons to try this out. They are a sponsor of mine. But just taking the challenge genuinely builds your skill, in my opinion. If you want to check it out, here is the link. We got the opening bell soon. Guys, opening bell soon. I'll put the link up in the description as well, up in chat. Have at it, go big, swing for the fences. Don't let anyone rain on your parade. Yeah, make 1,000% every day, you guys. You know, if you believe enough, you can do it, guys. Make 1,000%. Like, come on, we could be all motivational. Like, you could do anything you put your mind to. No, you can't, bro. Like, that's one of the most ridiculous statements. You can do anything you put your mind to. No, you can't. Okay? I can't fly out this window like the Matrix guy if I wanted to. All right? What a ridiculous argument. I don't know why we even tell people that. Again, my daughter is like 5 feet tall. Okay? And she's basically done growing right now. So she's not going to be an incredibly tall kid. All right, she's not going to play for the WNBA. Let's just be honest here for a second. I think it's okay to give I think it's okay to give out reasonable expectations for things. You know, Powell's speech is going to be right here. It starts in about 30 minutes. Yeah, well, what happens in trading a lot? Here's the opening bell, guys. We got about 20 seconds. What happens in trading a lot is, like, you'll get a trader that makes 10% one time in a week by gambling, making really risky trades. They'll make 10% one specific week by mostly gambling, right? Then the next thing you know, a week later, they might have been trading for a month and just kind of gambled to get that 10%. Next thing you know, all of a sudden, they're coming out with their own course and mentorship program. They're telling everybody they're making 10% weekly every week, and they've done it one time. That's what happens. Here's the opening bell, guys. There's the opening bell. Let's see how everything acts. Tesla is consolidating here. We'll see if it actually holds. We are starting to get drops in markets. We are getting dips in markets now. Tesla's still moving up, though. The SPY is moving down, though. So the SPY is dipping.
Apple did end up surging up. That's nice. See if it actually holds now, though. All right, market's starting to flush dramatically now. Nice. Apple surging up. I'm going to go ahead and take half off there and just let the rest ride. Big bear action, guys. Big bear action in stocks. Big red dips. Right, Hassan. That's how it goes, dude. Yeah, I mean, what happens, though, most of the time, like, people like to brag about showing their broker statements. But, like, listen, man, if somebody's actually, like, legitimately profitable, they're going to show you their broker statement every freaking month. They're going to show you their statement. They're going to say, hey, because if you're selling a course, why not show everybody your broker statement every month to show them how much you're making, right? And so if you see somebody show you their broker statement one time, what does that mean? That means that was probably the 1 month they were profitable. Because if they were really selling a course and they really are that profitable, they'd show you it every month. Think about how much credibility building that would cause, you know? All right, so Apple, man, chart prime, bro. I'm impressed with this. Chart prime worked. I'm going to go ahead and sell my Apple trade. Tesla would have worked too if I would have held on to it. But again, Apple was the one where multiple showed up together at once. We had engulfing candles. We had the reversal signal and engulfing candles. And so we popped up really nicely. Tesla's starting to head back up too. The market's trying to bounce here. Part of me is still pretty bearish though. All right, so we are starting to move up a little bit. Tesla up to 277. I should have held it. What's happening with the dollar? I'm assuming the dollar is up some today based off of what the market is doing. No, again, I'm not sure. I'm not 100% sure, but I'm assuming the Dixie is going to be up today. It's flat. It's slightly green. It is a green day for the Dixie, but my job is to protect traders, Anthony, so I'm going to say it a bunch of times over and over again. All right, so Apple's still surging up here. Again, I don't know whether I should take profit yet, but we're over the previous closing price. That's good. Yeah, Powell might be just really volatile with everything, though, is the only thing. Checking on things. Nice. Tesla's starting to consolidate and come back down a little bit. I'm going to take a little bit more off on Apple because I can. I'm up enough already in it. There we go. Took a little bit more off. Going to let the rest ride since I can. Dollar index is still surging up. The SPY is pretty flat here. You can see the E-mini right now. What's the NASDAQ doing? Is the NASDAQ doing anything? NASDAQ's just as flat. Let me put the VWAP up here. There's the VWAP. Where's the EMA? I want the EMA up too. There it is. I want the 200 EMA is my favorite one. There you go. All right, so we are starting a bear breakdown here. Starting to look weak. John, you're starting to become bearish when I'm going bullish after the last few months. Maybe I should follow you on this. Hey, I appreciate you admitting I've been right, man. Again, 6 to 8 months ago, I had a lot of bears mad at me. But anybody that's watched my stream long term knows how right I've been about what the market has done over the last 6 months to a year. And so I appreciate you saying that. Most people are afraid to admit they've been wrong, and so they kind of just argue with me indefinitely. But I appreciate that, Derek. Thank you, man. Apple's still surging here. We got a little bit of a downwick coming in too. Dollar index starting to drop. I don't know what the Dow is going to close at. Yeah, I had a lot of people in here telling me the market was going to crash in October, November, December. All right, there goes the NASDAQ popping up. There's the market bouncing back up too. Apple started to test the highs up there too. We're still kind of just waiting for this range to break in a lot of this stuff. We've got alerts up that we're waiting for here and everything too. But Tesla would have worked, I think, if I would have held it. I'm still getting used to trading a 5-minute chart is what it is. All right, guys, Powell starts in about 23 minutes. 23 minutes. All right, we're consolidating here, guys. We'll see if we get a bounce. Again, hit the like button. Do me a favor, hit the like button. Now, Powell speaks in about 22 minutes. You can see the timer in the top left. Market's mostly flat, though, leading into this, and that might be kind of the nature of the market today is sideways. All right, market's starting to really be sideways here over the last few minutes. Powell's big surprise is we all get ice cream sandwiches. I'm not really an ice cream sandwich type of guy, you know. All right, market's starting to break lows here. Lows of market hours, at least. All right, so market started to break lows. We still got about 20 minutes before the market comes out. Apple's still pushing up, testing highs here. And again, one of the reasons I think one of the reasons Chart Prime is just powerful, man, is look at Apple here. So Chart Prime gave multiple signals showing this latest Apple run, and I did buy it. And so again, my big edge is when multiple things show up together at once. And so here's the reversal down in the bullish engulfing candle, and there's a strong buy signal here. And then look at the huge pop we get. So we did ride Apple up this way. Again, Tesla would have worked as well. But again, I like finding them when the reversal down in the bullish engulfing candle, when they all show up together at once, you get this nice little pop here. Again, what I've found is when the reversal up in an engulfing candle, when a reversal signal and an engulfing candle show up together, there's usually a really strong move coincided with that. And again, I like using it on the SPY, but in this situation, it worked on Apple. Again, this is a company called Chart Prime. It's $35 a month, so they're very cheap. And again, this is shown to be really, really powerful. I can't guarantee you're going to make money, but for $35 a month, this is just a small piece of what they offer. And again, if you look back on the SPY yesterday, we did this on the SPY yesterday, and it has been really, really powerful. So again, we made about $1,000 yesterday trading off of these only. Because again, look, bullish engulfing candle, reversal up, huge bounce. Reversal down, bearish engulfing candle, huge drop. And with that said, there's the Tesla alert at the same thing. I got to make sure I turn these signals off. Sorry, I know this is loud. My apologies, guys. There we go. But again, this chart prime, 35 bucks a month, powerful for me so far. I'll have to look at Tesla to see if I want to take the trade. I also got to make sure these are muted during the actual conference, though. That's the only worry, is that I got to make sure these are muted during the actual conference. But again, I'll put these up if you want to check them out. Here's chart prime link. Yeah, you probably have to have a paid TradingView membership. But again, I think that's a good deal regardless of it. I mean, Tesla does have an argument here, I think. But again, I think I'm going to wait. How do I turn these alerts off is the question. Starting to get a little bounce. How do I mute everything? Anybody know how to mute alerts on all right. I'm gonna have to mute this alerts. All right, I'm gonna have to go back and cancel these alerts. Hold on. I probably could just sign out of TradingView, right? Yeah, all right, so market's starting to flush back down. Okay, gotcha. I'm pretty sure I could just sign out. Market's starting to flush down under these lows. Let me make sure I can sign out. All right, market's trying to bounce here. We're pretty flat and sideways, guys. No real edge. Again, Big Papa speaks in about 15 minutes. 15 minutes. So we still got some time today. Apple's still surging up nicely here. Okay, gotcha. All right, market's mostly flat here. I might start putting a 5-minute chart up. Tesla's quiet. All right, guys, Jerome Powell in 15 minutes. Again, 15 minutes, guys. All right, I think I could actually mute the alerts here. So I think I figured it out. I went to the search and stop all alerts. Yes. All right. I can start it again afterwards. All right, market's still consolidating here. I'm going to go ahead and cut the rest of my Apple trade. All right, we're bouncing up a little bit. Market's pretty flat and stagnant ahead of this report here, guys. We still got 15 minutes before Big Papa speaks. Again, we are waiting here for Big Papa to speak. We got it muted here, but we are waiting. Here, I'm gonna create the window for this now so people can see it. All right, so we're bouncing up a little bit here, guys. Looks like cutting Apple was the right move there. Mostly flat, stagnant action currently here. The E-mini moving up some, so we are bouncing back trend. It depends on what we think the market is going to do currently here, you know. NASDAQ just flushed down today. It's starting to bounce back a little bit. But, again, anything could happen during Powell's press conference. All right, so we just shorted a little bit more of the NASDAQ here. Ended up making on Top Step about 140 bucks. Sitting back, guys. Still got about 11 minutes here, 11 minutes. Yeah, the NASDAQ's giving us more volatility than the regular E-mini. I'm going to put the NASDAQ up. We just shorted a little bit on here. On the NASDAQ, is that it? There we go. So there's the NASDAQ. It depends on what we think. We're at the bottom range of the VWAP trend here. So you can see the bottom range of the volume weighted average price. And again, we are trading on Top Step today. You can see we're up 140. Yesterday, we made about 1,000. If you zoom out here, yesterday we made about 1,000, or we made about 1,200 gross. I think we made about 1,000 net. And so yesterday we did make some money. What this company is, it's a funded account program. Remember, the PDT rule restricts you from trading stocks. So you can't trade the SPY more than 3 times a week with a margin account. The reason futures are big and most pro traders trade futures is because there's no PDT rule. You can day trade short, buy market, buy bid, sell the ask. I can trade the SPY and what's called the E-mini, the NASDAQ, the Dow, currencies, a lot of currencies. So a lot of Forex traders should be trading futures. You can trade gold, silver. And so most pro day traders trade futures because the liquidity is better. There's no red tape with the PDT rule. And the cheapest way to get exposure to that is a funded account program. And Top Step is the most legit. It's been around for over 10 years. They pay out millions in actual withdrawals every year. They fund thousands of traders a year. And again, what they do is they give you a demo and they give you a profit target. If you can hit the profit target without hitting the max loss and following the rest of their rules and phases, then they fund you 50 grand up to 150K with a 90% split, and you can keep 10,000 of your first profit as well. And so it creates this situation where just taking the challenge builds your skill. Most people are going to fail these because most people lose in day trading, but it's a lot cheaper to lose a Top Step account. If you lose the base one, which is a 3-to-2 ratio, you got to make 3K without losing 2K. If you lose, it's only about 130 something bucks. And so your risk is small if you lose, but if you can pass it and you're good enough to pass it, you keep 90% of your profit, again, 10K or your first profit in terms of withdrawals. Now, again, they are a sponsor, so I'm biased in their favor, but I genuinely think this is good for traders. I think it teaches them to trade. There's less risk than putting the money up themselves, and a large majority of day traders lose, so limiting the risk you take is a good idea in these situations. So again, if you want to check them out, here is the link. All right, guys, 9 minutes here, 9 minutes. No options. Yeah, futures are dope. Yeah, if you're getting mad at me for doing one sponsored plug, just cry about it. You'll be okay. 271. So yeah, market's trying here. We got about 8 minutes left. 8 minutes. Again, we got about 8.5 minutes. Market's starting to flush here. Apple breaking down, SPY breaking down, but we're still in a pretty sideways, stagnant range. Again, a lot of people are waiting for the Jerome Powell press conference to start. That's when the big thing is going to start. And again, we have the Powell stream up right here, so we are just waiting for it to start. I will put this up right here. So again, we're waiting for it to start. Make sure we're caught up live. There we go. So again, we're sitting back waiting here. We'll see how this affects the market is really what I'm waiting for. I'll put this up. And what other stock would y'all rather have up on the screen when the Powell meeting starts? Would y'all rather have, we got the S&P right here, the NASDAQ. We can put the S&P up. I think the S&P is a little bit more relevant. So there is the S&P right here. What other stock would you rather have up? Zooming into the S&P. All right, guys, 7 minutes. All right, guys, here's the E-mini. E-mini is still in that range. We got the 200 EMA up there. Again, what other stock would you guys rather have up here? NASDAQ and Tesla. GNUS. Gold. We could put gold. We could put Bitcoin up. I heard Bitcoin's pumping up with all this stuff too. So Bitcoin is a good option. We can look at the S&P and Bitcoin. Bitcoin is surging up right now too. And so that might be a relevant thing. I'll try to put two charts up. I could put gold. I could put the dollar index up as well. Here's the S&P up at the top. And then I'll put 3 different charts up at the bottom here. I think that's a good move. So we could put... There we go. I think this works. So we got Tesla is a good option. We got Tesla as number 1. Tesla at the bottom. We got Bitcoin up to 29.5K. Gold. Gold currently at about 1,937 currently, 130,937. Tesla currently breaking lows, breaking down here. Again, I hope he says positive things, but this is one of those things where we really don't know what we're going to come in as. We don't know if we're going to be good, bad. We don't know if the market's going to go up, down, or sideways from this. We really just don't know. We're just going to kind of sit back and wait, I think, wait it out. Bitcoin's rising, though. Let me see if y'all can see all this. Yeah, that looks good. All right, good. Again, Tesla dipping. Yeah, I'm not going to put an obscure penny stock up on the chat, guys. Sorry. I'm going to also throw it in sub-only mode. If you haven't already, hit that sub button, hit the notification bell. We appreciate it. All right, gold is moving up. Bitcoin is moving up. The market is mostly down today, but the market's been surging up a lot over the last couple weeks. Still got about 5 minutes here, guys. About 5 minutes left. Again, we have the sub button. Hit the notification bell. Hey, announce yourself. Show us that you're subscribed. If you are a supportive member, hit that subscribe button. Show us that you're supportive of the channel, guys. We appreciate it. And let's see what he says. Again, do you think he'll say good things or bad things? Guys, let me know. What is Big Papa going to say? I'm not sure. Hey, yeah, hit the like button, guys. We appreciate it. I don't know why I just banned that Biggie, but sideways, bad. Can we do a new poll? Honestly, I think this is good. This poll is good. Does Jerome Powell help or hurt the market today at 10 a.m.? 43% think he's going to help. 57% think he's going to hurt the market. I think this is a good poll to have, honestly. Yeah, he'll definitely say that, Raz. He'll say inflation is still elevated. We are going to do what we can to bring inflation down to its 2% target over time. He's definitely going to say at least that. And remember, if you look up on screen, he did say this earlier. Where's my stream? There it is. So if you look at, he did say this earlier. He said the process of getting inflation back down to 2% has a long way to go. He reiterated nearly all FOMC participants expect it will be appropriate to raise rates somewhat further this year, is what he said. And so again, we'll see what happens. But that's what he said. Gold is popping up. Market's still breaking down a little bit. All right, guys, about 3 minutes left, a little bit less than 3 minutes. Also, guys, make sure you hit the play button next to the, make sure you hit the live button next to the play button to make sure you're fully caught up on stream. Your play button should look like this to make sure you're not delayed. Your play button should look like this. It should be red and say live right next to it. So again, it should be red and say live next to it. If it's not, you're back on the stream. Make sure you hit the play button, or make sure you hit the live button to make sure you're caught up. I had a dream crypto crashed and went to zero. It sounds like your dreams are wrong, bro. Sounds like you got a negative correlation with crypto because Bitcoin up to 30K right now. Basically 30K at 29.5K. It was down at 24, 25 a couple days ago. So it's had a huge rebounds lately. So basically short your dream, sir. In my opinion, I won't say anything rough, but people want to pull back so bad. I feel like anything remotely shy of we're good will be an excuse for people to sell. Well, he's definitely not going to just say we're good. He's going to say inflation is still elevated. Our goal is to hit 2% over time and some other variations of that. He said that he'll probably say that they're going to raise rates at least once more this year is my guess. Last FOMC, he said at least 2 more times this year. But we'll see what we had today. It'll be interesting to kind of watch and see what kind of market reactions we get to this. Again, we're going to stream the whole thing live. And again, on my channel, we cover all the big stuff. We cover stock market news, CPI, PPI, jobless claims, Jerome Powell press conferences, FOMC meetings, rate hike decisions, the Fed minutes report. All the big earnings are streamed here, or at least reported here live on stream. And so if you haven't already, hit the subscribe button. Do it now. I would never pressure you, but if you don't, I'll hate you forever. Do it now. I appreciate the love and support. I got to switch out my headphones right now, guys. Ooh, y'all are supposed to remind me. See what these are. All right, guys, we got about 45 seconds. We got about 45 seconds here, guys. All right. Luckily, we caught it. All right. Let's make sure Bluetooth is on. All right, guys, there's the timer. All right, guys. Again, you got it up here. Sound checks. Make sure sound is clear. Let me stop this, and we'll start it back up, and then it should be starting anytime now. All right, make sure you can hear the audio. You should be good to go. All right, there we go. Yeah, there we go. We're good. Big Papa Pump. Big Pete. Big Papa. Big Worm. What's your best Papa Powell name? I like Big Worm, but where's Smokey at? All right, guys. Hey, we're waiting for it to start. You can see we're live on the stream. Still waiting. They're a little bit delayed in terms of start time. So, hey, subscribe if you haven't yet, guys. Do you believe in magic? Big Papa does. Sell gold. All right, I'm going to stop the music here because the music, we don't need the music. All right, so again, it says they will begin shortly. Sound is fully up. We are waiting here. Again, make sure you hit the live button next to the play button. Again, nothing out yet. We're still waiting for this thing to start. Big P. Big Perm. Big Worm. Smokey. Who was better? Mike Epps or Smokey? Who was better? Chris Tucker. I honestly like Day Day a lot more than Smokey. But next Friday was my favorite one. But maybe that's because I grew up in the suburbs, and so, you know, more relevant to me. But anyways, hey, market's about to start. The Powell testimony. Again, we're still waiting. They're late on stream. They're late on stream. Still waiting for this to start here. Again, Bitcoin pull it back a little bit. The market's mostly breaking down here. We're going to get this timer out the way. Market's mostly breaking down. Here's the S&P 500 right here on the top left. Mostly a red day so far. Breakdowns here. Bitcoin now pull it back. Still waiting for this thing to start. Pinky. Yeah. Pinky was good. Yeah, I don't know whether he's going to say bearish or bullish things, guys. Again, let me know what you guys think. We're waiting for it to start. They're late. Again, hit the live button next to the play button to make sure you're caught up. But they are late on starting. It just says we will begin shortly. They are, at this point, 2+ minutes late. And, yeah. Again, we'll see what happens here. We are now waiting. E-mini still breaking down a little bit. S&P 500 still dropping. John has a tag that Powell says more rate cuts to come. Oh, you mean the scroller at the bottom of the screen? So that was part of his press release that he put out this morning. He said that the process of getting inflation down to 2% is a long way to go. He reiterated that nearly all the FOMC participants expect it'll be appropriate to raise rates again this year. Again, they are late, guys. Again, we still got we're 3 minutes late at this point in time. Still waiting for Big Papa, the man, to start. Markets are dropping mostly. Again, red action today. Tesla is down big. But, I mean, Tesla was up big prior to today, so it's all good. But, yeah, basically he thinks that we'll at least raise rates more this year. I'm not going to refresh. I will duplicate it to make sure it's not just me. Yeah, it's not just me. They just haven't started yet. But yeah, I refreshed it to make sure it wasn't just me, and it's not. They just haven't started yet. I got both of them up. I'll mute one just to make sure we're good. Oh, the girl that wanted the snacks? Man, what was her name? He had to make the deal with her. Craig had to make the deal with her. I can't remember her name. It's been a while since I've seen Next Friday. That's not really Carol's thing. That was like my movie that we always watched when I was a teenager. But Carol's not really into it. You know, rate pause temporary is new inflation. Maybe. I'm trading futures stocks. Yeah, speech hasn't started yet. Again, they're late. You can see the timer at the top of the screen at 10:04. 20. I hear sound. All right, here we go. I do hear sound. So they're about to start right now, guys. They're about to start now. I do hear sound. They've unmuted it for a second. Y'all can hear that, right? Just got to make sure my sound's working. I can hear the audience speaking right now. All right, SPY bounced it up a little bit. Okay, yeah, you hear it. Good. Thank you, Cisco. I appreciate it. Other people trying to act like they can't. The GOAT, the man. NASDAQ's still flushing down here. All right, here we go.
It'll come to order. Even the photography
Sound check.
come to order as well.
Sound check.
Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is titled the Federal Reserve Semi-Annual Monetary Policy Report. Not the most inventive title, but traditional. We call Humphrey Hawkins. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I will note at the outset this hearing has a hard stop at 1 p.m., which we will strictly observe. The chair would further announce to committee members that the chair's intention is in the second week we return in July, we'll have a markup, and that markup will include 2 important bills. One is giving digital assets a market structure and federal regulatory remit. And the second is a federal stablecoin regime. It is the intention of the chair to have that as 2 pieces of our committee markup in the second week we return in July. I now recognize myself for 4 minutes to give an opening statement. Thank you, Chairman Powell, for joining us today. Inflation remains broad-based and persistent. 2 troubling trends the Fed expects will continue. As you said last week, the process of getting inflation back to 2% is a long way to go. So even though the Federal Open Market Committee did not recommend a rate increase at last week's meeting, it's fair to say that the Fed will continue to make additional increases in the months ahead. We'd like to hear your thinking on those matters. As the FOMC again pointed out last week, the labor market still appears tight, with Fed policymakers projecting a rise in an unemployment rate to a still low 4.1% at the end of the year. Despite pressure from the left, the Federal Reserve must remain committed to eliminating this stealth tax on American workers and families. And I urge you to continue that resolve. A few weeks ago, Congress took the first step toward getting our fiscal house in order through the Fiscal Responsibility Act. Republicans will continue fighting for sensible spending reductions to combat inflation. This stands in stark contrast to Democrats' spending spree that poured nearly $2 trillion into a supply-constrained economy that was already flush with trillions of savings provided by earlier bipartisan COVID rescue efforts. And after keeping interest rates too low for too long, the Fed was slow to address the problem. In a stunning about-face, the Fed then raised interest rates by 5 percentage points in a little over a year, the fastest spike in modern history. This approach introduced accelerated interest rate risk for which companies, workers, and families across the country were not prepared. The bank runs we saw earlier this year are an example of the consequences. Now we're told these runs represent a systemic threat to the stability of our financial system. Add in the commercial real estate exposure facing financial institutions, and it becomes very easy to understand the mounting anxiety consumers and job creators share. And I share their anxiety as well. The rapid rise in interest rates, coupled with knock-on effects of the bank failures, have led to signs of a credit crunch across the economy. This would have a damaging impact to consumers and job creators alike. To top it off, Vice Chair for Supervision Michael Barr is undergoing a so-called holistic review of capital requirements. And something interesting that he mentioned in the press even yesterday is a new approach to stress tests that I can't quite understand. If reports are accurate, he's pursuing a massive increase in capital standards for medium and large institutions. This would limit banks' ability to lend money, exacerbating the looming credit crunch and starving families and small businesses the capital they need. Financial markets will also bear this strain as they will be forced to absorb nearly $1 trillion in new treasuries. This has led many to believe the Fed may be called on to help, perhaps through its repo or other facilities. Clearly, our economy is in a precarious position, from inflation to a potential credit crunch to substantial balance sheet risks for financial institutions. There's a great deal of uncertainty on the horizon. Uncertainty from the Fed supervision and regulation is the last thing the well-capitalized banking system needs now. Following numerous supervisory failures and a new vice chair for supervision at the Federal Reserve injecting politics into policy, it's become clear that Congress may need to again examine separating supervision and regulation out of the Fed and gaining greater oversight and control by Congress in the elected branches. With that, Mr. Chair, thank you for being here today. And the chair now recognizes the ranking member of the full committee, the gentleman from California, for 4 minutes for an opening statement.
Thank you, Chairman McHenry. Chairman Powell, welcome back. First, I'd like to start by acknowledging that the Federal Reserve made the right decision to pause interest rate hikes. As you know, since last November, I've cautioned against any approach to monetary policy that ignores the Fed's maximum employment mandate and results in a recession with millions of people losing their homes and jobs. While we have had strong job growth thus far, experts contend that this trend will not persist with more rate hikes, especially in light of new challenges. For example, the recent bank failures have resulted in the banking industry further restricting credit, making it even more important for the Fed to move with caution. The progress that we have made in reducing inflation is borne out in the latest consumer price index data. In fact, it's been 10 months since the passage of the Inflation Reduction Act, and inflation has successfully been cut in half. Every single Republican member of Congress voted against the bill and chose to cozy up to the wealthy tax cheats instead of working with Democrats to bring down costs for middle-class families. However, the only way we will fully combat inflation is to address the primary driver of inflation, soaring housing costs. Congress must invest more in fair and affordable housing. Under President Biden, unemployment is also at a historic low, and job growth is on the rise. So far, there's been 29 straight months of strong job growth. In fact, a record 13 million jobs have been created since President Biden took office. Democrats are working to build on this progress and grow the middle class so that everyone can share in this economic growth. Republicans, however, just can't seem to get their house in order on the heels of almost blowing up our economy by forcing a national default. They are now picking a fight over a tiny fee of less than 1% of total housing costs, ignoring the costs home buyers are paying with 7% interest rates, appraisal fees, and title insurance. Instead, they're fighting about gas stoves. In fact, just a week ago, Republican disarray got so bad that it halted business on the House floor for the first time in 20 years. Lastly, as we continue to monitor the banking system following the recent bank failures, the Fed must act to correct the supervisory and regulatory failures identified by our committee's oversight. Committee Democrats recently introduced 11 bills, including 3 of my own, to strengthen the safety and soundness of our banking system and hold executives accountable for their misdeeds. The Senate Banking Committee is holding a markup this morning on a bipartisan bill on bank executive accountability. So I urge Chair McHenry to join us in advancing sensible reforms to strengthen our nation's banking system. With that, I yield back.
Generally yields back. I now recognize the Mr. Barr, Chairman of the Subcommittee on Financial Institutions Monetary Policy, for 1 minute.
We expect proposals from the Fed's Vice Chairman for Supervision that could increase capital for financial institutions as much as 20%. Our already well-capitalized banks withstood the COVID shock and severe Fed stress tests as the economy is facing headwinds from the Fed's own rapid rate hikes. Now is not the time to be engineering massive new regulatory changes or hindering regional banks, which have already been under stress. New onerous one-size-fits-all regulation by the Fed needs proper vetting and transparency. I would ask you today to commit to providing us with analysis done so far by the Fed on the Vice Chair's new proposals. I also respectfully ask that the Chairman revisit Section 1107A1 of the Dodd-Frank Act to observe that the Vice Chairman for Supervision is authorized only to develop recommendations for the board and oversee supervision and regulation. The law does not give the Vice Chair special abilities to unilaterally write his own preferred regulations. It does not say that the Vice Chair should unilaterally write public-facing book reports on bank failures or results of climate scenario experiments. Consensus is paramount.
Gentleman's time is
Yield back.
expired. We'll now recognize the Subcommittee Chair on Financial Institutions and Monetary Policy, Mr. Foster, for 1 minute.
Thank you, Chair McHenry, and to Mr. Powell for being here today. In the wake of what seemed to be endless novel problems and disruption, I believe the Fed and Congress have done a reasonable job given the cards that we've been dealt. And indeed, it looks like the widely anticipated recession from the endgame of COVID disruptions, if it occurs at all, will continue to be more of a soft landing than a disaster for our economy. While there is certainly more work to be done, but in the immediate term, we can reflect with satisfaction on the historically low unemployment, 11 straight months of slowing inflation since the passage of the Inflation Reduction Act. However, I recognize that the necessary monetary policies put forth to combat inflation have not been without stress, including on the fraction of our banks that chose to ignore the Fed's clear forward guidance on that interest rate hikes were in the pipeline. We on this committee remain committed to alleviating the financial stress for everyday Americans to pay rent and get food on the table. I look forward to discussing how recent policies have performed and what else we should do going forward to ensure a strong economic rebound. Thank you, and I yield back.
Today, we welcome the testimony of the Honorable Jerome H. Powell, Chair of the Board of Governors of the Federal Reserve System. Chair Powell, we thank you for your time and being here. We'll recognize you for 5 minutes to give an oral presentation of your written testimony. Without objection, your written testimony will be made a part of the record. Chairman Powell, you're recognized.
Thank you, Chairman McHenry, Ranking Member Waters, and other members of the committee. I appreciate the opportunity to present the Federal Reserve's semi-annual monetary policy report.
Chairman Powell, if you'll pull the mic closer. Thanks.
We at the Fed remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. My colleagues and I understand the hardship that high inflation is causing, and we remain strongly committed to bringing inflation back down to our 2% goal. Price stability is the responsibility of the Federal Reserve, and without it, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. I will review the current economic situation before turning to monetary policy. The U.S. economy slowed significantly last year, and recent indicators suggest that economic activity has continued to expand at a modest pace. Although growth in consumer spending has picked up this year, activity in the housing sector remains weak, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. The labor market remains very tight. Over the first 5 months of the year, job gains averaged a robust 314,000 jobs per month. The unemployment rate moved up but remained low in May at 3.7%. There are some signs that supply and demand in the labor market are coming into better balance. The labor force participation rate has moved up in recent months, particularly for individuals aged 25 to 54. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. While the jobs to workers gap has narrowed, labor demand still substantially exceeds the supply of available workers. Inflation remains well above our longer run goal of 2%. Over the 12 months ending in April, total personal consumption expenditures prices rose 4.4%. Excluding the volatile food and energy categories, core PCE prices rose 4.7%. In May, the 12-month change in the CPI came in at 4.0%, and the change in the core CPI was 5.3%. Inflation has moderated somewhat since the middle of last year. Nonetheless, inflation pressures continue to run high, and the process of getting inflation back down to 2% has a long way to go. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. With inflation running well above our longer-run goal of 2% and with labor market conditions remaining tight, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5 percentage points since early last year and have continued to reduce our securities holdings at a brisk pace. We have been seeing the effects of our policy tightening on demand in the most interest rate sensitive sectors of the economy. It will take time, however, for the full effects of monetary restraint to be realized, especially on inflation. The economy is facing headwinds from tighter credit conditions for households and businesses, which are likely to weigh on economic activity, hiring, and inflation. And the extent of these effects remains uncertain. In light of how far we have come in tightening policy, the uncertain lags with which monetary policy affects the economy, and potential headwinds from credit tightening, the FOMC decided last week to maintain the target range for the federal funds rate at 5 to 5.25%, and to continue the process of significantly reducing our securities holdings. Nearly all FOMC participants expect that it will be appropriate to raise interest rates somewhat further by the end of the year. But at last week's meeting, considering how far and how fast we've moved, we judged it prudent to hold the target range steady to allow the committee to assess additional information and its implications for monetary policy. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, we will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity, inflation, and inflation, economic and financial developments. We will continue to make our decisions meeting by meeting based on the totality of incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Reducing inflation is likely to require a period of below-trend growth and some softening in labor market conditions. Restoring price stability, again, is essential to set the stage for achieving maximum employment and stable prices over the longer run. Before concluding, let me briefly address the condition of the banking sector. The U.S. banking system is sound and resilient. As detailed in the box on financial stability in the Monetary Policy Report, the Fed, together with the Treasury and the FDIC, took decisive action in March to protect the U.S. economy and to strengthen public confidence in our banking system. The recent bank failures, including that of Silicon Valley Bank and the resulting bank stress, have highlighted the importance of ensuring that we have the appropriate rules and supervisory practices for banks of this size. We are committed to addressing these vulnerabilities to make for a stronger and more resilient banking system. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you.
Thank you, Chairman. I now recognize myself for 5 minutes. Chairman Powell, as I laid out in my opening statement, inflation continues to be broad-based and persistent, both of which are concerning. Last week, the Federal Open Markets Committee decided to pause rate increases. And at the same time, the committee alluded that it would raise rates more later in the year. And so how should the FOMC's posture at the June meeting be interpreted? Will the committee continue to raise rates later this year? What's the thinking of this? What are we to understand?
Thank you, Mr. Chairman. So you're right, of course. We did decide to maintain the federal funds rate at its current rate at this meeting. At the same time, participants submitted personal forecasts suggesting that almost all of them thought there would be additional hikes. And I just want to say those two things are entirely consistent. The point being that the level to which we raise rates is actually a separate question of the speed with which we move. Earlier in the process, speed was very important. It's not very important now. The sense of the summary of economic projections and the decision really is just that, given how far we've come, it may make sense to move rates higher, but to do so at a more moderate pace. That's really it. You know, we were at 75 basis points for several meetings, then we were at 50 basis points, then 50 basis points, 25 basis points at 3 consecutive meetings, and now we're moderating that pace, much as you might do if you were to be driving 75 miles an hour on the highway, then 50 miles an hour on a local highway, and then as you get closer to your destination, as you try to find that destination, you slow down even further.
Okay. So it is more data is necessary for the Fed to make these decisions. And that's one interpretation, but thank you for a broader view there. I also want a broader view on this question of the vice chair for supervision is performing his own personal holistic review of the Fed's regulatory framework for bank capital and liquidity. In an interview yesterday, he discussed some version of a new type of stress test, even striking complete confusion in his description of it. And at the same time, we have testimony from you, even from the vice chair of supervision, saying that we have a sound banking system that is well capitalized. You will sit in judgment of this proposal that the vice chair for supervision will bring to the full board on this holistic review of capital. There are a lot of discussions about the amounts of capital he's talking about. The concern that this is pro-cyclical at a time where our economy with higher rates is you're measuring what's happening in the broader economy. And at the same time, we're going to have a major piece of capital required by financial institutions, which will further restrict lending. So how can you tell us to think about that, given your seat on the Open Markets Committee and as a Fed governor? How would you interpret that?
So I guess I would say you're right. There are a significant number of proposals that are kind of in the works. They haven't been finalized, let alone brought to the board yet. And so I can't really get into specific details today.
Well, we'd like your thinking, Chairman Powell. That's what we'd like.
What I can share is, principles and how I will think about this. Regulatory proposals go to the board. Every person on the board, that's 6 governors now, has an obligation to evaluate and vote on those. And I'm one of those people. I also chair the board. So a couple things I would point out. Just first that, I think regulation should be transparent and consistent and not too volatile. And particularly as it relates to capital requirements. I do note the central importance of capital. We want banks to be resilient to shocks. We want them to be able to lend in good and bad times. We want, in particular, the GSIBs, the 8 largest banks, to have high levels, very high levels of capital and liquidity. Indeed, we spent years raising those levels over a long period of time. And I think there's broad agreement, as you point out, that capital is strong. And, the question there will be what sorts of increases will be justified. That's what we'll be looking at. The other thing is to point out the trade-off between higher capital. The benefit of it, of course, is to have stronger banks that can lend and maybe survive more kinds of crisis environments. But, there are costs as well. And I think it's going to be, as always, a question of weighing and balancing those costs. And that's what I'll be thinking about. The last thing I'll say about that is just we benefit from having banks of all different shapes and sizes in our system. And we want to be careful not to regulate the smaller banks to the point where really their business models are challenged for all but the largest banks.
Well, this committee would expect to see a quantitative analysis of whatever the capital charge is going to be. We would expect that from the Fed, as we do from other regulators. With that, we'll now recognize the ranking member of the full committee, Ms. Waters, for 5 minutes.
Thank you very much. Chair Powell, at this committee's last hearing on digital assets, my Republican colleagues proposed a stablecoin bill that would create 58 different licenses with federal regulatory approval over only 2 of the licenses. The remaining 56 licenses can be issued by each state, territory, and DC with little or no federal oversight, regulation, and enforcement. This proposal takes state preemption into a whole new level. It effectively allows every state to preempt another state. DC-based coins, for example, would be sold to individuals nationwide, and New York or North Carolina regulators could do nothing to protect their own residents, while even the Fed would be severely hamstrung in providing any oversight. I've argued that we should allow states to be part of this process, but we must have a strong, enforceable federal floor with a role for the Federal Reserve to approve and provide oversight of payment stablecoins issued by non-banks in order to ensure that consumers are protected. Such a framework is similar to our dual banking system, and it would ensure that non-banks and banks are treated the same. We should also bear in mind that payment stablecoins are a new form of currency intended to allow individuals to pay for things with them. As such, do you agree that it is important for the Fed, as our central bank, to have a chance to approve or decline any state licensed non-bank entity before it starts issuing payment stablecoins nationwide?
Well, first of all, let me say we appreciate that we've been able to offer our views on these things to your staff and also the majority staff, and we appreciate the consideration that's given to our views. We do see payment stablecoins as a form of money, and in all advanced economies, the ultimate source of credibility in money is the central bank, and we believe that it would be appropriate to have quite a robust federal role in what happens in stablecoins going forward, and that leaving us with a weak role and allowing a lot of private money creation at the state level would be a mistake. But nonetheless, again, I do appreciate that we've been able to be heard and share our views with the committee.
Well, thank you so very much. I am appreciative for that clear answer. The next question that I have for you is a bit unusual. But one of the reasons we push diversity is because those things that have not been discussed, issues of people of color, et cetera, have not been dealt with. I'm going to throw you something that you would not expect. Earlier this week, our nation celebrated Juneteenth, which Congress recognized as a national holiday for the first time since 2021. The holiday celebrates the day enslaved African Americans in Texas heard that they were free 2.5 years after the Emancipation Proclamation was issued. To this day, Black Americans grapple with enduring racial economic inequality that has its roots in slavery, as evidenced by the Black-white gap in net worth and home ownership rates. My bill, the Federal Reserve Racial and Economic Equity Act, would require the Federal Reserve to carry out its duties in a manner that supports the elimination of racial and ethnic disparities in employment, income, wealth, and access to affordable credit. Now, the Fed has a number of duties to pursue maximum employment in the monetary policy, to supervise banks for compliance with our fair lending laws, and to ensure the Community Reinvestment Act is administered in a way that puts an end to discriminatory redlining practices by banks. Do you agree with me? And Atlanta Federal Reserve President Raphael Bostic, among others, that the Fed has a role to play in addressing racial economic inequality as it carries out its work until Congress passes this bill. What steps will the Fed can you take to address racial and economic inequality?
So we do consider inequality in the economy as part of our thinking about decisions, but ultimately, and those are certainly highly valuable social goals to pursue. I would say our ability to take part in addressing those issues is fairly limited. We have one federal interest rate that we set. We do try to keep in mind, as you know, not just the aggregate national level of unemployment or employment, but also that for different ethnic groups. So we take that into account, but I would think, and I think that's just part of making sure that we feel like we have all Americans in the room with us when we're making decisions on monetary policy. I will say, though, I think other agencies are better suited to address these deep issues.
Thank you. We must have this continued discussion on racial equality. I yield back.
The lady yields back. We'll now go to the Vice Chair, Mr. Hill of Arkansas, for 5 minutes.
I thank the chairman of the committee, and Chairman Powell, great to have you back before the committee. And this morning, you've reiterated, and certainly Vice Chair Barr has reiterated a number of times, that the banking industry here in the United States is well capitalized. And in fact, capital levels have remained robust despite COVID-19, with a 20% plus unemployment rate increase and a 9% output gap. They've remained stable through government shutdowns. They've remained stable through severe stress testing. And maybe more importantly, just in the last few months, since the first week of March, you've seen strong capital come into play as we've grappled with the reality of a 40-year increase in short-term interest rates and that impact on banks. But as the chairman said, Michael Barr continues to say he wants to increase capital requirements on certain financial institutions. And in March, you testified that you said, I will do everything I can possibly do to bring people together, meaning on the Board of Governors, in consensus and have a capital framework that could be broadly supported. So to what extent have you and the other governors been involved in this so-called holistic review by Vice Chair Barr? Has he briefed the other members of the Board of Governors thus far?
Yes, and we've all been briefed by staff really on the proposals, but as I mentioned, they're still somewhat in motion. But yes, we've been briefed.
So you would say those proposals are still under consideration and that there's no final decision that's been taken by the board?
Well, no, once the proposals really do settle down and are written up, they'll come to the board for a full discussion and a vote.
Has the Fed board reconstituted now the Committee on Supervision and Regulation, the membership of it?
Oh,
who's on that committee now?
So that committee is chaired by Vice Chair Barr, and it also includes Governor Jefferson, and it includes Governor Bowman.
When you look at capital in the U.S., and I look at the globally significant banks here versus other places in the world, would you say that the U.S. banks, the U.S. G-SIBs, are better capitalized than their global peers in Europe or in Asia?
So we're certainly at or near the top of the league table. I think there are a couple other jurisdictions that also have broadly similar levels of capital strength, but yes, we're at the top of the league table.
I looked at it this morning, and U.S. G-SIBs have 11.3% capital without any kind of modification compared to their European competitors at only 9.9%. So would you say that we're better capitalized than the European banks, the European G-SIBs?
I hate to call out the other jurisdictions, but I would say our banks are very strongly capitalized and also competing quite successfully globally outside the United States.
Yeah, I agree. And I think we've strengthened capital. We've strengthened our supervision, notwithstanding the problems that we saw this spring, which we've talked about ad nauseum here. But that capital standard does make American banks, I think, stand out. And wouldn't Basel, the so-called Basel III holistic reforms, wouldn't it be better if the European banks did a holistic review and actually got their capital up to American standards?
So I think they are bound by the same, no one's bound by these, but they have agreed to follow the same standards. And I think they're going through the same process we're going through.
Same topic, are the FDIC supervisory process and the OCC supervisors, are they involved and engaged with Vice Chair Barr in looking at this, quote, holistic review of capital adequacy?
I think,
in other words, are they providing their input to the Vice Chair for supervision in their own views on this topic?
on the regulatory proposals that are relevant to them, yes. I think on the capital proposals, yes, I believe so.
And you made a comment a minute ago, I think, to Chairman McHenry's questions about that you'd like to see rules and supervisory rules consistent over time. And I think that's frustrating here. We see change in administration. Sometimes we see change in rules, which is, I think, frustrating to the private sector and to market participants. I note that the Biden administration says that the Financial Stability Oversight Board should now base their decisions on size as opposed to activities. And for several years now, we've had an activities designation and a cost-benefit analysis. Do you think the activities designation gives supervisors more discretion at FSOC to select who should be deemed under their supervision?
So I actually think that one.
In other words, is size alone, should we be looking only at size or should we look at cost benefit analysis and activities? And my time's expired. If you'd answer in writing,
Okay.
I would appreciate it. I think this is an important issue. I yield back, Mr. Chairman.
We'll now go to Ms. Velasquez of New York for 5 minutes.
Thank you, Mr. Chairman. Chair Powell, at your press conference last week, you stated, and I quote, "The committee is completely unified in the need to get inflation down to 2% and will do whatever it takes to get it down to 2% over time." Some analysts have interpreted this statement as the FOMC's willingness to trigger a recession in order to get inflation to 2%. How would you respond if this is a fair and accurate interpretation?
So our statutory goals are price stability and maximum employment, and we are dedicated to using our tools to achieving those. In the case of employment, we still have historically low unemployment rates and high employment rates now, high participation, a very strong labor market. We're very far from our inflation target of 2%, and we're very focused on getting back to 2%.
And how does the FOMC takes into consideration the impact of rising interest rates on LMI communities and small businesses when determining monetary policies?
So we only have one interest rate to raise or lower. It's not true, but mainly one main interest rate to raise or lower, and it applies to everyone. But I would say that inflation hits LMI communities and people generally at the lower end of the income spectrum much harder than people in the middle or at the high end, because high inflation can get you into trouble right away if you're living on a fixed income just to cover the basic necessities. So it is for the benefit of those people that we must get inflation under control. It's for the benefit of all Americans, but particularly for those people. And we keep that in mind as we are strongly committed to getting inflation back down to 2% over time.
Well, and they are the same people that are having a hard time accessing loans, the same with small businesses. Chair Powell, Vice Chair Barr's report on the Fed's review of Silicon Valley Bank states that while there was regulatory tailoring conducted in response to S2155, there was also, and this is the part that really concerns me, a cultural shift at the Fed under the direction of the previous Vice Chair for Supervision, Randy Quarles. According to the report, this shift included pressure to reduce burdens on firms, meet a higher burden of proof for a supervisory conclusion, and a need to accumulate more evidence than in the past. As chair during that period, were you aware of this cultural shift and the impact it was creating?
So I think we learned from the Silicon Valley failure and the others that there is going to be a need for stronger supervision and also regulation for banks of that size. And I'm committed to learning the right lessons from this exercise and to forthrightly implementing changes.
Were you aware of the cultural shift?
So I can't really characterize it that way. Certainly, I was aware that we were trying to avoid excessive regulatory burden. That
So
is
you
always an
disagree
appropriate
with
thing.
Chair Barr's report in that respect?
I'm sure that the people who wrote the report were accurately reporting what they heard from back in.
How often were you meeting with Vice Chair Quarles?
I reasonably frequently. We sat quite near each other.
And never discussed the cultural shift?
I didn't say that, but I don't remember it. The way you're describing it is not what I recall. I recall Vice Chair Quarles talking about things like focusing on the really important issues and not getting diverted into other.
So the way it was described by Vice Chair Barr is not what you recall?
Well,
So
I
what
had no part
steps-
in. I said I had no part in preparing the report. I'm confident that the staff who worked on the report reported accurately what they heard. I'm sure that that's right.
So what steps did you take proactively to meet with regulatory and supervisory staff?
Well, I think we're taking significant steps now. We're, as you know, under Vice Chair Barr's leadership, we're looking carefully at these events and asking ourselves, what do we need to do with supervision? And I think there is a point to be made that there are situations in which we need to be more forceful and more proactive. Not in all situations, but in some. In regulation, I think we're learning that we need to update our thinking around liquidity regulation, which was based on a certain speed of bank runs, which now looks to be outdated.
My time has expired.
The gentlelady's time's expired. We'll now recognize the gentleman from New York, Mr. Garbarino, for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. I just want to start off by asking a few yes or no questions. Was the Silicon Valley Bank failure a result of a liquidity issue?
I'm sorry.
Was Silicon Valley Bank failure a result of the liquidity issue?
Among other things, yes.
Signature Bank failure, the result of a liquidity issue?
Yes, I mean, that's not, there's also a lot of very bad management decisions being made here.
But
Yeah.
liquidity. First Republic, was that a failure result of a liquidity issue also?
Among other things, yeah. I mean, I wouldn't say just liquidity.
Well, all right, were any of them a failure of having too low capital levels?
So let's go to Silicon Valley Bank. You know, the issue that triggered the run initially was the presence of significant losses in their securities portfolio.
Yes.
And that is that is a capital issue.
So they had too low a capital, the requirements, so what?
They weren't required to, as you know, they weren't required to take that into account in their capital. But I think if you remember what people were focusing on was these portfolio losses. And then what people weren't focusing on was the fact that they had in excess of 90% uninsured deposits, and that's what caused the run.
So would increasing capital requirements for Silicon Valley Bank or any of these other banks or all banks together, would that have stopped these banks from failing?
That's it's a hypothetical, unknowable question. I think it might have helped. I think it might have helped, but
How much then? Increasing it by how much would have helped?
It's very hard to say. Very hard to say. I mean, clearly the main issue there was a failure of management to follow up, a failure of supervision to require them to follow up, and really the liquidity regulation was just not appropriate. We needed to have stronger regulation around liquidity and uninsured deposits.
So last year you said the banking system is very strong, well capitalized, highly liquid, does a much better job of understanding the risks that it runs and managing them. And just today you said the banking sector seems to be strong. Do you still stand by those statements? I mean, just said it today.
Yes.
So, yep. Last month, Vice Chair Barr appeared before this committee and he agreed with you and said overall banks have a strong capital and liquidity. Secretary Yellen has said similar things. But today, even though you've all said that banks seem to have strong capital, you seem to lead us today by saying the bank's considering what increase would be appropriate of capital requirements. So has the board already decided that an increase will happen? They're just deciding what's the size of the increase for capital requirements?
No. What I meant to say, what I thought I said was that any increase above these levels would need to be shown to be justified.
So I understand, and you have a vote as whether or not what this proposal you'll vote on whether or not. Do you personally think that an increase is necessary at this time?
Do I think?
That an increase in capital requirements is necessary at this time?
Look, I'm going to react to whatever the proposal turns out to be in the end and give it my best assessment. And also, that's what I'll say.
Okay. You just also said that credit is tightening. Won't increasing capital requirements further tighten credit?
Over time, I mean, the thing about capital requirements is if we put a proposal out this summer, let's say, it'll be quite a while before that proposal is, agreed and among the agencies and then voted on, and then it'll take some years to come into full effect. So I would think, whereas interest rates, for example, have immediate effects on financial conditions and then reasonably quick effects on economic activity, capital requirements are a much more sort of medium-term, longer-term thing.
So I'd like to move on to what the impacts on lending, raising capital requirements would have. According to an academic literature by the Basel Committee on Banking Supervision, a 1% point increase in capital requirements could potentially reduce annual GDP by up to 16 basis points, showing that higher capital requirements come at a cost and could have significant impact on the U.S. economy. I discussed this with Vice Chair Barr last month, and he expressed my concerns about what the impact of increased capital on the real economy, but he didn't answer the question directly. We just need to, we're hearing from all sorts of industry that these increased capital requirements at any level would have a further tightening on lending. And if that happens, and I'm hearing from everybody, if that happens, it's going to be a real disaster. So I think anything that the committee proposes, if you could come back and brief us on before it's finalized, we would appreciate that very much, sir.
Gentleman's time has expired. The gentleman from Missouri, Mr. Cleaver, is now recognized.
Thank you, Mr. Chairman. Welcome, Mr. Chairman. Thank you very much. This is probably Economics 101, but a lot of people in my district are misunderstanding 101 along with me. In May of this year, unemployment remained at 4% for the 16th consecutive month, and at 3.7%. This means that unemployment remained at or below 4% for the longest stretch in 50 years. In the U.S., the job openings rate has fallen by more than 1.5 percentage points from its peak, while the unemployment rate has crept slightly lower. In other words, the job openings decline, but so does joblessness. And I'm wondering if there was any expectation that this would occur.
There is an expectation that the level of the ratio of job openings to unemployed people has been in historic territory, all-time highs for a while now in the last year or so. And there is an expectation that it will come down. There a while ago, there were 2 jobs for every unemployed person. Now we're down to 1.7, I believe, or 1.6. And that still speaks to a historically tight labor market, where their demand for labor still very substantially exceeds the supply of available workers. So we do expect as things, and that, by the way, that's a way that the labor market can become less tight without having unemployment go up.
I'm sure you're hearing this all over as I am, and that is business people. I've got a good friend who has number of barbecue restaurants in Kansas City, and he is constantly telling me how difficult it is to find workers, to the point where he did something he thought I'd never do, put a sign out in front of his restaurants, job openings. And are there particular industries or sectors of the economy where we would expect this sentiment to be particularly true?
No, and that is right. That is, there's still a significant labor shortage. The surveys at the aggregate level show that it's not as bad as it was 2 years ago. So gradually, businesses are reporting that they're having better able to find workers. Workers are reporting that they're not quitting their jobs as much as they were. That's a really good sign of how tight a labor market is how much people feel free to quit their jobs voluntarily. So those things are all suggesting a gradual cooling and a gradually getting supply and demand back into alignment. But we're not there yet. We still have a significant excess of demand over supply.
Are we also finding that well, I know in Missouri that in spite of the fact that there is some jelly-like movement with the economy, people are still willing to go in our community, still willing to go out and buy homes. I mean, we're not we're not having difficulty in terms of people going out getting loans, even with the interest rates rising. If all of this continues, if the consumers are constantly paying whatever the interest rates might be, are we going to get stuck just continually going up?
Well, no, I don't think so. So in housing in particular, there is the housing sector nationally has flattened out and maybe ticked up a little bit, but at a much lower level from where it was with rates as high as they are. So supply and demand there are getting back into alignment. And I do think that, housing inflation is set to come down as we move forward. There's a particular way that the inflation is calculated there, so that you're really only looking at you're waiting for leases to come due and roll over at much lower levels of increase. So we think housing inflation will be coming down significantly over the course of the rest of this year and next year.
Thank you, Mr. Chairman.
Gentleman's time has expired. The gentleman from California, Ms. Kim, is recognized.
Thank you for recognizing me, Chairman. And Chairman Powell, thank you for joining us. I appreciate your comment to price stability and commend your efforts to reduce inflation and make life more affordable for all Americans. Thank you for that. The 10,000 small businesses survey of 2,000 small businesses found that 77% were concerned about their ability to access capital. So with that in mind, do you think it's appropriate for the Federal Reserve to increase capital requirements at this time? And I know this was discussed earlier, but what specific analysis has the Fed conducted so we can determine the impact of this warrantless regulatory action on small businesses and other marginal borrowers?
So it's with capital standards, it's always a trade-off. The more capital means a more stable, more sound, more resilient banking system, but it also at the margin can mean a little bit less credit availability, and also the price of credit can be affected. And there's no perfect way to assess that balance. Obviously, the answer is not zero capital. It's not 100% capital. So it's somewhere in the middle.
Thank you. There are estimated about 1.5 trillion of commercial real estate loans that are maturing in the next 3 years. And declining demand and the prevalence of work from home policies are putting a strain on commercial real estate market. The bulk of commercial real estate loans are held by smaller and regional banks. So is the Fed thinking about policies that could provide time for commercial real estate loans to be refinanced? And could an increase in capital requirements reduce liquidity in the commercial real estate loan market?
We're very focused on the commercial real estate situation. You're right, of course, that a good portion of the commercial real estate loans are held in smaller banks. And supervisors are very much engaged with those banks. And it's particularly banks that have a high concentration. That's what we look for among the smaller banks. And there are some of those, but there's a playbook for working your way, working your way out of these loans. And it's particularly in the office sector where, work from home is still a pretty material factor in some areas, as you know.
Thank you. So the next question has to do with the board process and procedures. What are those procedures that govern consideration and potential adoption of matters like the proposals that Vice Chair Barr is, about to present to the board?
So on regulation, as opposed to supervision, on regulation, the Board of Governors votes on regulatory proposals, and it's a majority vote. We now have 6 voters. So when there is a proposal, it will be briefed carefully, and then we will have we'll have a meeting, or it can be done actually virtually, and probably will be that way, as most of our meetings are. And then we have a vote. That's on supervision. It's different. Most supervisory matters are really under the authority of the Vice Chair for Supervision under the law. So most of them don't have to go to the board for a vote.
So what percentage of the governors must vote in favor?
Majority.
The majority of them?
Yeah.
Okay. The California governor, prior to the depositor bailout for SVB, reportedly identified that he had been in touch with the highest levels of leadership at the White House and the Treasury. The governor also on Sunday March 12, when the bailout was announced, issued his own statement praising that action. There have also been reports that the governor and his wife, with respect to their business and perhaps other interests, may have had depository interest in SVB. So when the Federal Reserve Board, the FDIC board, and Secretary Yellen, in consultation with the president, recommended invoking the systemic risk exception for SVB, and then decided to provide blanket insurance even on uninsured balances, did the Fed or any others, to your knowledge, perform any conflict of interest due diligence?
No, I mean, we were in an emergency situation on Monday morning. There was going to be, and there was a run on banks that looked, that
So
had
looking
high
back,
insured
do you think
depositors.
there
So
was
we,
any
we carried out our
Yeah.
duties, and I'm actually pretty sure we did the right thing.
And you don't think there was any conflict of interest, even looking
I
back?
have
from
nothing.
that?
I have absolutely no knowledge on that.
Okay. Well, thank you. Thanks for being here. I yield back the balance of my time.
Gentlelady yields back. The gentleman from Texas, Mr. Gonzalez, is recognized.
Thank you, Mr. Chairman and Ranking Member. Thank you, Chairman, for being here with us this morning. The June Federal Open Market Committee report indicates inflation in the U.S. and abroad continue to ease but remain elevated. In response to the FOMC that has the proposed interest rate increases up until June 14th recommendations to pause interest rate hikes for the first time this year, research has shown that the effects of monetary policy decisions, like raising interest rates, can take on average 42 months to be realized fully in the United States, meaning we may not fully understand the effects of this first increase in rates of March 2022 until next fall. With that in mind, how have our recent tightened monetary policies impacted the strength of the US dollar and how it is valued globally?
Let me say that there's a lot of uncertainty around how long it takes monetary policy to affect real activity. There's no agreement on 42 months or any particular thing, and I think most people would say shorter than that. So you're asking how it would affect the dollar?
Yes.
So first of all, the Treasury Department has responsibility for the level of the dollar and the stewardship of the dollar as a currency. We don't actually comment on that. We don't look at any particular level. It's just to us, it's a financial condition. A stronger dollar means certain things and a weaker dollar means certain other things. But
it continues to be a concern here in this committee. Also, Chairman, as you're aware, the Federal Reserve's core mission is to keep employment up and inflation down. Although I understand the calls for climate-related financial risk management from my colleagues, we should be focusing on the economic state of our country. The credit of the US dollar is at jeopardy, and as you know, we've had global pressure recently, and we need to be sending a clear message that the world can rely on the full faith and credit of the United States dollar. We should be focusing on mitigating the calls to reduce dependency of the US dollar. Monetary policy changes implemented in the US are likely to cause a ripple effect throughout the global economy. With that said, would you agree that monetary policies to directly address climate change should be made by Congress and not the Federal Reserve, and implementing monetary policies and supervisory tools to exclude energy leaders from capital and financial institutions would have a grave impact on local, state, federal, and even global economies?
a strong agreement around the fact that we have quite a narrow role in climate change, and really the important decisions about climate change need to be made by elected people, not by the Fed.
Thank you, and I yield back.
Gentleman yields back. The gentleman from Florida, Mr. Donalds, is recognized.
Thank you, Mr. Chairman. Chairman Powell, thank you for being here. Really appreciate you being here. Look, I got to say, first of all, it was good to hear from the other side of the aisle that the Federal Reserve should not even be engaging in using its tools with respect to climate change or climate mitigation or whatever the case might be. The Fed, you guys have a big enough job as is. Adding anything like that to your job, I think will be wholly detrimental to the American economy. So I, for one, this morning am glad to hear that coming from the other side of the aisle. You've had a couple of questions already on capital, bank capital, et cetera. Look, some of the current views are that continuous raises of bank capital will increase costs to our economy anywhere from 50 to $200 billion. What's your view of the current desire or mode of Vice Chair Barr to fully implement the Basel III capital standards?
Well, I think that's the next thing. Vice Chair Quarles was working on that. It didn't get completed for various reasons, but that, I think that's an international capital standard that we should go ahead and complete. As to the right level of capital, that's a discussion we're about to have.
Are you guys at the Fed, are you guys kind of concerned about the fact that now it seems like the European regulators are starting to pull back from that? Like they're starting to think about capital standards being too much for European banks, and that they're starting to recede from what was, I assume, kind of a handshake agreement in years gone by.
Yeah, I'm not hearing that exactly. We'll be watching that carefully though.
Okay. Overall, just with respect to capital, I mean, let's take a step back. Obviously, since 2008, 2009, we have, in my view, aggressively gone through this process of increasing capital standards and capital requirements on a tier one capital for banks. In retrospect, do you think that's been a net positive to the overall banking environment, or do you believe it's been a negative to the overall banking environment?
I think it's been a net positive. And as I pointed out earlier, U.S. banks have competed very, very successfully through this period, despite what were pretty significant capital increases that we put in a few years back. So it really has led to a very strong and also made it well through the pandemic period, I thought. And I think that was a pretty good test. So even though the government did do a lot to support the economy, still, I think that those capital hikes that we made in the last cycle come through looking pretty good.
Do you guys at the Fed, do you have a view of, I say you guys, because I know you're the chairman, but there's other members as well. Do you have a view of the concern about community banking in the United States, or a lack thereof of community banking? It has been shrinking quite significantly over the past 10 to 12 years.
Very, very much so. It's a focus for us. We understand the importance of community banks, that they provide a different service and a really important service to smaller businesses and communities. And community banks have been consolidating for 30 years now. So it's really a secular trend as people have moved to bigger cities and things like that. But we don't want to do anything to move that along. We think that the world's not a better place with fewer community banks, and we try to keep that in mind in all of the regulatory and supervisory things that we do.
Do you think that federal regulatory policy, in part from Congress, has led to a supercharging effect of diminished community banking in the United States?
It's probably been a factor, but I do think there have been important demographic factors as well. And also having interstate banking. Interstate banking only became legal quite recently, and that also has led to consolidation. You can look back though, look back 30 plus years, and you've seen a very steady decline. So I think there are demographic and other factors driving it, but regulation can fall as a fixed cost, which means that institutions need to be bigger. And I think that's probably part of the story.
Look, I don't disagree with your conclusion. I'm just concerned about the trajectory. I think just having larger financial institutions, larger banks overall, with a diminishing smaller community bank infrastructure is detrimental to lending to small businesses, mom and pop businesses. It also could be parochial. I started my career in community banking, so I saw a heartfelt situation. Last question, running out of time. The SEC has proposed a rule that would, among other things, require banks to segregate client cash held in custody, upending custody bank balance sheets, and by extension, the bank custody model. Are you guys at the Fed concerned about this proposed rule from the SEC?
The gentleman's time has expired. The chairman can
I'll
answer
respond to
in
that.
writing.
Okay, fair enough. Thank you, Mr. Chairman.
The gentleman from New York, Mr. Torres, is now recognized.
Thank you, Mr. Chair, and thank you, Chairman Powell. As you know, the U.S. has foreign adversaries, particularly the CCP, that seem intent on de-dollarization. How seriously should the threat of de-dollarization be taken, in your view?
Well, the status of the United States, of the dollar as the world's reserve currency, is a very important thing to us. I think the reason we have that status is largely due to our great democratic institutions, the rule of law, and the fact that we have, generally speaking, had strong levels of price stability. And I think that the dollar will remain the reserve currency as long as those things are in place.
Well, I want to explore that answer because commentators often speak of the dollar as the world's reserve currency as the cause of America's economic dominance. Do you think of it as the cause of America's economic dominance or as a consequence of it?
To me, it's more of a consequence. And also there tends to be an equilibrium where one currency becomes the accepted global standard, and that has been the dollar for some time, and I expect that it will be for some time, continue to be.
It's often said that the Fed has a dual mandate of maximum employment and price stability. Do you view these mandates as equally binding upon the Fed, or does one supersede the other?
They are perfectly equal under the law.
And I'm curious to know what it means in practice to have a 2% inflation target. The latest pause notwithstanding, does it mean the Federal Reserve will continue raising interest rates until the 2% target is reached, even if doing so comes at the expense of maximum employment as well as financial stability?
No, it doesn't mean that. It does not. So the way we think about it is most of the time, the two goals are aligned in the sense that if you're achieving one, you're achieving the other, and if you're a little bit off, the other one, they move in the same direction. Today's situation is unusual in that we are overachieving, in effect, the maximum employment goal, but we are far from achieving the inflation goal. So in our system, we have a constitutional document, and what it says is that when that's the case, you look at how far you are from the goal, and you look at the speed with which you would move back to the goal. And so that would tell you today that we should focus heavily on inflation. But as it becomes closer, as the two things become more aligned, then they go back into perfect equality under the law.
So the Fed engages in a delicate balancing act between employment and inflation.
Yes.
To what extent do you factor in financial stability, safety, and soundness when raising interest rates?
So you're right. We do have a financial stability mandate, but we try to.
Well, you have a financial stability mandate with respect to your role as a bank regulator. But when it comes to
also just generally, we're the lender of last resort. Central banks were originally created to support the financial system in times of stress and to make sure that you don't get into times of stress. So I would say that, sorry, what was your question before that? It was
to what extent do you factor in safety and soundness when setting interest rates?
Sorry. So we really try hard to use our financial stability tools for financial stability purposes and our monetary policy tools for monetary purposes. The reality on the ground is much messier than that. They're very much entangled, and one affects the other. So the separation is not at all perfect. But we do think of these as separate things with separate tools.
Do you think that the Silicon Valley bank failure revealed a deeper tension between the safety and soundness mandate of the Fed as a bank regulator and the mandate of the Fed as a administrator of monetary policy? Or?
I would say no, and I'll tell you why. Interest rate risk is, one of the most basic banking risks. We supervise for it. Overwhelmingly, U.S. banks did manage their interest rate risk. Silicon Valley Bank didn't, and even though we were, the supervisors were pointing that out to them, they just didn't take, the bank didn't take action quickly enough. So I would have thought that you can say that it was interest rate hikes that caused portfolio losses, but it was management that failed to hedge against those losses and failed to hold appropriate liquidity.
In the pre-COVID world, we had the best of both worlds: low unemployment, low inflation for decades. Do you believe that we could return to that best of both worlds, or are high interest rates a new normal in the American economy?
So we will return to 2% inflation and maximum employment. What will be the level of interest rates there? That's a really good question. And
do you suspect it's going to settle at a higher level than we've known historically?
I think it's really hard to know. It's a great question. We talk about this a lot. The people who argue that they will move it back down just point to the fact that it was really global factors that drove rates down in the first place. Maybe the truth is somewhere in the middle.
Gentleman's time has expired. The gentleman from Nebraska, Mr. Flood, is recognized.
Thank you, Mr. Chairman. Chairman Powell, I'd like to discuss the continued efforts to unwind years and years of quantitative easing and what it's done to our Federal Reserve balance sheet. If you take a look at the size of the Federal Reserve's balance sheet, Since the 2008 financial crisis, we've seen an alarming increase from around 800 million to today's 8.3 trillion in assets. Back in 2018, you did start the work of winding down the balance sheet. You managed to offload roughly 700 billion assets between the beginning of your time as Federal Reserve Chair and August of 2019. The problem was, shortly after your efforts began, we had another major economic shock, the COVID-19 pandemic, that caused the Fed to once again return to quantitative easing as a form of economic relief. Pretty soon, the Federal Reserve's balance sheet had increased another $4 trillion in size. That's how we made it to the balance sheet level that we are at today. I understand you have started working to shed some of the Federal Reserve's balance sheet, and I appreciate the work. That being said, the scale involved here, to me, is startling. My concern, Chairman Powell, is that efforts to shed assets from the Fed's balance sheet have never been anywhere as quick as efforts to build it back up. Our economic cycle does go through recessions from time to time. It's not always boom, but some bust too. If we continue a pattern of rapidly building up the Federal Reserve's balance sheet in bad times and slowly shedding assets in good times, we're going to see the balance sheet grow significantly over time. Chairman Powell, is this a concern of yours? And to pair with that question, long-term, how can we avoid an environment where any effort to unwind the Federal Reserve's balance sheet is undone anytime there's an economic shock?
It is a concern, and that's why we are this time the balance sheet roll-off is much faster than it was back in the first episode. We also know more. We hadn't grown our balance sheet like that, and we hadn't shrunk it before. Now we have experience with that, so we are moving back down to a level that will be appropriate for our new framework. By the way, we won't go back to a framework where we were dealing with scarce reserves. We like the administrative rate framework that we're in now, but it is important that the balance sheet not just grow with every cycle, and I think I'm very conscious of that.
Chairman Powell, do you have an optimal Fed target for the size of what the balance sheet should look like? A number?
I'll give you the idea, and that is, you find the number, but the idea is that it's smaller than now. It's a place where reserves are abundant, and also have a little bit of a buffer on top of that so that we don't accidentally run into reserve scarcity. Demand for reserves can be volatile, and you don't want to find yourself, as we did a few years back, suddenly finding that reserves were scarce, even though we didn't see it coming, and we then had to put more reserves into the system at a time when we didn't want to be doing that. So I think you want to have a level where we have ample reserves plus a buffer, and that'll be a % of GDP that we get down to, and we're moving in that direction pretty smartly.
Chairman Powell, realistically, how quickly can the Federal Reserve unwind its balance sheet? What's the threshold beyond which an asset sell-off by the Federal Reserve would disrupt our markets?
So we don't sell assets. What we do is we allow them to mature and passively roll off, and that's what we're doing to the tune of about $1 trillion a year. And we're in the middle of that process now. We will, it's an empirical question. You're going to find a level that is still ample, plus a bit of a buffer, and that's how we're thinking about it.
Thank you, Mr. Chairman. I would just reiterate my concern on this issue. I fear that having the Federal Reserve backstop so much of our economy through the holding of treasuries and mortgage-backed securities is not sustainable long-term. Thank you, Chairman. I yield back.
Gentleman yields. The gentleman from New York, Mr. Horsford, or Nevada, Mr. Horsford is recognized.
Thank the chair and the ranking member for holding this important hearing, and thank you, Chair Powell, for appearing before the committee today. Before I begin, I'd like to ask permission to enter into the record editorial by the Las Vegas Sun entitled "Economy Infrastructure Thrive When Dems Have the Reins," dated June 16, 2023.
Without objection.
During this time of increased economic uncertainty, it is more important than ever that the Federal Reserve fulfills its dual mission of maximizing employment and supporting price stability. There is no doubt that it is difficult, and the needle that has to be threaded is very specific. However, the human cost is simply too great for us to get this wrong. Sometimes we need to be reminded that there are real people behind the economic data, and that the actions taken by both Congress and the Fed have real consequences for everyday Americans. everyday Americans who want to know that myself and my colleagues are dedicated to creating an economy that actually works for them, which is why I was pleased that last week the Federal Reserve decided to pause your interest rate hikes and take stock of the overall economic picture. Now, don't get me wrong, there's certainly more work ahead of us, but with 13 million jobs added since President Biden took office, we should be rooting for America to succeed and not to fail. The strength of the labor market continues despite the multiple concurrent shocks that continue to reverberate throughout the global economy. And I believe our economy remains resilient thanks to the historic investments that were included in the legislation passed last Congress and signed into law by President Biden. These beneficiaries of these investments were the people, the middle class, not special interest. The bipartisan infrastructure law is creating construction jobs and projects that will help ease supply chain challenges and ensure safer transportation for everyone. President Biden and congressional Democrats are investing in technology that will define the 21st century, components to generate solar and wind energy, semiconductors, and electric vehicles that will all be made here in America. Just last week, Treasury Secretary Yellen was before this committee and described how the transformational investments from the Inflation Reduction Act are ushering in a renaissance of domestic manufacturing. These are good-paying jobs, union jobs, that are expanding our production capacity here at home while reducing our reliance on goods imported from abroad. As I indicated in the editorial by my hometown newspaper, the Las Vegas Sun, remarks that annual investments in manufacturing construction has more than doubled its pre-pandemic levels. Furthermore, when we narrow the focus to the region, including Nevada, the U.S. Census Bureau estimates that in just 2 years, private manufacturing construction increased almost tenfold. So if we want to rebuild the American middle class, we must do so from the middle out and by investing in modern infrastructure and modern manufacturing facilities. But this does not mean that everything is improving equally. I've heard time and again from my constituents about the cost of housing being one of their biggest pain points. The Monetary Policy Report points out that housing services prices have risen a shocking 8.5% over the 12-month period ending in April, and in my district, it's even worse. So Chair Powell, at a time where it has become increasingly difficult for working Nevadans to purchase a home, I worry that rising mortgage rates will put working families even further behind on accessing the wealth and equity that a house provides. While higher rates have cooled some housing markets across the country, what do you see as the biggest remaining upward pressure on housing services, and what can we do in Congress to incentivize new home starts to hopefully moderate the imbalance between supply and demand in the housing market?
I think you're talking about largely longer run factors here. And I think there has been for some time a shortage of housing. It's harder to get lots, it's harder to get workers, and in the pandemic, it had been harder to get materials and things like that. So there's certainly a need for more housing. I think during the pandemic, you had people wanting to live in houses rather than downtown in apartments because of COVID. You had low rates, and so you had 2 or 3 years of very, very high price increases for housing, and now that is flattened out a lot as we've raised rates. And
Gentleman's time has expired. The gentleman from New York, Mr. Lawler.
Thank you, Mr. Chairman. Chairman Powell, you, the Fed's Vice Chairman for Supervision, and many others have indicated that the banking system is well capitalized. Bank capitalization remained robust during the COVID shock and related shutdowns of economic activity and in severe Fed stress testing. Nonetheless, the Vice Chair for Supervision wants to increase capital and other requirements on financial institutions. This will have substantial economic effects that will begin immediately while you are still focusing on bringing inflation back to the Fed's 2% target. Excessively high capital requirements will constrain credit provision to the economy, costing jobs, incomes, opportunities, and living standards. As my colleague, Mr. Garbarino, pointed out, a 1% increase in capital requirements could potentially reduce GDP by up to 16 basis points based on the Basel Committee literature. On January 21st, 2021, 30-year fixed rate mortgages had an interest rate of 2.77%. Now, for the same loans, individuals are looking at a 6.69% interest rate for a 30-year fixed rate mortgage. For the median home valued at $436,800, the difference from less than 2.5 years ago to now equates to over $300,000 more over the course of the loan. For the median household making around $71,000 a year, that extra $10,000 a year out of pocket in mortgage costs is crushing. Some areas like my district are even harder hit due to the high cost of living and the lack of housing. Combine that with inflation at or above 4%, and these factors are taking a real toll on the average American family, including in the Hudson Valley. Now, further decreasing the availability of credit to households and businesses across the country would only likely worsen this crisis. So, Chairman, do you agree that excessively high capital levels constrain banks' lending capacity with spillover effects on jobs and living standards for Americans, and effects would begin immediately, independent of any proposed phase in timing?
I do think that, as I mentioned earlier, there is a trade-off between safety and soundness and availability of capital, and you want to get that balance right.
But respectfully, you have testified that there was more than enough capital in these banks. So where are we unsafe and unsound that we would require more capital requirements?
Well, as I mentioned, that's the question we're going to be asking as we review the proposals when they do come forward. We don't have a proposal in front of us at this point. And I think as I mentioned, any increase in the capital for the large banks would need to be justified. I don't know that there will be much in the way of capital increases proposed for banks other than the very large banks, but we'll have to see.
So you don't believe regional and community banks will face the same requirements?
Very different requirements, I would think, as they do now.
But you're not looking to increase the requirements on them?
We'll have to see what the proposals turn out to be. Honestly, they're still to some extent in motion, and once they're out, we can have lots of conversations about the specifics. But until they are, it's tough to do that.
And you'll commit to providing this committee with all such analysis before any proposals come out?
I think there will be a proposal that comes to the board sometime this summer, and the board will vote on that, and we'll obviously share whatever analysis we have.
Are you concerned that any significant increase in capital could significantly jeopardize the Fed's efforts to rein in inflation?
So the thing about capital requirements is there would be a 90-day comment period, roughly, something like that, could be in that range. And then there would be a long period of considering those, the comments that are made. And then there would be movement toward coming to an agreement about what to finalize. And after that, so that would take many months. And then you would be into a situation where there would be long phase-ins. So I don't really think capital requirements play into the near-term economic situation the way interest rate hikes do.
Chairman, according to the Bureau of Labor Statistics CPI inflation calculator, it takes $1.16 today to buy the same consumer goods and services as $1 purchased when President Biden took office in January of 21. Do you agree that outsized inflation we have seen since early 2021 has caused and continues to harm workers, retirees, and families trying to make ends meet and pay their bills?
I strongly agree with that, and that's why we are taking the measures we're taking.
Thank you.
Gentleman's time has expired. The gentleman from North Carolina, Mr. Nichols, recognized.
All right. Thanks, Chair Powell, for being here with us today. Back in 1995, I worked here in Congress as an intern for Dick Gephardt. I was in his press office, and we had newspapers, where my job would be to clip out the articles and paste them on a sheet. But when I was here in 95, the Grateful Dead were playing. It was one of Jerry Garcia's last concerts. And I was just so disappointed that I missed that concert. But was excited to see that from public reporting that you were at the most recent Dead and Company show. I've been to this version with John Mayer and enjoyed it, but we weren't here. How was the show? Did you like it?
Oh, it was terrific. What can I say? So it was great. I've been a Grateful Dead fan for 50 years. So
Well, I've found one universal truth that I like people who like the Grateful Dead. So having said that, I have limited time, but do you want any time to go back to some of the questions that you had? You want to elaborate on anything that you've said here so far today?
you're very kind to offer, but I'm fine with the answers I've given so far, I believe.
Well, back to that show, a lot of people there in Virginia and like my constituents, they're very concerned about this economy. They're worried about, the cost of groceries, rising inflation, interest rates going up. And when we do these hearings, it's always big news. The things you say, move markets and are very important. But Fed speak is just so hard for my constituents and the American people to understand. What could you tell, the American people who are concerned about the economy in a way that they can really understand where this economy really is heading?
So I guess I would say this economy is very strong, and what's driving it now is just a very strong labor market. There's still significant demand for workers. There are more job openings than there are unemployed people. Wages are moving up, and that's really what's driving the economy forward. People's disposable incomes are coming up. Inflation is moving down gradually. The thing that troubles people, and I think the thing that accounts for the surveys you see where despite a historically strong labor market, people are still concerned about the economy, it's really inflation. So this is our job, is to bring inflation down. The way we do it is by raising interest rates. And while that can be painful, what it does is it gradually slows down demand so that supply and demand can get back into alignment, and so that we can have inflation running at 2% and people can get on with their lives and basically not have to think about inflation. That's what the definition of price stability from one standpoint is, just that people can live their daily lives without thinking about inflation all the time. We want to get back to that place, and we're on a journey to get there. We have quite a ways to go, but we're making progress.
And I've always wondered this, and I think there's a pretty simple answer, but if Congress was in charge of setting interest rates and it became a political thing, do you think that's something that we could handle as a legislative body?
I wouldn't want to comment on that.
That's a safe answer. All right. And I do want to just join on the chorus with a lot of my colleagues on both sides of the aisle here about capital requirements for banks. I brought this issue up with Vice Chair Barr, with Mickey Bowman, and in your written questions for the last time you were here, I didn't get a chance to ask questions because my seniority here on the committee, but you said, you answered in writing and you said, we've got to be mindful of the trade-offs associated with adjusting capital levels, as it could, quote unquote, cause banks to reduce the availability of credit or to pass higher costs of credit on to consumers, end quote. And you also said that, quote, capital and liquidity levels at our largest, most systemically important banks are at multi-decade highs, end quote. My constituents sent me here to lower costs for working families, so increasing borrowing costs really hits them hard. As the Fed considers new capital requirements, how do you intend to strike that balance between the trade-off that you talked about in your written response?
So that is the balance. You said it very well. So stronger capital requirements mean we have a stronger banking system, means it's more resilient to downturns and crises and things like that. So banks can continue to lend during even stressful times. And so that's very important. And we put a high value on that. And yet, of course, we know that at the margin, the cost of capital goes up for banks and the cost of credit will go up. So it's a balancing thing. And there isn't any one simple model or answer. So you just have to make a judgment call based on that. And that's what we'll be doing as these proposals are made and then assessed.
Thank you. I yield back.
Thank you, Mr. Nichols. I look forward to joining you at the next concert with the chairman. We'll see how that works out. Chairman Powell, thank you very much for taking time to be with us here today. Recognize, first of all, that you get, I think politely said, feedback from every sector on how you're doing your job. You are charged with 2 mandates. Primarily among those are price stability and combating unemployment. As my colleagues have discussed today, the labor market is clearly very tight, and you should be credited with succeeding in maximum employment and being a partner in this. Unfortunately, as we've also heard, and as the country is experiencing, we haven't collectively been as lucky in terms of price stability. Core CPI is still over 4%, and services and housing costs remain very sticky. Given the economic uncertainty on how the Fed will bring inflation to its 2% mandate, can you quickly touch on how the bank capital requirements Vice Chair Barr is proposing? And I'll be specific here. My Main Street businesses, especially farmers, family farms, and Iowans back in my district, really provide a backbone on this, and they depend heavily in this area. Do you think that they will be facing a more difficult and expensive credit environment as a result of this?
I don't think so, and particularly in the near term. So first of all, many of those people will be dealing with regional and community banks, right, rather than with the GSIBs. But even with the GSIBs, though, as I mentioned, the phase-in for higher capital, the process of publishing and then getting comments and evaluating those comments, and then coming to a broad agreement and consensus on what to implement and over what time period, that takes time. And it will not be important during this period of the next year or two when we're getting inflation back down to target and the economy's kind of normalizing. I don't think the capital the capital changes will have much of an effect in the near term.
So, Mr. Chairman, let me ensure that I'm hearing you correctly. Then, Vice Chair Barr is engaging with small businesses throughout the Midwest right now on potential knock-on effects from this holistic review. Some economic studies have found that these knock-on effects will increase borrowing between $50 and $200 billion. As we look to cut this in half, is this the right thing to be doing?
Sorry, cut in half.
The inflation rate.
Honestly, I don't think the two are really in conflict. We have an obligation to bring inflation back down to 2% over time, and we will do that, and we'll use our tools to do that. But I think the question of bank capital is real. I don't see it as a key factor in how we think about inflation, because again, it'll take quite a while to decide what to do and then to implement. Some of the changes we're talking about will have multiple year phase-in periods.
So, Mr. Chair, let me ask you on that implementation timeline, particularly for new capital standards. You said it would be some years before it would go into effect. According to a report published last year by the Federal Reserve Bank of Cleveland, in the case of implementation Basel III, banks began to increase their capital ratios, and I quote, prior to the publication of specific language applicable to U.S. banks, end quote. And that bank responses we estimate to take place well before Basel III rules started to come into force after 2014. Do you agree with the Cleveland Fed, and do you believe that our banks will begin to adjust as soon as the proposal is released?
Yes, I do. It's not an absolute thing where they'll wait until the effective date. They will certainly, and they may even be starting, but I would think the earlier you start, the more gradual the path will be.
Very quickly, I want to turn to a different subject. It's been brought up by a number of my banks back home relating to a central bank digital currency or any federal issued coin. We have seen how this administration and the last Congress wanted to require anyone who made more than $600 on a third-party settlement organization like an eBay purchase has to report that to the IRS. The existing threshold before the law was modified was $20,000. That is how far this administration wants to peek behind the curtain of what my constituents are spending their money on. And $600 in Iowa doesn't go a long way. It's the equivalent of a PlayStation or paying for your kids' dance classes. I'm a dad of 6. I digress on this, but I do want to know specifically for my constituents back home, the thoughts of creating a central bank digital currency that tracks individuals. If the Fed were to offer a direct individual accounts to citizens, wouldn't this be a direct threat to the financial privacy of many Americans?
Potentially, and that's why it's not something we support. We would not support, accounts at the Federal Reserve by individuals. That would not be. If we were to, and we're a long way from this, if we were to, support at some point in the future a CBDC, it would be one that were intermediated through the banking system and not directly at the Fed for exactly the reason you point out.
I'm very happy to hear that. I think that's a good partnership with the individuals there and a respect for Americans across the board. With that, I yield my time and recognize the gentlewoman from Colorado, Ms. Peterson, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chair Powell, for being with us again today. I come from Colorado. I was in the legislature for 10 years. And when the pandemic happened, I was part of being one of the unfortunately elected people during that time, that difficult time. When I think about what our country was going through a few years ago, where our economy was almost in free fall, completely shut down. Our local governments were they were slashing their budgets, they were laying people off, and what that moment meant that we had to do in stepping up at the national level to infuse dollars to save our country's economy. So my frustration here is that we continue to talk about inflation as if it was spending just to spend money, instead of acknowledging the urgent crisis that this country and this world was in, and what we needed to do in the moment to make sure that we were able to recover, keep our small businesses afloat, our local governments, and ultimately recover much more quickly than others. So since we talk about this often, I'd like to know, if you look to other countries around the world who didn't infuse dollars like we did, is there countries that we can look at to compare what the outcomes would be, and what is their recovery like now?
Our recovery is by far the strongest of any country. And I would say inflation that we have is actually, everybody has very high inflation. The EU, the United Kingdom, many countries within Europe as well.
Thank you. That was my next question, is how we compare to other highly developed economies on our recovery. So it sounds like in the emergency that we were in, the hopefully once in a century global pandemic, that the United States ultimately met the moment, and that when the American people look at what has been done, we should feel really good about where we are, but we know we have a long ways to go. And so I also want to acknowledge that something that comes up often is that rising debt leads to increase in higher rates of inflation. Doesn't that also include tax cuts, trillions of dollars of tax cuts that we couldn't afford that went on our rising debt?
In terms of today's inflation, so I think if you look, to your point, you look around the world, there's a common factor that has driven inflation very high in lots of advanced economies, and it's the pandemic, and it's everything about the pandemic: the closing of the economy, the reopening of the economy, the fiscal support, the monetary support, all the things that happened went into high inflation. And inflation is coming down. We'll look back on this, and we'll be able to look back at period of very high inflation. But I think it's not just monetary and fiscal policy; it's also just things to do with the pandemic, various shocks.
Absolutely. It's hard to believe where we were a few years ago and where we are now, although we do have challenges ahead. Another frustration that I have here is our failed policies around immigration reform and providing legal pathways for workers here in this country. When I talk to business leaders across the country, they say that the number one thing that we could do to address inflation is address legal pathways for people who want to work here. And so, while I recognize you say your job is to address inflation, you are still limited only within the tools that you have. So my question to you is, would an increased labor supply help supply chain issues and inflation in this country?
So we're seeing that now very much. A little bit to our surprise, we've seen a bounce back in labor force participation, and also a significant return to the prior trend in immigration. And that, we believe, and most analysts would say, that that's part of why employers are finding the labor market to be a little bit less tight now. It's still extremely tight, but that more labor supply is helping the labor market get back into balance, including through immigration.
Great, thank you. Another concern that I have is not just now our inability to address legal pathways to work in the United States and the consequences of not doing that to our economy. I really worry about in the long term if we don't address our labor shortage. So I'd like to know if we are unable to provide these pathways looking at the needs of this country, do you see this contributing to the rising costs and inflation here in the United States in the long term?
I'm not sure about the long term, but I would say that, right now still employers are reporting a very significant excess of demand for workers over the supply of workers. And so there's a lot of demand out there for people to work.
Thank you, Mr. Chair. Ladies, time has expired. I now recognize the gentlewoman from Texas, Ms. Dela Cruz, for 5 minutes.
I thank the chairman for holding this important hearing today. It is critical that this committee continue to explore how the Biden administration's ill-conceived policy and regulatory approaches are harming our nation's economy. And thank you, Chair Powell, for appearing before us today. I'd like to lead off with a question that I posed for Vice Chair Barr when he recently appeared before this committee. As representative for a largely rural district where my constituents, of which 86% are Hispanic, heavily rely on smaller institutions or community banking institutions for their financial needs. I am concerned about Mr. Barr's focus on factors that aren't necessarily material to the recent bank failures. His report on Silicon Valley Bank seemed to go out of its way to advocate for higher capital levels as a cure for the recent bank failures, instead of the failures of regulators and bank mismanagement. In fact, one of your other colleagues, Federal Reserve colleagues, Governor Bowman, echoed these concerns in recent remarks when she said, "The unique nature and business models of the banks that recently failed, in my view, do not justify imposing new overly complex regulatory and supervisory expectations on a broad range of banks. If we allow this to occur, we will end up with a system of significantly fewer banks serving significantly fewer customers. Those who will likely bear the burden of this new banking system are those at the lower end of the economic spectrum, both individuals and businesses." Just a couple moments ago, Rep. Donalds asked you a couple of questions, and your response was that you mentioned how important community banks are and that you are keeping them in mind with all that you do. As I speak with my local community and regional banks, they say that the increase in regulation and in capital requirements will really hurt them. With that being said, what I find as being an outsider in politics, new to the political arena, I find that people here in Washington, people who hold leadership positions, are often out of touch. And so I want to ask you, Chair Powell, do you personally bank with a community bank?
I have over time, not currently, but yeah, the last mortgage that my family and I had was you would like the story, I can tell you someday, but we had a very large bank which sort of failed at the last minute to come through with our mortgage, and we went to the local community bank, and they knew my family and they knew the house, and they were able to give us a mortgage without difficulty within a few days. So I have very positive experience with community banks.
So with your relationship with community banks in the past, how do you feel that increasing regulatory burdens would have consequences to these community banks?
So I really think that the things we're looking at are not about community banks. They're about the very largest banks, and to some extent, banks in the Silicon Valley Bank range is sort of 100 billion to 250 billion. So that's far larger than I would consider a community bank to be, under 50 and probably under 10 billion in assets. So those are not the focus of the regulatory reforms, I believe, that are going to be proposed to the board for consideration this summer.
And I will also hope that be true, because, as I said, in my district, we have a lot of community and regional banks that would suffer with increased regulation and capital requirements. And so with that, I have very little time, so I will yield back to the chair. Thank you.
The gentlelady yields back. I now recognize the gentleman from California, Mr. Sherman, for 5 minutes.
I want to comment on one success story. Several years ago, there were $16 trillion of LIBOR instruments where the amount the debtor was supposed to pay the creditor was to be determined by the London Interbank Rate. And as of June of this year, that rate will no longer be published. Something happened unusual here in Washington. A year and a half before the LIBOR hit the fan, Congress acted. You published your regulations in February, and the problem is solved. I want to pick up on the ranking member's comment that it's critical that we deal with housing. There's a lot we can do in Washington, but we also need to get cities to allow the construction of apartment buildings and condos. Someone has talked about the de-dollarization. We need to compete against the euro and against the won. But one place where Congress can act is with regard to crypto. The crypto billionaires have told us they want to displace the dollar. They're working for de-dollarization. And when billionaires tell you they are trying to hurt your country, you should believe them. There's been a discussion here as to whether it's the pandemic or Washington, D.C. policy that's caused the inflation. We have a perfect test case. Our annual inflation rate is now at 4%. The European Union, where Mr. Biden is not president and Mr. Powell is not head of their Federal Reserve, the European Union is in May had 7.1% inflation. The unemployment rate in the United States is 3.7%. The European Union is at 6%. And since the pandemic began, GDP has grown in the United States 5.3%. In the European Union, only 3.1%. I think it's pretty apparent that our policy has turned out to be actually better than Europe's policy. Banks and bank regulators have said, oh, how could we possibly have anticipated the inflation and interest rates of 2023? Today we have 4% inflation. That is almost exactly the average inflation rate over the last 50 years. Much lower than it was in the Reagan administration when we had 13.5% inflation, 16% interest rates. And that's why I blame the management and also the regulators at Silicon Valley Bank for telling us that, oh, this was an unanticipated circumstance. It's certainly one of the things they could have anticipated. I'll point out that both the Congressional Budget Office and the University of Pennsylvania Wharton School of Business's models both show that the estimated effect of the Inflation Reduction Act on inflation will be statistically indistinguishable from zero. So we'll accomplish a lot for the environment and not increase inflation. Of course, the recent action by Republicans to take away IRS enforcement will lead to higher deficits and higher inflation. The chair of the committee tells us we don't need regulation of our well-capitalized banks. Why are they well-capitalized? Because of our regulation. And I do want to focus on whether our banks really are well-capitalized. Mr. Powell, are our banks well-capitalized if you value their assets at today's fair market value, where we have experienced higher interest rates and the value of the debt declines? And are they well capitalized even if you assume that depositors are not just going to leave their money lying in the banks, but that the obligation the bank has to its depositors is valued at full face value, but the marketable securities and loan portfolio is priced at today's interest rates? Under those circumstances, do we have a well-capitalized banking system?
So I think you have to take the capital requirements as they are for purposes of this.
Well,
question.
that's the problem. Our capital requirements are hide the facts that are unpleasant.
Right.
If you don't hide the facts, are we well capitalized?
Traditionally, though, as you know, a rising rate environment has increased the value of the deposit franchise, which more than or at least offsets any portfolio losses.
So we're well capitalized if depositors are continue to be lazy and stupid.
The gentleman's time has expired. Chairman Powell can submit any additional response for the record. With that, we'd recognize the gentleman from Tennessee, Mr. Ogles.
Thank you, Mr. Chairman. Mr. Powell, as you know, when the COVID-19 pandemic started, the Federal Reserve began a round of quantitative easing, referred to as QE4. Like many COVID policies, this program dragged on, not ending until March of 2022. To conduct this program, the Federal Reserve expanded its balance sheet with short-term interest-bearing liabilities on one side and long-term interest-bearing assets on the other. And this was at a time of historically low interest rates. When predictably, expansionary fiscal and monetary policy sent inflation to the highest level in 40 years, the Fed was forced to raise interest rates rapidly. Now, going back to one of my colleagues' questions about the bank losses and the result of that being poor management and failing to hedge against the interest rate environment, is that a fair summation that management and failure to hedge is what caused some of the bank losses?
Certainly, many banks manage the interest rate risk that came along through that technique.
But some did not, is that correct?
Some did not.
In October, the Fed suspended its remittances to the Treasury due to losses. Mercatus Center estimates that the lost revenue for the Treasury will result in $760 billion over the next 10 years. And so it does concern me that Treasury is blaming banks for mismanagement when you yourself had to stop remittances and will suffer losses. Now, when the Fed prepared its and I said Treasury Fed, but semi-annual monetary policy reports through the time of QE4, none of those reports mentioned interest rate risk would impact the government's finances. Should that have been disclosed, or did the Fed not understand its own risk in correlation to the interest rate environment?
Well, so what we do, we remit all of our profits, right? And in the era of QE, those profits were enormous. We remitted something like $1.2 trillion in profits to the Treasury Department because, you know, we're funding purchases of long-term assets with issuance, as you pointed out, of overnight, you know, lower rate instruments. So, you know, in a way, that's what was happening during the QE era. As we now enter an era of raising rates, that'll turn around a little bit. But ultimately, though, we don't manage at all for fiscal reasons. What we're managing to is maximum employment and price stability, and we're using our tools to achieve that. So we don't think of ourselves as trying to attain some kind of fiscal goal one way or the other.
But what about as far as, well, I guess I'll ask this question. When you look at, you know, the roughly $700 billion in blow to the Treasury, how's that going to impact the president and Congress's kind of economic plans and policies going forward? I mean, is it going to impact negatively?
It's not, it doesn't affect spending, right? It doesn't affect, Congress appropriates money, the executive branch spends it. It will mean that more borrowing has to take place, and that could raise rates very marginally at the margin. But that's how it would affect the budget, but it wouldn't be a major effect on the budget.
Well, I didn't ask about the budget moreover than our overall economic goals. And I think what I think a lot of us are getting at is when you look at Main Street America, when you look at mortgage rates and how it's impacting, you know, families' abilities to get a mortgage. And so someone who was eligible for $300,000 to buy a home now is no longer eligible for that home. You have people that are now upside down due to this, you know, expansionary, you know, interest rate environment. And I have concerns about, you know, future raises and impact that's going to have on small businesses, availability of credit, and again, your average homeowner. And the people that pay that or bear the burden of that are your lower income and your middle class families. Now, when you look at Silicon Valley Bank, and which is supervised by the Fed, again, I get back to when you look at the interest rate increases, why there was not more warning or hedging from you as the impact it may have on the fiscal system, the financial system, and the banking system, because as we well acknowledged, both sides of the aisle, that there was some poor management, but the regulators and the communication from the government was lacking. And Mr. Chairman, I am out of time. Mr. Powell, thank you for being here, and I'll yield back.
Thank you, Mr. Eagles. With that, the chair recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you, Mr. Chairman, and I thank the ranking member. Welcome, Chairman Powell. Good to see you again. Chairman Powell, I heard some of your comments the last couple of days about the Fed seeking a softening in the labor market. And as a former union president for the ironworkers, I always took a dim view of a softening of the labor market because it, reduced bargaining power and that sort of thing. But I do admit that right now, unemployment rates are historically low all across the country. I think Massachusetts, the Fed numbers at 2.8% unemployment. Arkansas, even less. Alabama, even less. So I understand the need for your position. But when you look at the Black and Latino unemployment rates in some of these major cities, they're double that. And I can't help but seeing this as an opportunity to perhaps redouble our efforts to pull workers who aren't traditionally have strong connections to the job market and make things happen. At the federal level, we fund about 25,000 job training programs. And according to the GAO, we don't do a very good job. I think the average program produces about 3 workers per year. But I am aware of the work that the Boston Fed is doing with the Gateway Cities program. Susan Collins is running that in the Boston area. And the Fed actually helps us with data and coordination. And cities like Brockton, Massachusetts, my district, but also Fitchburg and other more rural areas, the Fed comes in and actually provides a great amount of expertise and has done wonderful, wonderful work. And I'm just wondering, are there other tools in our toolbox that the Fed could use to help? You could soften the labor market by adding workers as well. And I'd rather see that on the supply side than simply restrict credit and squeeze companies into a position where they have to lay people off. And I'm just wondering if there are other tools that you think might be available to us to accomplish that.
So I'll say 2 things. First, what the softening that we've seen so far in the labor market has been around job openings declining. It has not been around unemployment increasing. We've seen some wages moderating back toward more sustainable levels. You'll remember well the labor market before the pandemic, where we had 2% inflation and a really tight labor market with no inflation, and a lot of the gains were going to people at the lower end. That's where we all want to get back to, because what we have now is a very tight labor market, but inflation is so high, it's eating up the wage gains that these people make. So we need to get away from that. In terms of other tools, I visited East Hartford, which was another one of those cities, and I agree with you. We're not spending taxpayer money on this. We don't have the authority to do it. We convene people who have private sector funds, and we focus on a city. And I was really impressed. I don't know if you sound like you visited one or more of these cities. It's amazing what you can do.
Yeah.
But as a convener, really, rather than as an agency that has the authority to spend money on people. But so I mean, we do think about these things. We think that the most important thing we need to do for working people is to get inflation back under control, because it is people at the lower end of the income spectrum who suffer most immediately and worst from high inflation.
Yeah, I just think there are deeper structural problems in the limitations within our workforce. I met yesterday with IBEW Local 103 in Boston, and I talked to new electrician apprentices, mostly women of color, who they're working days, their husbands are working nights, and it reflects in that that very, very low unemployment number, which is, I mean, you're getting around 2%. It's really people who are in between jobs. Those are the people that are, so there's no real reservoir of unemployed workers there that you can rely on. And I do appreciate the way the Fed came in and the Boston Fed came in and big-footed the situation in Fitchburg, where they brought a bunch of people together and they accomplished a lot without spending federal taxpayer money. So I'm going to continue to try to find ways that we could use the resources that you have available. Mr. Chairman, I yield back.
Thank you, Mr. Lynch. The chair recognizes the gentleman from Georgia, Mr. Loudermilk.
Well, thank you, Mr. Chair. Mr. Powell, good to see you again. Thank you for being back here. I want to continue a dialogue that you and I had about Fednow. And I also want to continue voicing my concern that this product is a solution to a problem that the private sector is already addressing. The RTP network is already capable of instant settlement with a much greater degree of connectivity than Fednow will have at launch next month or in years to come. And my concern is also that the Fed has an undeniable advantage over the private sector in the payment space, as it can clear transactions through Fed master accounts. Furthermore, the Fed already has options to improve transaction speeds through existing services. For example, the Fed has discussed extending the operation hours for the National Settlement Service since 2015. So first question is, why not respond to industry demand by improving existing services instead of launching a new one that can compete with private industry?
Well, we, as you may remember, we surveyed all of the banks, not just the large banks who stood up RTP, which was a very positive development that we supported. And overwhelmingly, the smaller banks wanted us to set up Fednow. This was a very overwhelming view among smaller banks. They wanted a Fed alternative to RTP. So we set it up. And I would agree with you. That does not a reason not to work on the efficiency of our other payment services. And I hope we're doing that. I mean, I know we're doing that.
So we had also discussed in the past about setting up some guardrails to protect customers from accidental or fraudulent transactions. And we know that's a big issue across the entire financial services sector. And in response to that, you know that the banks already have procedures for customers to report unintentional transactions, and Fednow will come up with a suite of features as well to help institutions investigate and remedy any unintentional or fraudulent transactions. However, with real-time settlements, this becomes a whole lot more difficult than just debiting the account that received funds by mistake. Can you elaborate on how you're going to handle this protection?
Yes, and then, of course, RTP faces the exact same issues. I mean, it's a problem with real-time payments. You just have to have very high, extra high levels of security around the payments, who the payee is, and that sort of thing. And we do think we can master that and build that in, as any faster payment.
Do you have any ideas of the direction that you're looking to go? How are you going to be able to resolve those? Or is this just something you're beginning to look into?
No, I think we've built very strong safeguards in. I can't give you the technology answer.
Okay.
But we'll be happy to supply that.
Yeah, if you could supply that, I appreciate it. Just a couple other questions. Will the Federal Reserve itself use Fednow for real-time payments between banks and in the system?
I'm sorry, will it?
Are you going to use the Fednow for real-time payments between banks within the system?
Yes, I mean, that's what it's for. It's it's an interbank payment system that allows banks to offer real-time payments to their customers.
Okay, so with that, I'm going to divert just a little bit. I've dealt with in the past at state level with government competing with private industry. And we run into this problem where the government has an undeniable advantage. In this case, it had to deal with internet services, where city governments had gotten involved in internet servicing and started competing against private providers. And the issue came that the city governments were undercutting the private providers because of the poll access fee. So we passed legislation in the state of Georgia that required that any municipal government that provides a service that competes with private industry has to assess
themselves the same fees. So with that in mind, will transactions between Federal Reserve banks be subject to the same rules and fees as other banks? Are you going to charge yourself the same fees that the private industry and abide by the same rules as the private industry?
I don't know the answer to that. I will say, I wouldn't advocate, in the payment space, there are many, many instances of a government-operated payment system operating side by side with a private sector one. It was not something I would advocate broadly for in the economy. You think about ACH, you think about FedWire, there are private sector and public sector payment utilities operating next to each other in the United States and around the world.
Okay. Thank you. My time's expired. I yield back.
Gentleman yields back. The gentleman from California, Mr. Vargas, is now recognized for 5 minutes.
Well, thank you very much, Madam Chair. I appreciate the opportunity. I want to thank the ranking member too. Thank you. Mr. Chairman, I've always had great confidence in you. I've told you that personally. Now that you're a deadhead, though, I'm not quite sure. Especially after 50 years. But anyway, again, thank you very much for being here. I appreciate the service you've done for our nation. One of my colleagues was talking about the difference in inflation rates in the United States and Europe, on both sides, actually. One of my colleagues on our side talked about that. And I was wondering if you saw the headline today in the New York Times about the UK inflation rate. And you saw that they're running, I think, at 8-something%.
Yes, I did see that.
And you were asked a question by a gentleman on the other side of the aisle that when the Biden administration took over, what you could buy for $1 now cost $1.16, and that was hurting consumers. And you said, and I want to quote you, I strongly agree. But the question obviously inferred that inflation was the fault of the Biden administration. I mean, that's the whole point of the question.
That wasn't the question I answered, by the way.
That's right. And I was going to say that I'll give you an opportunity to answer that, because you later said that the pandemic was the issue all around the world. So is the Biden administration the cause of all this inflation?
So just to be clear, the question I answered was, is inflation hurting people? It was nothing to do with the cause of the inflation. And
but it's inferred, Mr. Chairman, when you say that this has happened during the time of the Biden administration. I think the question clearly infers that.
I think you understand the question I was really answering. So I guess I would say again, people are going to be unpacking the causes of this inflation. Many academic careers will be built on new ways to look at this. Former Chairman Bernanke delivered a paper with a colleague just a couple of weeks ago at Brookings on this. And I just think you see inflation everywhere in the world. There's a common factor here, which has to do with the pandemic. There's also a room for fiscal policy. There's a room for monetary policy in the explanation. And I just think it's very hard to unpack that. And it's not up to us to make a judgment about, we don't render judgment on fiscal policy. We don't support it. We don't criticize it. We take it as something that arrives at our front door. No matter who is president, no matter what fiscal policy is, it's not something we play a role in commenting on or criticizing or praising.
I wanted to give you an opportunity. I appreciate the answer. I wanted to give you an opportunity just to make sure if there was any confusion about that, the confusion was cleared up, and I think you've cleared it up. Now, I want to answer a question that you didn't answer, that you passed on. The question was if Congress should be in charge of setting the federal rates fund. I can't think of a worse idea. The only worse idea, I think, might be another idea that was set forward earlier, that maybe we should be involved in supervising the banks, Congress. We can't even figure out appliances here, for God's sakes. We closed down the government over appliances. We can't even figure that out. I don't know how in the world we'd be setting rates and how in the world we'd be supervising banks. Again, I think you guys can do a tighter job of supervising banks. I mean, I do think that and you guys have admitted to that with the Silicon Valley Bank, and I hope you do. And I know you're looking at these regulations. It was brought up that since 2008, 2009, their capital requirements have gone up, and the banks generally have done well in the stress test. What was the law that caused the capital requirements to go up?
It was a combination of Dodd-Frank and also the Basel Committee.
Of course.
agreements.
And those are the two things that I've heard from colleagues on the other side. They just keep beating up. Now they don't do it as much, but when I first got here, now that's the CFPB. But that was the choir again, once again, just saying it's the terrible banking. But the reality is it probably saved banking in the United States, and I appreciate it. Lastly, I would just comment this, and you don't have to comment. I'm just going to make this comment. Obviously, your focus is narrow and should be. But the notion of climate change is important. I do think that it's affecting the economy. I do think that it's affecting our world. And I do think that we've had our head in the sand for way too long on this issue. And we have to do something about it. Obviously, that's not your mandate, but obviously it's important. I hope we do something about it. We don't have the courage to do that in Congress. That's why I think others are doing it for us. But we have to do something. We see the bigger hurricanes. We see these things happening. And it's because of our participation in making it happen. Thank you very much.
Gentleman, time's expired. The chair now recognizes the gentleman from Oklahoma, Mr. Lucas, for 5 minutes.
Thank you, Madam Chair. And Mr. Chairman, it's good to see you as always.
You as well.
Many of my colleagues today, of course, have expressed their concerns about the upcoming Basel III revisions, and I hope you'll continue this dialogue with the committee once the joint rule is proposed and open for public comment. I'd like to follow up with a topic we discussed back in March. I'm sure you're keenly aware of how important it is for banks and companies to manage interest rate risk. Participating during the last several years, the Silicon Valley Bank made that very clear. Could you speak generally to how hedging interest rate risk is an important risk management tool for U.S. banks and companies?
I think you see the reality of it here. When rates go up, banks are encouraged by their supervisors and their own internal personnel and risk committees that they need to manage that risk. And most U.S. banks did a good or adequate job of that, I would say. But it's a fundamental risk of banking, one of the most basic risks, along with credit risk.
Exactly. And on that point, I've heard concerns that the Fed's Basel III revisions could increase costs for derivatives end users, whether hedging interest rate risk or commodity price risk. I'm optimistic that these concerns will be addressed. Having said that, these revisions to capital requirements do not exist in a vacuum. The SEC is proposing major changes of their own. Last week, I asked Secretary Yellen if Treasury is coordinating with the Fed and SEC on economic analysis necessary to understand the potential consequences of U.S. banks implementing both significant market structure changes and increased capital requirements associated with market activities. The Secretary responded that the Fed is, in fact, coordinating with Treasury on this analysis. Are you aware of this coordination, and have you personally been a part of these conversations?
I have not been a part of those conversations, but I do understand that that's correct.
Okay. Chairman Powell, I'd like to follow up with you on your conversation with Congressman Gonzalez from earlier today. You have assured this committee that the Fed is not a climate policymaker, and I appreciate your commitment to this. However, I'm concerned that the Fed's regulatory toolkit would be utilized in a way that would, in effect, require the Federal Reserve to make policy decisions on climate change. We've seen other U.S. financial regulators embark on significant climate rulemaking, such as the SEC. Chairman Powell, are there principles you keep in mind when ensuring that the Fed doesn't give in to, shall we say, political pressure around things like climate change?
There are, and for starter, one would be that we don't see it as at all appropriate for us to tell banks what legal businesses they can lend to. That's not our role. We don't allocate credit. So what we do is we supervise banks to make sure that they understand and can manage the risks that they're running. And we're thinking of that as our point of contact with climate change, in the sense that it's another risk that over time banks need to be able to analyze and assess. So, but fundamentally though, as I mentioned earlier, climate change is going to be a very important issue for a long time, and it needs to be addressed principally by by elected people, because it has enormous distributive consequences, and we don't have a mandate to deal directly with climate change as a policymaker. It does arise in connection with bank supervision, but that's not the heart of bank supervision. That's just a small part.
I very much appreciate those comments, Chairman. On another topic, I'd like to discuss the Fed's balance sheet, which currently stands at around 8.5 trillion. As you know, the size of the balance sheet more than doubled as the Fed worked diligently to stabilize markets during the height of the pandemic. Now, as the Fed begins to reduce the balance sheet, could you explain this process and describe the levels of securities that the Fed would look to maintain in the long term?
So the way the process works is securities mature and they roll off our balance sheet. And that's the way it works. And there's a cap for MBS, mortgage-backed securities, and also for treasuries, so it doesn't get too large. And if you hit that cap month upon month, it works out to roughly a little less than $1 trillion a year in shrinkage, which is a whole lot faster than what we did in the last cycle. But then again, the balance sheet is that much bigger. In terms of the level, we're thinking about a level that will allow us to operate our abundant reserves regime with enough of a buffer on top of it so that reserves won't accidentally become scarce. I can follow up more with you on this.
Thank you. My time has expired, Madam Chair.
Gentleman yields back. The gentlewoman from Ohio, Ms. Beatty, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Powell, for being here today. I have 2 questions I'm going to try to quickly get through. The first question on the U.S. dollar dominance is kind of a follow-up to Congressman Torres's question. Chair Powell, in the National Security Subcommittee, which I'm the ranking of, we've been discussing the importance of preserving the U.S. dollar's status as a global reserve country. Can you share with us the current status of dollar dominance as it stands today and whether there are risks to the strength of the U.S. dollar in the international financial system? And if so, what are some of the risks?
So the U.S. dollar is still the dominant reserve currency in the world, and that is principally thought to be as a result of our liquid capital markets, the rule of law, strong democratic institutions, price stability over the years, critically open. Money can come in and out of the United States without all sorts of legal restrictions and things like. All of those things are necessary to provide the world's reserve currency. We have them. There's not another economy that does have all of those features. So as long as we are a country of rule of law and relative price stability and strong democratic institutions and open capital accounts, we can continue to be the world's reserve currency. History shows that this is not a permanent status, but it is a lasting one. And I think in the case of the United States, as long as we maintain those characteristics of our government and our country, then we can continue to be the world's reserve currency.
Okay, thank you. Let me go to another question that will not be foreign to you. You know, as the former chair of diversity and inclusion, I asked you and others of your colleagues, and let me just say for the record, Madam Chair, that Chair Powell was always on point, went out of his way, in my opinion, to make sure that there was fairness and equity for all people. In light of that, I'd like to follow up with Congresswoman Waters' comments and maybe Congresswoman Velasquez, maybe what she was talking about. Several of our colleagues here in the Senate, the person who preceded you, it had been stated by many of us that we thought through banking deregulations, he was enabling risky banking practices and failing to combat lending discrimination, which for some thought it might have perpetuated racial inequities. A few weeks ago, Chairman Powell, on June the 7th, to quote, you said that we understand at the Feds that our actions affect communities, families, and businesses across the country. And everything we do at the Fed is in the service to our public mission. So could you maybe elaborate, or the time ran out with Congresswoman Waters on, is there anything you'd like to share with us that you do at the Feds that would dispel that there are things that you're not looking at that causes one or members of Congress to think that it is perpetuating racial inequities?
Well, as you know, we do consider, we call out disparate economic characteristics of different demographic groups, including by race, and we want those facts to remain present in the room as we're making our decisions. We try to think of maximum employment we do think of it as a broad and inclusive goal, meaning we're not just looking at the aggregate level. I think it's important to keep those facts in your head as you think about monetary policy. I will say, though, that we have one federal funds rate, and we don't really have tools that address distribution and historical inequities and things like that. Really, the Fed is not an agency that has those things. The best thing we can do for everybody, including in particular low and moderate income communities, is to maintain price stability and over a long period of time, and on top of that, a very, very strong labor market. Those strong labor market conditions are the single biggest contribution we can make on this area.
Thank you. And let me end by saying I appreciate your comments that you said you realize that high inflation imposes hardships as it erodes purchasing powers for food and housing from the least of us. Thank you so much for being sensitive to everyone.
Gentlelady's time's expired. Chair now recognizes the gentleman from Michigan, Mr. Huizenga, for 5 minutes.
Thank you, Madam Chair, and Chair Powell, good to see you again. I wanted to follow up on an exchange that we had back in March, this past March, where we were discussing the parameters highlighted in the Federal Reserve Board's legal opinions that outlined how asset managers can operate without being deemed, quote, in control of a regular bank or a bank holding company. Letters from the Fed's legal division also include certain commitments made by these asset managers to ensure the same result. However, it's no secret that this percentage of ownership held by asset managers will constantly fluctuate as shares are purchased and sold on a daily basis. With the ever-changing ownership structure, someone must ensure asset managers are complying with not only these opinion letters, your opinion letters prepared by your own staff, but also with the statutory and regulatory framework that the letters outline. So, Chair Powell, I'd like to ask you again, is the Fed taking any steps to assess or monitor whether Vanguard, BlackRock, and others are complying with these commitments made in November of 2019 and December of 2020, respectively? Is that ongoing?
Can you give me 1 second?
Okay.
Sorry, that's a very specific question. I didn't know the answer, but so I would say this: we're broadly monitoring the situation. I don't know that we have a particular focus on the asset managers.
Okay. Well, those were opinion letters put out by your folks outlining very specific things that could or could not happen. And back in March, when I brought this up, and now again today, I'm looking to find out who's actually minding the store on that. And that, so it's a little concerning that we don't have an answer on that. I guess we'll continue this conversation, and maybe you can answer this. What division at the Fed is responsible for reviewing and monitoring an asset manager's compliance with these opinion letters issued by the board's legal division?
So it would be the general counsel's office. We don't have any reason to think that they're not in compliance, by the way.
But nobody's checking.
Well, we'll check, but
Okay.
I think we know what we're going to find.
I'd like to know what you're going to find, not what you think you're going to find on that. So thank you. I'll be following up with a letter to include some more detailed questions on the topic, and I assume you will commit to getting us a timely answer into that.
I think we offered your staff a briefing on this, by the way.
Yes, and there was a briefing, and let me be clear. Appreciate the cooperation that has happened. We've also had some other briefings. There's been a number of briefings that we've requested, and frankly, your your division of government has been more helpful than others, shall we say. So I'm going to quickly pivot to a committee's investigation of the SVB, the Silicon Valley Bank failure. Your staff has been working to get us some answers on our outstanding questions. You did your own report. Now it's our turn. And can you appreciate that the committee, our committee, is conducting its own independent review of what happened in March?
Yeah, very much so.
Okay, thank you. Will you commit to producing the interview notes and allow us access to the staff who participated in the interviews conducted for the Fed's own internal review of the bank supervision report?
I'm not in the middle of that discussion. I don't know where that stands, so I don't want to make commitments that I can't back up. So I'll be happy to understand where that discussion is and try to
Okay.
work with you.
We're going to be following up for sure on that. When Vice Chair Barr concluded that a quote culture shift, his words, happened, do you know if the Fed officials spoke with examiners of other banks, or was this conclusion made solely after the review of SVB? In other words, did they find some systemic problem throughout the Fed?
The thing is, I didn't play any role by design in the preparation of the report, and I'm reluctant. I think I know the answer, but I don't want to guess. So we can give you a 100% clear answer on that, but I'd
Okay.
rather not speculate.
All right. Well, along with the FDIC and Department of Treasury, you invoked the systemic risk exemption, the SRE, for both Silicon Valley and Signature Bank, guaranteeing all depositors will be made whole. For example, regulators could have used orderly liquidation authority, the very tool Dodd-Frank was intended to resolve the, quote, too big to fail institutions while protecting taxpayers. Why was the decision to use SRE made, and do you think that is that we've now lowered the bar to use SRE in future bank failures?
I hope we don't have to face that question again.
We all do.
As long as I live.
But has a new bar been set?
I
No
would
pun
say this.
intended.
So this happened with no warning on in the middle of the night, Thursday night, and less than 12 hours later, we're on the phone with the FDIC, and they're deciding to close the institution and to haircut uninsured depositors. So it was an emergency situation over that weekend. We could see that there was an electronic run building up, and we did what we had to do to address that, and I think successfully.
Gentleman,
Time
time
has
has expired. Chair now recognizes the gentleman from Illinois, Mr. Foster, for 5 minutes.
Thank you, Madam Chair, and to Mr. Powell for appearing. Now, wars have historically been associated with elevated levels of inflation worldwide, although the relationship is complicated and wars can have impacts on both supply and demand. Higher inflation may just be one of the many prices that the humanity pays for the decision to go to war. Now, we don't have boots on the ground, but there's no doubt that in terms of supply disruption and military spending, both Europe and the US are effectively at war in support of the freedom of the people of Ukraine. So my question is the 2% inflation target a realistic and appropriate goal during a time when much of the world is effectively at war? Or should the 2% goal be thought of as a goal for normal times, with policies being put in place that will return to 2% when the war is over, or at least when we've decoupled adequately from the Russian economy?
2% is our goal, and it will remain our goal. It's a medium-term goal, so we're using our tools to get the inflation level back down to 2%. We're not considering changing it because of the war in Ukraine, and I don't know that that's playing a particularly important role in inflation today, although when energy prices and commodity prices went up at the beginning of the war, it certainly was.
Yeah, well, and certainly it's an important factor for Europe still.
Yes.
The disruption particularly. Well, just more generally, you have been trying to deal with this question of how you balance your dual mandate. And so whenever you're trying to optimize simultaneously two different things, the first step is to put them into common units. And so just to be specific here, let's say that you're missing your unemployment goal by 1% and you're missing your inflation goal by 1% in the opposite direction. At some point, do those two cancel? Is 1% in one goal equivalent to 1% in the other, or do you need a 2% missing of the unemployment target? how does he, what are the, I guess this must be implicitly, there must be that coefficient there in the Taylor rule and things like this that try to predict your behavior. But what internally, how do you view the difference between a 1% unemployment missing of the target versus a 1%
So
of inflation?
the Taylor rule is a pretty good place to start there. Same coefficient on both
Now,
variables
is that really true? I don't know. I'd have to go look at
in
it.
the original Taylor rule.
Okay.
But
Because it's not it's a coincidence if the coefficient is 1. Because you could choose a quarterly inflation target or an annual or a decadal inflation target numerically and get very different numbers. So
it's also there's a significant amount of research about the relative social costs of inflation and unemployment, and you wouldn't want to ignore that research either. So I think there'll be a lot of judgment in this. At the current moment, it's not a question because we're obviously the labor market is extraordinarily strong and we're very far from our inflation target. So we
Yeah,
don't
but, well,
have
you're
that
getting
conflict.
complaints from business that the labor market may be too tight. They're,
Yeah.
at least it's viewed from the Taylor rule point of view, that there is a penalty that you pay when the unemployment gets too small. There is a target you're trying to hit.
But both
Okay,
sides,
and
both sides
both
are calling
sides, right.
for tight policy, though.
Yes, that is correct at present, but there, you can certainly foresee times when they will be in tension, and they historically have been. And so you're saying that pretty much it's a 1% on both, that you
I
take.
think that's a starting place. I think it doesn't lend itself to that level of precision.
Yeah, well, it's either that or you have to face questions like you've been facing for the last decade. And just how do you balance this? Let's see, in terms of the internet or electronic runs on banks, it seems like that's a new thing that's going to have to inform bank capital and liquidity provider. The first question is, if you get a significant electronic run on a significant sized bank, is there anyone but the Federal Reserve that can provide that emergency assistance? Or do you pretty much have to be the only line of defense against the big internet runs?
Well, I think regulation and supervision can play a role in that as well. And
That's in stopping the run from starting, right? But
Yes.
but part of that stopping the run from starting is knowing that if it starts, that there is someone or some entity that can stop it.
we're the lender of last resort, and that is something that only the central bank can be or do. But I would say changes to regulation to assure that that you don't have this mismatch between runnable liabilities and available cash to fund their running. That's something we can address and will address through regulation and supervision.
Thank you. Yield back.
Gentleman's time has expired, and the chair now recognizes herself for 5 minutes for questioning. Welcome, Chairman Powell. I'm going to start asking about the FOMC, the Federal Open Market Committee's latest forecast. It predicted that core inflation will fall below 3% within a year. This forecast has been the exact same for each Fed meeting over the past 2 years and has been wrong each and every time. Why do FOMC participants continue to make the same forecast, sir? And what data are they reviewing to make this forecast?
So in the world of economic forecasting, we don't really have any advantage over private sector forecasters who've been at this. There's a number of private sector forecasters that are well-resourced, and the data are all public. We don't have private data. That's not how this works. And I think essentially all forecasters have made the same mistake, which is at the beginning thinking that the supply chain problems would be resolved quickly and workers would come back to work quickly and things like that. It's just been, inflation has consistently surprised us and essentially all other forecasters by being more persistent than expected. And I think we've come to expect that and expect it to be more persistent.
It seems that we moved way past the whole transitory thing, and for 2 full years now, they've been saying it's going to be under 3%, and clearly they've missed that. So it was just a little concerning to me if there was something that we're missing. Let me move on. In your press conference last week, sir, you stated that, and I quote, "The conditions we need to see in place to get inflation down are coming into place." What conditions are you seeing that show that we're moving in the right direction? Because I can tell you, my constituents are still feeling great pain of this inflation that continues to persist.
So there's underlying conditions that I'll mention, but the point is you get them in place and then the process of inflation moving down will take a significant amount of time. And we've been, consistent in saying that. And the conditions I mentioned would be, first, we need economic growth to be slower than, to be modest. And it has been at modest levels, so that's happening. Secondly, we need the supply chain bottlenecks to go away and get better and improve. And thirdly, we need the sort of mismatch between demand and supply in the labor market to diminish. And that has been happening. So all of those things are happening much later and much more slowly than we would hope. And, my committee and I do believe that that the process of bringing inflation down is going to be a relatively lengthy one, longer than we expect.
Well, it's clear that the spending on consumer services, for example, a car oil change, a haircut, or a concert ticket, remain almost unresponsive to rate hikes. Do you have a projection for when we might see this spending go down?
So non-housing services, the broad service sector is
Right.
famously less responsive to and less focused on rate hikes and the cost of capital. So what we think, and that's about half of core inflation, a little bit more than. So we think, and I think broadly, this is what forecasters think, is that it will take some softening in labor market conditions because in that service sector, it's very labor intensive. By far the largest cost for most service companies is labor. So what you want to see is rebalancing so that demand for labor and supply, a lot of that can happen through fewer job openings and things like that. And we do see it happening.
The Consumer Price Index, or CPI, which measures the price of everything from groceries to cars to rent, has in fact declined from its peak. But this personal consumption expenditures, this is the PCE index, which measures the, as we were talking about, consumer spending, remains historically high. How else can you account for this difference when it comes to a rate hike pause?
Well, we never used the word pause, and I wouldn't use it here today. What we did was we agreed to maintain the rate at that meeting. Almost every single of the 16 of the 18 participants on the FOMC wrote down that they do believe it'll be appropriate to raise rates, and a big
Yes.
majority believes raise rates twice this year. And I think that's a pretty good guess of what will happen if the economy performs about as expected.
Yeah, I think you're right. More rate hikes likely are needed to bring inflation back down to the 2%. And, we're concerned about a hard landing, about recession. So anyway, my time has expired. And I now recognize a gentleman from Illinois, Mr. Caston, for 5 minutes.
Thank you, Madam Chair. Thank you, Chair Powell, for being here. So in June of 2021 at the Green Swan Conference, you said climate change poses profound challenges for the global economy and the financial system. In October of 2021, FSOC's report on climate-related financial risk for the first time identified climate change as an emerging threat to U.S. financial stability. And in December of last year, the Fed released climate supervisory principles for large banks that said, quote, "The financial impacts that result from the economic impacts of climate change and the transition to a lower carbon economy pose an emerging risk to the safety and soundness of financial institutions and the financial stability of the United States." You've made many comments today that I think are broadly consistent with that in your role, and I appreciate the comments you've made in that capacity. Can I safely conclude that in June of 2023, 6 months after that release, that the Fed's position is still that climate change presents a risk to the global economy and the financial system?
Yes, I mean, I hasten to add, though, that our role in this is an important but quite small one around bank regulation.
Understood. And I'm not asking for the role. I just want to clarify that. The reason I asked that question is because on May 11th, your colleague Christopher Waller at a speech in Spain said, quote, "Climate change does not pose a serious risk to the safety and soundness of large banks or the financial stability of the United States." and went on to say that the risks posed by climate change are not sufficiently unique or material to merit special treatment relative to others. Should we understand as we sit here that Mr. Waller was speaking in his personal capacity and not as a designee of the Fed, if indeed Fed policy hasn't changed since December of 22?
So I don't comment on what any of the things that my colleagues say.
So I understand, but you understand the concern that if markets and regulators are to understand that the Fed has a consistent policy, and one of the members of the Fed is saying something that appears to be directly opposed to Fed policy from 6 months earlier, that's a concern.
Again, it's governors have always had the ability, and Reserve Bank presidents as well, the ability to have their own views on things, and that's going to happen, and that's probably a good thing that we have a diversity of perspectives. I think there may be less in that difference than you suggest. I mean, what I'm saying is that banks, to the extent we have a role, it is to assure that banks understand and can manage the risks that they do face from climate change.
Okay. Well, I don't want to create internal tension, but I think we're all aware that you, above anyone, is aware that your words are closely scrutinized, and we were concerned with the words of your colleagues there. Madam Chair, I'd like to introduce for the record a working paper from the European Central Bank, the impact of global warming on inflation. I don't know if you saw this report that just came out recently, but it says, among other things, that climate change poses risk to price stability by having an upward effect on inflation, both food prices and headline inflation. And what I wonder, without opining on their math, if in fact we are looking at a world where climate change, per the European Central Bank, is going to increase inflation, and we were to find ourselves in that world going forward, would the Fed or other central regulators say we have tools to address this, or are we going to say, well, that's non-core inflation? What are we going to do in hindsight? Because it feels to me like we've got a major bank regulator saying climate change is running the risk of inflation, but I don't even know what tool you would use to address that.
I can just say for now, this doesn't enter my thinking in any way that we would, in the near term, change our inflation goal because of climate change or the need to deal with it. There's a lot of thinking and research that over a long period of time, really the process of investing very large amounts of money in a green transition could drive inflation up, but that's not something we're thinking about today. We are not, during our FOMC meetings, we are not thinking about climate change as something that's relevant to the current inflation or to current monetary policy, and that is very much our focus today, is inflation today.
Yeah, and I guess what I'm struggling with is that if we agree that this is a systemic risk, if we agree that this leads to inflation, and we don't really know what role you'd have with tools, there's a concern there. Last thing I just want to end with, in April of 23, the report on SVB, one of the lessons that was noted in the Fed review said that this is an opportunity for regulators and bank managers to be more willing to adopt a precautionary perspective, and that the Fed must strengthen its supervision based on what we've learned. I'm trying to figure out with climate change, if we agree that this is a forward risk, how do we get the Fed the tools to apply a precautionary perspective?
The gentleman's time has expired. The chairman can submit an answer in writing to the record. And I now recognize myself for 5 minutes. Chairman Powell, in March, you confirmed to me that the Federal Reserve is a consensus organization built on garnering broad support before agreeing to any proposal. And given the breadth and scope of the potential changes to the capital framework that is under review right now, that consensus-driven approach seems to be all the more important. I am concerned that the Vice Chairman for Supervision is seemingly been given far too much latitude to act unilaterally, and especially in light of Section 1107A1 of the Dodd-Frank Act, which provides the Vice Chairman for Supervision authority only to develop recommendations for the board and oversee supervision and regulation. Can you speak to the process that's underway? Is the Vice Chairman acting unilaterally, or is that a wrong characterization? And if so, if it's just a recommendation, can you walk through the steps that the board will take from recommendation to a vote?
Sure. So I think what you see is very much the way the statute works, which is the vice chair for supervision has the responsibility, the obligation to develop regulatory proposals for the board that will be considered by the full board. He's, as I mentioned before in another context, he's not the comptroller of the currency. He brings proposals to the board, and the board votes by majority vote to support them. Or not, and that's how that works. In terms of supervision,
Is he including other members of the board currently as he's?
so I think all of us have been getting briefings on what's developed, but ultimately the job is to present something to the board for consideration by the board.
And how long will that, once he presents his recommendations, how long will there be debate, deliberation, and is that transparent for the public?
There will be a meeting, it could be a virtual meeting this summer to vote on these things. In the meantime, there's a lot of conversation going back and forth now, and we're sort of in that process now, but things are still moving around.
Our concern, Mr. Chairman, is that it seems right now the vice chairman is writing personalized assessments of bank failures and results of new Fed climate scenario experiments without a whole lot of collaboration with other governors. And so, given that this new scheme could raise capital requirements by as much as 20% in an already well-capitalized banking system, and that the cost of such changes could be $100 billion or more in lost GDP, I am concerned with your testimony that this would only be a virtual vote. Shouldn't this be a more transparent public board meeting and a deliberative process that includes all members of the board?
It's really just a question of calendars and when will people be. It's the summer, and but that's something we haven't decided what form the meeting would take. Would it be virtual?
Well, given that it's a pretty big decision, and that the law requires the full board to make this decision and not one board member to act unilaterally, we would hope that the Fed would hold public meetings on the new proposal. Will you and the Federal Reserve Board commit also, when the proposal is voted on, to also include your economic analysis that would justify whatever capital changes are made in a quantitative form?
I don't know that. I'm not sure we will have exactly what you're looking for, but we'll create a public record that supports the proposal, whatever it turns out to be, and the votes will be what they are, and it'll be subject to public comment and analysis, no doubt.
Well, in order for the notice and comment period to be meaningful, I think market participants will need to understand on a quantitative basis what the justification is for additional capital requirements, if in fact that's what the proposal is, given the fact that we already have a very well-capitalized system. I don't have much time left, but will you also commit to proposing appropriately tailored regulatory requirements based on the complexity and size of the financial institution?
So I will commit to supporting that. I can't commit to what the final product will be or what the vote will be, but as I mentioned at the outset, I do think we benefit hugely from a very diverse banking system, and I wouldn't want to do anything to jeopardize that.
Finally, earlier this week, the Wall Street Journal published an article that stated that unlike your predecessors, you have not focused on fiscal responsibility. Would you like to correct the record regarding that?
I would, thank you very much. So it was just an op-ed, but it was factually incorrect. I mean, there are countless times, and you've heard me do this, I've said the same thing that my predecessors have said, which is that the United States federal budget is on an unsustainable path, which means that the debt is growing faster than the economy, and that we're going to need to fix this, and sooner is better than later.
Time has expired. Thank you. And the gentleman from New Jersey, Mr. Gottheimer, is now recognized.
Thank you, Mr. Chairman. Thank you for being here today, Chairman Powell. I'm particularly concerned that the current regulatory environment disadvantages small and regional banks. Specifically with First Republic's receivership, I'm concerned that the largest banks were given preference in the bidding process, just enabling the larger banks to grow even bigger. My understanding is that certain regional banks were unable to bid on First Republic because of an extensive and time-consuming vetting process put in place by regulators that put them at a disadvantage in the bidding process. Mr. Chairman, are you aware of a regulator mandated pre-approval process that banks must complete to bid on firms going into receivership? And is there a notification process for informing banks that they can go through this process? Because I'm concerned that some who wanted to bid on First Republic were unable to.
So this is entirely something within the jurisdiction of the FDIC. We play an important role here, but when it comes down to selling a closed institution, that's just something the FDIC does according to their own procedures. To my knowledge, there were a bunch of regional banks involved in bidding for First Republic.
Do you know if, to your knowledge, if any were said they could not participate, or your understanding was that anybody
Honestly,
could
I don't.
participate?
I'm not aware of any, but I wouldn't be. That really is a question for, that's the heart of what they do. They have the lore, they have the people who have the experience and everything.
Thank you. Small and medium banks hold a large portion, as you know, of our country's commercial real estate loans. The Federal Reserve's May financial stability report stated that the higher interest rates may be increasing the risk that commercial borrowers are not able to refinance their loans, and that a correction in property values could lead to losses by banks that hold commercial real estate debt. I'm particularly concerned that such a correction threatens the stability of lenders and thousands of jobs in my district in northern New Jersey. How's the Fed looking at this and helping small, medium, and regional banks manage their portfolios or think about the risks of commercial real estate loans, and what guidance is being provided to banks given that nearly 1.4 trillion in commercial mortgages are set to mature in the next 2 years?
So following it very, very closely, and I think you've put your finger on it. This is a problem more for smaller banks, and not for all smaller banks, but it's the banks that have high concentrations. There will be losses particularly in the office and in some of the mall sectors. And what we can do, there's a supervisory playbook, and so the supervisors are in there, they're working with the company to help it preserve capital and do the right things to get through what may be a difficult time for some banks that have a high concentration.
Thank you so much. As was discussed today, there's concerns, obviously, that banks may be tightening their lending process and processes and tightening what's available. Are you concerned that higher rates and the recent instability in the banking system will lead to a credit crunch that can make it harder for small businesses to finance their operations and potentially lead to rolling blackout of loan defaults across industries?
So we're watching that very carefully. Bank credit conditions have been tightening for a year, and that's partly as a result of our rate increases. We're very alert to the possibility that the sort of shocks that happened in March might exacerbate that. We don't see a lot of evidence yet on that, but we wouldn't have expected to. So it's something we're going to continue to monitor carefully.
Are you concerned at all about the non-banks and what the crunch that could happen on that side?
Yes, I mean, the banks are obviously highly regulated and have capital and that kind of thing, and some of the non-bank lenders are in a very different place, and so, but we don't regulate and supervise them, and so it's something we're watching.
How do you think we as Congress should be looking at the non-banks? Is there any recommendations?
Where there is same activity, there really ought to be same regulation. You shouldn't be able to conduct the same activity. We regulate these things for a reason, and if we're not regulating them appropriately, then that should be changed. But if you can just go across the street and start a business that does the same thing without the regulation, then that's not going to be effective or fair.
With Basel III conversations up and running, and obviously driving towards some conclusions, it appears, or recommendations, is that something that you've been watching? Obviously, you have Fed representation there. What are your largest concerns in terms of requirements and how you're thinking through that right now?
So I think these are going to be very important. A number of very important proposals are coming, and I mean, I would just put out a couple principles, and that is, our banks are strong and they're well capitalized. I think that's pretty broadly agreed, and I think we're going to want to understand how even higher capital is justified. There'll need to be a case made for that. Almost as important as that, or maybe more important, is that we need to respect the diversity of institutions that we have in this country. And I mean, we benefit from having banks of all different shapes and sizes, and we don't want to push regulation or capital, for that matter, to a place where only the biggest banks have a viable banking model. We're a long way from that. I just think we need to keep that in mind.
Or be disadvantaged compared to our foreign
banks.
Okay, thank you so much. I yield back.
Thank you.
Thanks. Mr. Chairman, we have 2 more members here, but unfortunately, you're hard to stop at 1. Can we go over just by 5 minutes? Is that okay? Okay. No good deed goes unpunished. So we'll go to Mr. Davidson from Ohio for 5 minutes, and Ms. Garcia from Texas for 5 minutes, and then we'll wrap. Thanks.
Thank you, Chairman. Chairman Powell, thank you. Thanks for the extra time so we get all these questions in. And just picking up where my colleague, Mr. Gottheimer, left off, talking about non-banks and banks and kind of the regulatory framework. Recently, you published online the list of master accounts that the Fed has. Are any of those master account holders non-FDIC insured entities?
Are any of them? I don't know.
Could you get that answer back to us, please?
Sure.
Okay, thanks. So when I think about some of the dynamics that are going on in the market related to banks, non-banks, securities, not securities, one agency in particular has been very activist in this place over at the SEC, and it's kind of tangentially related to the Fed, but crypto and digital assets in the U.S. has got a market cap of around $1.1 trillion right now. It's been there for a bit. Do you acknowledge that this asset class has staying power in the U.S. economy?
It appears to have some staying power. Of course, that 2.1 trillion was, what was that a year ago? A lot higher.
Yeah, it's had some volatility in large measure due to the lack of legal clarity. And so hopefully this committee will help that quite a lot here this summer with at least two bills, one on stable coins and one on market structure. And it'll be clear, not just for Congress, but for regulators, including Chairman Gensler, and obviously market participants, whether they're forming the ideas or investing in the ideas or participating in the activities in the space. But when I think about participating in activities, one of the core functions that has taken place for a while now is the reverse repo market. So it's hovered over just over $2 trillion for the first half of this year, and it follows kind of exponential growth that we've seen over the past few years. So what's your assessment on the implications that the reverse repo market has on our economy?
Not much. It's just a place where that holds money on the Fed's balance sheet. It's like a mutual fund. I mean, in fact, it's as the Treasury has been issuing bills to refill the Treasury General account, we've actually seen the reverse repo overnight facility declining. So,
Isn't there some sort of conflict with higher reserve requirements, liquidity, and lending in the market? Or is there any tension there?
I don't believe so. It's just a place where largely money market funds have been putting their money. And as rates normalize in the economy, we're likely to see the reverse repo facility shrink dramatically. And I think without particularly important macroeconomic effects.
If you think about the implications, the Fed had to intervene in September of 2019 to provide stability and liquidity to that market. The fact that the Fed needed to use an emergency facility to intervene in the market would normally indicate some cause for alarm. Do you feel like that was an aberration? There's no more cause. Everything's been settled.
Well, that was about suddenly finding ourselves in reserve scarcity. So we'd been monitoring the level of reserves really carefully and thinking that we knew where scarcity would start to appear. And the problem is demand can be very volatile. So demand spiked and there weren't enough reserves. So you had a situation where we had to supply reserves in big quantities. That's not what's going on with the reverse repo facility was at zero for a very long time. And I think it's shrinking now. We don't know how much it will shrink.
Well, I think the growth of it kind of highlights some of the related concerns for inflation and tension between liquidity and frankly, when you look at the requirements for capital and the alternative returns in the market, there's concern. Well, all that capital can't be deployed in the same place. So when you have to pick places for it to be deployed, then it certainly has implications. So would love to follow up with you on it. Maybe align my own views with the thinking at the Fed and with some market participants. When I think about the Federal Reserve, of course, we think about monetary policy, and we want Fed autonomy on monetary policy to some extent. A lot of non-market intervention that to me continues to be a cause for concern. Continued purchases of mortgage-backed securities, for example, prevent real price discovery. Is Fed's purchasing propping up prices, or is it holding them artificially low? It's a non-market influence, and I think it has some distortions. So as chairman of Housing and Insurance, I am continue to be concerned about that. But the other thing is really the big concern is the regulatory side.
Gentleman's time's expired.
Yield.
We'll now recognize Ms. Garcia for the ultimate question of the day.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here today. It always is a breath of fresh air to have you here to give us the latest report on from the feds. I first want to thank you personally for working on a topic that has always been dear to my heart and dear to the heart of the Congressional Hispanic Caucus. I know several members have already touched a little bit on issues related to diversity and inclusion, and you yourself said something, and I really was struck by the words you used, that when you look at setting the interest rates, you want to reflect that all Americans in the room when you do it. And in my view, the best way to do that is to make sure that the people at the table making those interest rates decisions reflect what America looks like. So I want to thank you again for last month joining you was Adriana Kugler, who was nominated as the first Hispanic to ever serve on the Federal Reserve Board of Governors in its 109-year history. It took a while, but we're there now, and hopefully that will help ensure that when decisions are being made, that all Americans are indeed in the room with you. And so I want to thank you and the president both for making sure that that happens. I know that in my district that is 77% Latino, we're really proud of that fact. But Mr. Chairman, I wanted to see if you could provide me an update on the federal workforce, particularly within the Fed system, because I think that area too, you may recall we've discussed it before in prior times that you've been here, the workforce doesn't quite look like America. So could you give me an update on where we're at with diversity and inclusion issues related to Latinos in the federal workforce for the Fed?
Sure. Well, I guess the place I would start is a good part of the story, which is the directors of the 12 reserve banks around the country. That's been an area where we focused heavily on diversity and inclusion, and I think met with a great deal of success. So relatively high numbers. We can give you the numbers. We'll be happy to. Relatively high numbers of both Hispanics and African Americans and other minorities, and majority of women. So that's been an area where we have a free hand to act, and we can do that. I think in terms of the workforce, we actually had a particular focus at the Federal Reserve Board on Hispanics and working hard, particularly devoting ourselves to a tight focus on generating more Hispanic contact and more Hispanic employees. And I think we had some success with that. We spent a whole year of that, doing that a year or so ago. And so, you know, it's a very important, the most successful organizations in American society are, it's not a coincidence that they seem to me to be the ones that have pretty advanced diversity and inclusion programs, so that they do have, you know, all different parts of America represented around the table.
Great. Another area of concern for me has always been affordable housing. I know that is a challenge for us in Houston, and also the challenge of combating the homelessness crisis across America. I know that the ranking member, Chair Waters, this morning filed some bills related to seeking increased dollars for affordable housing and dollars for tackling the homelessness problem. Do these issues impact the inflation rate and the work that you're doing to lower the cost of housings for all Americans?
I think they may have a marginal effect on inflation. I think more, I would point to things like workforce participation. So people need housing so that they can get to the place where the jobs are. And in many metropolitan areas, the rents are very high, so people are having to work to drive very long routes to get to work. And I mean, labor force participation has an important effect on labor supply, which has an effect indirectly on inflation as well. So,
how long have we had the 2% goal for inflation rate?
unofficially for a quarter of a century, and officially since 2012. And every other central
What
banks.
factors would have to occur for you to reconsider the 2%, since it's been there for so long.
What would have to happen for us to
Mhm.
reconsider it?
Mhm.
I can't really think of anything. Nothing during my tenure will happen to cause me to want to reconsider it. If you come back in 100 years, it'll probably be different, but it's some unforeseen circumstance, I would say.
Thank you.
Somebody's time's
Thank
expired.
you, Mr. Chairman. I appreciate it.
I'd like to
for
thank the
staying.
Chair Powell for his testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions to the witness through the chair, which will be forwarded to the witness for his response. I ask you, Chair Powell, and your team to please respond no later than July 30th, 2023. And with that, this hearing is adjourned.
Thank you.
All right, guys, so that is the end of the show today. Before we go, I got a couple sponsored plugs. I've only done one sponsored plug all day today. And so with that said, today we are going to do a couple different sponsored plugs here. The first one is check out Top Step. I have been day trading on Top Step. Yesterday, I made over, oh man, this thing is stuck. Yesterday, how did I get this up here? Yesterday, I made over 1,000 day trading. And Top Step is, if you're one of those day traders that don't have that much money, you don't have that much equity, you're losing too much in the market. The futures market is where you should be day trading. There's no PDT in futures. You can day trade in short, just like stocks. I can buy market, buy bid, sell the ask. You could day trade the SPY. You could day trade the NASDAQ. You could day trade currencies, gold and silver, and the patterns are very similar, and they move with economic data in futures. And there's no PDT restrictions. You can day trade 500 times in a day if you want without being restricted by it. And again, it's just very similar to day trading stocks, but there's no PDT restriction. A funded account program like Top Step is the cheapest way to get your feet wet without taking on a lot of risk. It's really the best of both worlds, where if you're struggling and you want something that will build your skill, teach you how to trade, this is really what you want to do, because they give you a demo. The base one's $50K. You got to hit $3K in profit on that $50K demo without losing $2K total and pass their testing. If you do so, they fund you $50K with a 90% split. And so if you take that funded account, you make $20,000 on it, you get to keep 18 of that. They keep $2,000 since they're funding you that money. And you also get to keep your first $10,000 in profit. But on the other side of it, if you don't get funded and you lose, you probably would have lost more money regularly without taking these funded account programs. If you put the money up yourself, you probably lose more. And the base package on Top Step is only like 130 something if you use my link. And so there's tons of reasons to do these funded account programs. When I first got started day trading, I lost thousands and thousands of dollars. And I wish I had something like this, because this would have just ultimately saved me money. In the beginning, I wouldn't have lost as much. I still probably would have lost at least a couple of these accounts. And you could also reset it for 100. And so it's honestly much better to pay for the monthly subscription and then keep trying over like a week or two period to build up big profit. And then boom, you're funded. You can sit there and just kind of skate on that and withdraw every month if you're profitable. I think that's a really good way to do it. They are a sponsor of mine, and so I'm certainly biased in their favor. But if you want to check out the link, there is the link for Top Step in the description. You also have it up in chat right now. Also, guys, check out Moomoo. Moomoo is actually where I'm switching to in terms of stock trading platforms. So that's futures. If you want to invest, if you want to swing trade, if you open up an account and deposit, you can get up to 16 free shares of stocks on Moomoo. And Moomoo is really, really dope. Like if you look at Moomoo here, they have free heat maps. It's a lot like Webull, but a little bit better. And again, they're just really, really useful. If you open up an account on Moomoo and deposit at least $100, you get 5 free stocks. If you open up an account and deposit over 1,000, you get those 5 free stocks from before, plus another 10. If you deposit over 5,000, you get those 5 free stocks from before, plus that 10, plus another share of either Google or Tesla. So basically an extra $300, $200, $100 and something dollars, depending on how much Google is. It's just really, really good platform. There's free paper trading on Moomoo. There's just a lot of good reasons to use it. 0 commission stock and option trades, and it's open the entire time of pre-market. So it's open the entire pre-market session. And so in that regard, that's why I'm switching over, because TOS, I can't trade at all until 7 a.m. So I'm switching over to Moomoo. They are a sponsor of mine as well. But again, if you want to check out Moomoo and take advantage of getting free stocks, I mean, percentage wise, you're at least going to get what, like 5 to 15% if you deposit $100. That's a pretty good deal. 5 to 15%, just for depositing money is a pretty good deal. And I think if you start to use Moomoo, their scanners are really, really nice, and they're free to use if you have an account. I think if you start to use it, you'll be kind of addicted to it like I am now. And so again, if you want to check out that link, you get up to 16 free stocks upon depositing, including a free share of Tesla or Google. There's the affiliate link right there.
And again, these are only, this is the only sponsored plugs I've done except for one other one in a 6-hour stream. And so again, we average about, one plug an hour, and, we got one more. The other thing I've been using lately, and honestly, the reason I made that $1,000 yesterday was because I was using I was using TradingView, and I was using Chart Prime on the SPY specifically. So I have found that using Chart Prime, which is a TradingView indicator service, using Chart Prime, you can get really nice reversal calls. So again, what I set alerts to. So if you set these alerts, like, let me show you. So these are the 2 trades that I got into yesterday that made that $1,000. If you look at my Top Step gains, and so I am kind of using it with Top Step. If you look at my Top Step gains yesterday, I made over $1,000 taking these 2 trades based specifically off of Chart Prime indicators. And again, if you want to see this, I set an alert. So I can set an alert here, and I can say, hey, using the market oracle, which is what this is for Chart Prime, give me an alert if it's a possible reversal up or possible reversal down. I also have it to where it gives me phone alerts. So it'll send me a notification on my phone. I can run into my computer room and take the trade. $35 a month for Chart Prime. But look at every single time this gives you a reversal signal and an engulfing candle. Powerful on a 5-minute chart, specifically on a 5-minute chart. I think it'll probably work on other charts as well, but it's powerful. Look. Huge bounce after that happened. This was the second one I took. It gave me the alert on my phone. And look at the nice downward action you get for literally hours. Literally hours. Again, you can use this on any time frame. You can use it in stocks, crypto, Forex, future. Look at the reversal up signal here. Bounce. Same concept here. Again, same concept here. If you look at this, possible reversal up and a bullish engulfing candle. Nice little bounce afterwards. Look, literally called the bottom. Here's another example of it here. Same thing, except this is 3 different indicators. If you're strict and you only take it when multiple of these with a reversal signal and a candlestick pattern show up at once, you get nice little drops. And again, this is just a small percentage. I can't guarantee you're going to make money. Nobody can, but this is just a small percentage of what they offer. I can put up chart patterns. And if I zoom out here, it'll show me chart patterns on any specific chart. I can put up smart money concepts. If you like smart money concepts, I can zoom out here, and I can use any time frame. I can use a 5-minute, a 1-minute, a bunch of cool stuff here. And again, just a lot of different resources, indicators, stuff like that. If I put a longer term chart up, it'll actually show you the chart patterns, I think. If there are some. Sometimes they're wedge patterns. I've seen them before. Sometimes they're triangle. Let me get the smart money concepts out of there so we can just look at the chart patterns. But yeah, very, very useful. Look, there's a triangle pattern. It shows you when it breaks and the support holds. And so $35 a month is very, very cheap for this, in my opinion. Of course, they're a sponsor of mine as well. If you want to check it out, here is the link. And again, great way to help support the channel, guys, is to check out the sponsors. But of course, they're not you're not obliged to. Everything we do here is free, and I appreciate it, guys. We're about to break 110,000 subscribers, 110K. Again, you can find all the sponsors in my description. We're less than 200 subs away from 110K, and we'll definitely hit that tomorrow. So remember, guys, tomorrow Jerome Powell does his testimony in front of Congress. So today was his House testimony. Tomorrow is his congressional testimony, and so be ready for that. I'm not sure, Adrian. You want to reach out to them, Bobby? I'm not sure as well. Again, I would look out. Let me see. I'll try to look it up. What countries does Mumu work in? U.S., Hong Kong, Singapore, and Australia. And I think it also offered 24-hour. Okay, so yeah, so 24/5 trading for selected U.S. stocks is now available if it's on Mumu, Singapore, and Australia. Currently. Okay, so yeah, currently 24/5 is not available in the U.S. Okay, gotcha. Only in U.S., only in Australia and Singapore. But yeah, again, check out the links in the description if you want more info on these. These are all pretty useful. Again, I got 3 sponsors. I only really accept ones that are actually useful. And so check them out, guys. I appreciate the love. Again, I'm going to be back day trading on Top Step later. I'm waiting for the signals to show up because, again, I do have them alerting me on my phone. This looks like a short. And so I'm going to take one short position now. I'm already up. What am I up today? I know I'm already up some. Let me see what I'm up. Okay, so I'm already up $140 today, $140. And so we're going to see if this short works. I'm trading what's called the E-mini, which is just the SPY or the S&P 500. I just want to see if we get a little dip here. So we're flat on the trade. If I can build up a cushion, all right, you can see we're up a little bit. There's $25 in profit. We're shorting this. A little bit more of a breakdown. There's 25. Larger breakdown, we're up 40. Question is, do I want to keep pushing here? I'm going to go in and cut it and just take my money. All right, so we just made another. We're up about 180 on the day now, which is nice. So you can see we're up about 180. So far, my profit factor is about 3-1. So we're winning about 3-1 out of our trades. And again, if you want to try out Top Step, easiest way to get your feet wet. Taking challenges actually build your skill. Like they genuinely build your skill. A lot of people are going to lose these, but they genuinely build your skill. So I'm going to get out of here, guys. Y'all be safe. Good luck. Later, guys.